risk assessment, internal control, and materiality. So three different aspects are there. The title itself says we have to cover three broad concepts. What are the three broad concepts which we have to cover? Risk assessment, internal control, and materiality. And if you are aware, as a part of the discussion, whatever we had till now, we have already come across these terms. It is not something new to us. Did we come across all the three terms? But not in a detailed manner. We got a brief actually. Risk assessment we have seen. When we have seen that risk assessment? When we have understood audit procedures, the first and foremost procedure is risk assessment, where what we try to do? We try to understand the entity, environment, and its internal controls. For what purpose? To identify and assess the risk of material misstatement. Very good. Then we have seen internal controls also. I have told you about internal controls also. I told you brief meaning about internal controls. What did I say about internal controls? Any policy, any procedure which is designed and implemented by the management of the organization to prevent something from going wrong. This is simple meaning. Technical definition I will teach you in this chapter. So basically any policy and procedure which is getting implemented by the management of the organization to prevent something from going wrong in the organization, that we are going to call it as internal control. Then we have seen materiality also. So materiality, when we have come across this term materiality, when we have discussed the introduction to the audit chapter itself. So there one of the objective is the auditor has to express an opinion whether financial statements are free from material misstatements. So there I told materiality means something which is significant, major, important. But is there any hard and fast rule to decide this is always material, this is not always material? Is there any hard and fast rule for that? No. So, but when we can say a misstatement is considered to be material? When it affects the economic decision of users of financial statements, then we consider that misstatement as material. But we did not see anywhere till now how to fix that materiality. If I am conducting audit of an entity which is having 1 crore of turnover, what amount I can consider it as materiality? We did not know it. If I am conducting audit of 100 CR worth of company, what is my materiality there? What I can consider it as materiality? We don't know it at how. And also, if I am conducting audit of Reliance, which is having 6 lakh plus crores of turnover, how to fix the materiality in that company? That also we did not understand. That we are going to learn as a part of this chapter. How to fix that materiality, we are going to learn as a part of the chapter. So we have decided, we have understood that a misstatement will be considered material if it could influence the decision of users of financial statements. But how to decide it, which misstatement will affect the economic decision of users of the financial statements, that we are going to learn now. Okay, right. And as I have told you, in any chapter, we are basically learning the standards on audit only. As a part of this chapter also, we are learning the standards only. And 2 standards we are going to learn. How many standards? 2 standards. So this risk assessment and internal control part, this part has been taken from the standard SA 315, SA 315. Whereas materiality related discussion, whatever we are going to discuss regarding the materiality, that has been taken from SA 320. So we are going to learn 2 standards here, SA 315 and SA 320. Risk assessment and internal control part has been taken from SA 315, whereas materiality part has been taken from SA 320. So first what we will do is we will take up risk assessment part and we will try to have a discussion about it. So risk assessment, keep aside the procedure, keep aside the procedures. When I say risk assessment, what do you mean by that? You have to analyze the risk. Risk assessment means what? Assessment basically means analysis, evaluation. These are all synonyms for that. So analysis or evaluation of the risk. That is what the main meaning of risk assessment. Risk assessment in audit means what? When we are conducting the audit, we have to analyze, we have to evaluate risk of conducting the audit. Now let me ask you one simple question. You, after qualifying as a chartered accountant, when you started your practice, if your client has approached you, asked you to do the audit, you have accepted, and your ultimate objective is to express an opinion on the financial statements of the company. When you have undertaken an audit engagement where your ultimate objective is to express an opinion on the financial statements of the company, by undertaking this audit engagement, are you facing any risk? By doing an audit engagement, do you have any risk? Are you taking any risk by doing an audit engagement, or there is no risk at all? You have risk. What kind of risk you have? You have a risk of giving an inappropriate opinion. Whatever opinion that you have given, that might be inappropriate. You might give a wrong opinion. That risk, we call it as audit risk. In simple terms, if I have to put it, audit risk is the risk of expressing an inappropriate opinion. So now, can you eliminate that risk? Can you do the audit and say that I have zero risk here? My opinion can never go wrong. Can you say that? You can't say that. Why you can't say that? Very good. So we all know, we have learned when we are kids that we obtain reasonable assurance only. Audit always involves obtaining reasonable assurance. Reasonable assurance is a high level of assurance. You get high level of assurance, but you will not get absolute assurance. You will not get 100% confidence. You will not be able to give the guarantee by giving opinion, because the process of our audit suffers from some limitations, drawbacks. The process of audit suffers from some limitations which are of such a nature that you can't avoid them. So the process of audit suffers from some limitations which are unavoidable in nature. Those limitations, we call them as inherent limitations. What do we call them? Inherent limitations. Limitations which are unavoidable in nature. Like if I have to say a simple example, you have to give sampling. Today we are doing the verification of transactions on sampling basis. If I say there are total 1 lakh transactions in the organization, out of that 1 lakh transactions, since I don't have time, since I don't have enough of resources, scarcity of time and resources is there. Today everybody is doing the sampling. I will not be able to do 100% verification. I have taken sampling. Say for example, I have taken 20% sample. So that means out of 1 lakh transactions, you are saying that 20,000 transactions you have verified. Now, by verifying these 20 transactions, you form an opinion. By verifying these 20 transactions, you form an opinion. That opinion, will you form only on this sample, or will your opinion will be on entire population? Entire population. If I give you a simple analogy, this class, say for example, you are 30 students. So if I want to test your understanding of the concept, if I don't have enough of time, now I want to point out some person and ask a question. So say for example, I have pointed 5 people. 5 people are my sample. I ask the question to them. If I get the responses, I will form a conclusion. Yes, these people are having good understanding. Will I form my conclusion? Will I feel that only these 5 people are having a good understanding, or entire class is having a good understanding? Entire class is having a good understanding. So when I, from the population, when I take a sample, when I perform audit procedures only on my sample, but on that results, I form an opinion on the entire population, not just on the sample. But here there is the other side of the coin. When I say out of 1 lakh transactions, I have verified only 20,000 transactions, the other side of the coin is you are saying you did not verify 80,000 of the transactions. In that 80,000 of the transactions which you did not verify, there could be error also, there could be fraud also, there could be a material misstatement also. If you did not verify, you will not be able to identify. So this is the limitation. We have to do the verification on sampling basis. Can we avoid that limitation? Can we do 100% verification? No, quite not possible. Looking at the size of the organization today 100% verification might not be possible. We can't avoid it. If we have to complete the audit within a reasonable amount of time, if we have to complete the audit within a reasonable cost, we have to verify compulsorily on sampling basis. And if I do the verification on sampling basis, there is always a chance for my opinion going wrong. So the point which I want to conclude here is, whenever you accept an audit engagement, there will always be a audit risk. Audit risk cannot be eliminated or cannot be reduced to zero. Audit risk cannot be eliminated or audit risk cannot be reduced to zero. So then why we are doing the audit, sir? We are doing the audit. Our objective should be to keep that audit risk at a low level. Our objective is not to eliminate the audit risk. Our objective is to not completely reduce the audit risk to zero, but our objective is to keep the audit risk at a low level. As much as possible, at a very low level, you have to keep the audit risk. Okay, so that audit risk analysis you have to do. Analyzing the risk in the audit is very, very important. So let us try to dig deeper into the concept of this risk assessment. So first of all, let us try to understand what is the meaning of the term audit risk. I have already told you that, but let us see what is the definition they are giving in the standard. So if you see here, they defined it as, it is the risk, audit risk, it is a risk that auditor gives an inappropriate opinion when the financial statements are materially misstated. So what they are telling here, audit risk is a risk of giving an inappropriate opinion when the financial statements are materially misstated. Let us try to analyze this definition. Say for example, when the financial statements are materially misstated. When the financial statements are materially misstated. Tell me which kind of opinion will be appropriate. What is the appropriate opinion when the financial statements are materially misstated? Modified opinion you have to give. So depending on the pervasiveness or availability or non-availability of evidence, it could be qualified also, adverse also, disclaimer also. But if in a broader perspective, if I have to say which opinion you have to give, modified opinion you have to give. So if you came to know that financial statements are materially misstated, you have to give modified opinion. But I'm saying here I'm giving an inappropriate opinion. I'm giving what? Inappropriate opinion. So what do you mean by inappropriate opinion here? What opinion I am giving? I am giving an unmodified opinion. So when the financial statements are materially misstated, I am giving an inappropriate opinion. That means when I am supposed to give a modified opinion, instead of that, I am giving a what? Unmodified opinion. When I am supposed to say some financial statements are not completely giving a true and fair view, instead I am saying that financial statements are giving true and fair view. Okay, so risk of giving an inappropriate opinion. Let me tell you another scenario. Financial statements are not materially misstated. Let us say, for example, financial statements are not materially misstated. So what should be the appropriate opinion when the financial statements are not materially misstated? You are supposed to give unmodified opinion. That will be appropriate opinion. But you are giving a modified opinion. You are giving inappropriate opinion. That means what? You are giving a modified opinion. That could be qualified, adverse, a disclaimer, whatever it is. See, when these kind of circumstances will happen is, say for example, you are freshly qualified chartered accountant. You got a client, which is the first audit engagement you are doing. You have performed audit procedures, you have obtained audit evidence, and you concluded that you found one small misstatement in the financial statements. Practically speaking, it is not material. It is not at all material. Very small misstatement you have found. But since you are a freshly qualified chartered accountant, you have that excitement, you have learned a lot of things in the audit, you want to apply all your knowledge in the first engagement only. So we generally have that excitement, no? So you found a misstatement, it is not material, but ultimately materiality is a matter of professional judgment. You are saying that in my professional judgment, it is material. In my professional judgment, it is material. I want to give a modified opinion. So you want to show off all your skills in the first engagement only. So what you have done is, when you could have told financial statements are not giving a true and fair view, but instead in your opinion, you have given either a qualified, adverse or disclaimer. This is also, this will not come under audit risk. Second case will not come under audit risk. Only the first case will come under audit risk. So why? Because if you look at the definition, if you look at the complete definition, they are saying that risk of expressing inappropriate opinion when the financial statements are materially misstated. If they have ended the definition till here, if they have told risk of expressing inappropriate opinion, we would have told in both the cases it is audit risk. But what they are saying, financial statements are containing a material misstatement, and then you are giving a inappropriate opinion. Financial statements are containing a material misstatement and you are giving a inappropriate opinion. In that case only there will be audit risk. That means when modified opinion is appropriate, if you are giving unmodified opinion, that will fall under audit risk. But if unmodified opinion is appropriate and you are giving a modified opinion, that will not come under audit risk. If you go by the definition, even if I tell you concept perspective also. See, when you are supposed to say financial statements are not giving true and fair view, but still you have told financial statements are giving a true and fair view. Say, for example, in the financial statements, there is one prospective shareholder. Consider one of the user who wants to invest his money in one company. So in the financial statements, there is a material misstatement. What you should have done, you should have given a modified opinion. If you give modified opinion, this shareholder might have stopped his investment. He would not have made the investment in the company. But instead of that, you are giving an unmodified opinion. If you give an unmodified opinion, what this person will do? He will go and invest his money in the company. But tomorrow, when that fraud and error comes to the public domain, the share price of the company will fall. When the share price of the company will fall, this person will face loss. When he faces the losses, he will bring an obligation against the auditor. Why? Because when the people are in loss, they want to blame someone, right? So easy culprit will be we. He will say, I have read the auditor's opinion. He told everything is giving true and fair view, but I have invested my company and now the fraud has identified for that year. Please catch the auditor. So now I have to face the legal consequences or not. So here I am facing a risk. Let me take a typical scenario. Let me take another scenario. A prospective investor, he wants to invest his money in the company. So financial statements contain very small misstatement. Financial statements contain very small investment. So what I should have done is I should have given a unmodified opinion. So but what I am doing is, as an auditor, I am giving a modified opinion. So now this person will not invest his money in the company. This person will not invest his money in the company because as an auditor I have given a modified. Tomorrow, if that small misstatement has only turned out to be a very bigger fraud also, still I will not face any consequences. Why? Because I have behaved in a conservative manner. I have already given a modified opinion. In that case, I am not going to face any legal consequences. No, I am being a bit more careful. Because of my decision, no one is getting financially affected. But in the first case, I have to face legal consequences. So that's why when the financial statements contain a material misstatement and you are giving an inappropriate opinion, that only will come under audit risk. Able to understand? Now you all will get a doubt. Sir, when unmodified is appropriate, if I give a modified opinion, client will become unhappy. Definitely client will become unhappy, no? So when we are giving a modified opinion, when unmodified is appropriate, when financial statements are free from material misstatements, but because of small misstatements, if we are getting modified opinion, the client will definitely become unhappy. Then let him be unhappy. Who is worried? Let him be unhappy. No, we will not face any legal consequences, right? If at all he becomes unhappy, what he will do? He will not reappoint us. If at all he becomes unhappy, he will not reappoint us. Sir, we are losing a client. No. Yes, you are losing a client. That is your business risk. You are losing a client, you are losing your reputation. That is a business risk. When I say audit risk, I am talking the risk which auditor will face from the legal perspective. When I say audit risk, I am talking from the perspective of the risk which auditor will face from legal perspective. Losing of client, losing of reputation, non receiving the fees from the client. So all these are examples of the business risk. Audit risk does not include business risk. So audit risk means risk of expressing an inappropriate opinion when the financial statements are materially misstated. When modified opinion is appropriate, you are giving an unmodified opinion. Understood? Now, this audit risk can happen because of two factors. So simply, if I have to put it, if you are giving inappropriate opinion, that we call it as audit risk, and this chances of your opinion going wrong, this has gone batteries. Is it audible? Fine. Shall I continue? You want me to increase the volume? Now is it okay? Shall I continue? Okay. So audit gone. Hello. Batteries marchoa dintlo. Fine. So let's resume. So audit risk means risk of auditor's opinion going wrong, and that auditor's opinion can go wrong. That audit risk can happen because of two components. How many components? Two components. One is risk of material misstatement and the other one is detection risk. So audit risk can go wrong because of two components. What are the two components? One is risk of material misstatement and the other one is detection risk. So let us try to understand what is the meaning of risk of material misstatement. First, we will address the first concept. Risk of material misstatement means the chance of or the susceptibility of happening a misstatement in the financial statements even prior to the audit. Risk of material misstatement means what? The chance of, risk means basically a possibility. The possibility of happening of misstatement in the financial statements even prior to the audit. Even before you have started doing the audit, there is a risk that there is a chance of happening of misstatement in the financial statements. Let me give you one example to make you understand. Say for example, you are conducting an audit of the entity. You came to know that your client is storing an inventory at a warehouse. At that warehouse, there is no security guard. There is no CCTV camera, no proper inventory records. Because of that, do you find any chance of happening of misstatement? Yes. Where there is a chance of happening of misstatement? Inventory. In the inventory, what kind of misstatement could happen? Inventory might be stolen. Inventory might be overstated or understated. So you found a risk, a chance of happening of misstatement in the financial statements. And this risk is there even prior to audit. Whether you do the audit or not, this risk will always be there. If there are no internal controls in the warehouse, if there is no security guard, if there is no CCTV footage, if there is no proper inventory records, whether you do the audit or not, there is always a risk of happening of misstatement or not. Yes, this risk we call it as a risk of material misstatement. The chance of happening of misstatement in the financial statements even prior to audit. It has nothing to do with your audit. Whether you do the audit or not, this risk will always be existing. That risk we call it as a risk of material misstatement. Tell me, who is responsible for that risk? Management is responsible for that risk. As an auditor, are you responsible? Are you anyway involved in the making of the risk? No. So when it comes to risk of material misstatement, it is always and always the risk created by management. Auditor is nowhere responsible for creation of that risk. Then what auditor will do to that risk? Auditor is nowhere involved in the creation of that risk. See, if the management is having better internal controls, risk can be avoided. Since management is not having internal controls, risk is there. So it is this risk of material misstatement is something which is created, which is management involved risk. So auditor has no role in its creation. Then what is auditor's responsibility? If the auditor is nowhere involved in the risk of material misstatement, then what is his responsibility? What he is supposed to do regarding risk of material misstatement? He will only identify it. He will only identify it and assess it by way of performing risk assessment procedures. By way of performing risk assessment procedures. So auditor will not be involved anywhere in the creation of risk of material misstatement, but what is expected from the auditor regarding the risk of material misstatement is to identify and assess the risk of material misstatement by way of performance of risk assessment procedures. So basically you have to try to understand the entity, environment and its internal control, where the risk is there, where the risk is not there, that you have to identify with regard to the audit. Clear? So first component which will lead to audit risk is risk of material misstatement, and this risk will be there even prior to the audit. Whether you do the audit or not doesn't matter, this risk will always be prevailing. And who is responsible for its creation? Management. And this risk of material misstatement, the chance of happening of misstatement in the financial statement is can further happen because of two more components. This risk of material misstatement, the chance of happening of misstatement in the financial statements, it will happen even because of two more components. One is inherent risk and the other one is control risk. So audit risk has two components, risk of material misstatement and detection risk. And the first component is having further two components, which is inherent risk and control risk. So both inherent risk and control risk both collectively give rise to risk of material misstatement. The chance of happening of misstatement in the financial statements prior to audit can happen either because of inherent risk, either because of control risk. So they define the term inherent risk as the susceptibility, or let me read the definition, then I will try to explain it. So if you see what is the meaning of the inherent risk, they say susceptibility of an assertion to a misstatement that could be material either individually or in aggregate, assuming that there are no internal controls, or before considering internal controls. Sometimes you read the phrase also, before considering internal controls. The chance of happening of misstatement, even before internal controls are there, absence of controls. Or if I put it in simple way, this kind of risk is something where internal controls can't be implemented. If I put it in simple way, this kind of risk happens even before implementing internal controls. Basically, this risk is something where internal controls can't be implemented. If I tell you one example, there is a company which is a dealing in electronics, mobile phone manufacturing company is that. Now this mobile phone manufacturing company, the product in which the company is dealing, it is highly sensitive to the changes in the industry. If a new technology comes into the market, if you don't adopt to that technology, because of rapid changes in the technology, your product will become obsolete. Today AI, everybody is promoting their electronic products on the basis of AI. If you are an electronic goods manufacturing company, if you are not able to cope up with the technological changes, if the industry is very rapidly growing, some strong competitors are there, they are spending a lot of money on research and development, they are introducing new products, the small players will always have a risk of getting thrown out of the market. Because of that, their profits will be impacted, their assets will be impacted. Now the management will come under pressure or not. And if the company is dealing in such products, the management will be in pressure. If they are unable to cope up with the market changes, their product will become obsolete. This will create a pressure on the management to inflate their inventory values for getting the loan, to maintain the stock price, to increase the profits. This risk will always be there. Can you implement internal controls in this area? Can you change the market from getting rapid changes? No. Market will do, whether you do it or not, the market will always adopt to the new changes. But if you don't cope up with that, you will be become obsolete, and the management might come under a pressure to manipulate. There is a risk of manipulation. This risk will be there even before considering internal controls. You can't implement internal controls in this area. Number two, I will give you one more example. Take the case of ITC. ITC is a company which is into multiple products, but even today the major revenue comes from the tobacco, cigarettes. So now this company is mainly affected by changes in the laws and regulations, because these are the companies which are into sin products, the companies which are breweries, which are into alcohol business, and this tobacco based companies, we call them as sin companies, because they are dealing in sin products, no? Right. So now these companies are highly affected by changes in the laws and regulations. If tomorrow any change in the laws and regulation comes which bans the consumption of the alcohol or tobacco, it might be a serious effect on the future prospects of the company. So if that thing happens, there is always a chance of committing fraud through the manipulation in the books of accounts. Management might commit something wrong to avoid that laws and regulations. So this is also a risk of happening a misstatement in the financial statements. But can you implement internal controls in that area? No, we can't implement the internal controls in area. So those kind of risk, we call it as inherent risk, something which is built in. You can't tackle it, you can't control it. So that kind of risk we call them as inherent risk. Able to understand? So now if you read it, you will get the clarity. Susceptibility of an assertion to misstatement that could be material, either individually or aggregate, assuming that there are no internal controls. There will be no internal controls. And even you can't implement the internal controls in that area also. That risk we call it as inherent risk. Basically, absence of internal control. Okay, so no internal controls to prevent that risk. Then we have something called control risk. Control risk means the risk of happening misstatement due to failure of internal controls. There is an area on the organization where you can implement internal controls. Management has in fact implement internal controls also, but those internal controls have failed miserably to prevent a misstatement from happening. That risk we call it as control risk. Say for example, management has implemented internal controls of CCTV camera footage in the inventory department. There is an internal control, but still fraud can take place because no one is monitoring the CCTV footage. Or company has appointed company has appointed the security guards at the warehouse to prevent the theft. Internal control is there, but at certain point of time, like for example, people have to change their duties, shift they have to change. When the people are changing, when the security guard is shifting their duties, in between some half an hour of time gap is there where no security guard is available. Failure of internal control, which can make the misstatement to happen. That failure of internal control, the chances of internal control failing, that we call it as control risk. So either not having internal controls can lead to risk of material misstatement, or you have a control, but the failure of that internal control can also lead to a material misstatement, risk of material misstatement. So one of the main component of audit risk is risk of material misstatement, the chances of happening of misstatement even prior to the audit, and that risk of material misstatement can happen because of two reasons. One is inherent risk and the other one is control risk. Inherent risk means absence of internal controls. There are no internal controls to prevent a misstatement from happening, whereas control risk is a failure of the internal control. You have a risk, you have internal control, but that failed miserably to prevent the misstatement from happening. So that we call it as failure of the internal control. Clear? Right. Next, let us come to the detection risk. Okay, we have seen what kind of risk will be created by the management. So now what basically auditor will do is he will identify and assess the risk of material misstatement. On the basis of identification and assessment of risk of material misstatement, he will perform further audit procedures. He will perform compliance procedures. He will perform substantive audit procedures. Why he will perform compliance procedures and substantive audit procedures? Okay, compliance procedures, let us keep it aside. He will perform to determine the operating effectiveness of internal control. What is the main objective of performing substantive audit procedures? To identify the material misstatement. Actual misstatement identification, where it will happen? Substantive audit procedures. So auditor will perform further audit procedures to mainly find out material misstatement. But sometimes what will happen is audit procedures performed by the auditor may not be able to detect a material misstatement, which is already there in the financial statements. Because of the risk of material misstatement, there is an actual misstatement happened in the financial statements. As an auditor, you performed audit procedures to detect the material misstatement, but due to some circumstances, either because of your negligence, because of inherent limitations, whatever it is, the audit procedures performed by the auditor are not able to detect a material misstatement in the financial statements. That is something we call it as what? Detection risk. So what do you mean by detection risk? Audit procedures performed by auditor. So audit procedures performed by auditor. Performed by auditor may not detect a material misstatement. See, either, once again I'm telling, that could be either because of his negligence, that could be either because of his inherent limitations, whatever could be the reason. The audit procedures performed by the auditor may not detect a material misstatement which is already there in the financial statements. That risk we call it as detection risk. Now you tell me, who is responsible for the detection risk? Auditor. Here management will have no role. So detection risk is purely the responsibility of auditor. If the auditor performs a better audit procedures, if he is more careful, if he is not negligent, he can control that detection risk. On the other hand, if he did not perform proper audit procedures, if he was negligent, if he did not be careful while conducting the audit, then he will increase his detection risk. So between the risk of material misstatement and detection risk, which component will be under auditor's control? Which component auditor can influence? So overall objective of the auditor is to reduce audit risk to an acceptably low level. In order to reduce that audit risk to an acceptably low level, which component he has to control? Detection risk. So overall process audit, if we talk from the audit risk perspective, the auditor will accept the audit. The overall objective is to reduce the audit risk to an acceptably low level. In order to reduce that audit risk to an acceptably low level, he will perform risk assessment procedures. By performing risk assessment procedures, he will identify and assess risk of material misstatement. On that basis, he will perform further audit procedures with the overall objective of reducing detection risk to a low level, so that overall audit risk is reduced to an acceptably low level. Able to get the sequence here? Connectivity. I'm establishing the connection between risk assessment and audit procedures, audit evidence, everything we are connecting now. So overall objective of the auditor is what? To reduce audit risk. So overall objective is to reduce audit risk to a low level. In order to do that, first what he will do? He will perform risk assessment procedures. By performing risk assessment procedures, what he will do? He will identify and assess. He can only identify. He can't control it. He can't create it. So he will perform risk assessment procedures, identify the risk of material misstatement. On the basis of that risk of material misstatement, you will perform further audit procedures. By performing further audit procedures, you try to influence detection risk. You try to influence your detection risk, which will, by way of this, ultimately you will try to keep the audit risk at a very, very low level. Understood? Got the objective here? Right. So this is what the relationship between the components of the audit risk. And one more thing I will try to tell you here. They have one more paragraph. What is the relationship between the components of audit risk? So two components of audit risk is there. What are the two components of audit risk? Risk of material misstatement and detection risk. What is the relationship between the two? So if you find risk of material misstatement to be very high, what you will do? You will perform more audit procedures, less audit procedures. You will perform more further audit procedures. By performing more further audit procedures, will you detect more misstatements, less misstatements? You are detecting more misstatements. When you are detecting more misstatements, your detection risk is less or your detection risk is high? Your detection risk is less. When you assess risk as very high, you perform more procedures. When you are performing more procedures, more misstatements you are able to detect. If you are able to detect more misstatement, means your detection risk is low, no? What do you mean by detection risk? Not able to identify the misstatements, not able to detect the misstatements in the financial statements. If I say you are able to detect more misstatements by performing more procedures, that means you are reducing your detection risk. So when the risk of material misstatement is very high, you plan further audit procedures to reduce your detection risk so that overall audit risk will come to a low level. So you tell me what kind of relationship exists between risk of material misstatement and the detection risk. We have a inverse relationship between the risk of material misstatement and the detection risk. Clear? So quick recap once. Audit risk means risk of expressing an inappropriate opinion when the financial statements are materially misstated. If I simplify it, risk of giving a unmodified opinion when modified opinion is appropriate, whereas other way around will not come under audit risk. If you give a modified opinion when unmodified opinion is appropriate, that will not come under audit risk. Audit risk also not include the business risk. It has how many components? Two components. Risk of material misstatement, detection risk. What is risk of material misstatement? The prior susceptibility of or chance of happening of misstatement even prior to the audit. Who is responsible for that? Management. What auditor can only do? Identify and assess the risk of material misstatement by performing what? Risk assessment procedures. And this risk of material misstatement is further having two more components, which are control risk and detection. Inherent risk and control risk. Inherent risk means what? Susceptibility of a transaction to a material misstatement even before considering internal controls, or there are no internal controls to consider. Basically, absence of internal control. What do you mean by internal control? What do you mean by control risk? Control risk means you have an internal control in place, but that failed miserably to prevent the misstatement from happening. Failure of the internal control. So both inherent risk and control risk collectively lead to risk of material misstatement. Then we have detection risk. What is detection risk? The audit procedures performed by the auditor may not be able to detect a material misstatement in the financial statements. That could be either because of auditor's negligence, that could be because of inherent limitations, whatever it is. Clear, everyone? What kind of relationship exists between the two components? Inverse relationship. If the risk of material misstatement is high, the auditor should try to keep the detection risk at a very, very low level. Clear? Right. So this is what the question number 1 is all about in our material. So we'll go for a short break now. After the completion of the break, we will come back and resume discussing the chapter. Okay. Right. Fine. So let us resume our discussion. So since we have now, am I audible? But voice is low, right? Fine. Perfect. Okay. So we have understood what is audit risk, what are the components of the audit risk, and what is the interrelationship between the components of the audit risk. All that concept we have understood. Let us have a look at the material now. Quickly, we will try to cover this 6.1 heading, audit risk and its components. So this we have already seen. Audit risk meaning it is the risk that auditor gives an inappropriate opinion when the financial statements are materially misstated. If auditor expresses unmodified opinion, when modified opinion is appropriate, that will get covered under audit risk. However, audit risk does not include risk of expressing a modified opinion when financial statements are not materially misstated. In simple terms, when unmodified is appropriate, if you are giving a modified opinion, that will not get covered under audit risk. And it also does not include business risk faced by auditor like loss of clients, loss of reputation. These will not get covered under the audit risk definition. When I say audit risk, I'm purely talking in terms of legal risk faced by the auditor. Then what are the components of audit risk? How many components we have, guys? Two components we have. It is made up of two components, risk of material misstatement and detection risk. So even they have expressed it in the form of a formula, audit risk is equal to risk of material misstatement into detection risk. So what is risk of material misstatement? Risk that financial statements are materially misstated even prior to audit. It consists of two components, namely inherent risk and control risk. It is an entity's risk and it will exist irrespective of audit. So that means whether audit happens or not doesn't matter. This risk will always be there. And this risk of material misstatement is further having two components. One is inherent risk and the other one is control risk. So susceptibility of an assertion to a misstatement that could be material either individually or in aggregate, assuming that there are no internal controls. In other simple terms, absence of internal control is also called as inherent risk. And inherent risk is generally unavoidable and it is built into the system. It is inherent in the system. Examples also we have like technological developments may lead to product obsolescence. That electronic products related example whatever I have given. And high rate of business failure in an industry increases inherent risk of misstatements. Like when you are operating in a highly risky industry, then also the risk will be high. Then also the chance of misstatement in the financial statements could be high. Then control risk, it is a risk that internal control system fails to prevent, detect or correct a misstatement on a timely basis. That means you have internal control in place. The management without their fault, they have implemented the internal controls. But even after implementation of the internal controls also, the given internal controls are unable to prevent. Prevent means what? Stop it from happening, or they are unable to detect. Detecting means what? Misstatement has happened but they are unable to detect it. Or correct, that means even after detection they are not able to correct it, they are not able to take a rectification action. So those failures of the internal controls either to prevent, detect or correct a misstatement, we call it as control risk. It refers to the possibility that internal controls are not efficient enough to stop, identify or rectify material misstatement in the financial statements. Once again, same. Stopping means preventing, identifying means detecting, rectifying means correction. Also known as control weakness or control deficiency. This control risk, there are other names. We also call it as control weakness or control deficiency. And we have a statement here. There is an inverse relationship between control risk and efficiency of internal controls. If the internal controls are more efficient, control risk will be less. If the internal controls are not efficient, control risk will be high. So there exists an inverse relationship between control risk and efficiency of internal controls. So examples also they have given. A company has controls over cash and checkbooks being stored in locked safe with authorized access, but there is a risk that this control might not be followed. A company has a petty cash control for expenses under 10,000 rupees via the Impress system, but there is a risk that control is not being adhered to, control is not being followed. Okay. Detection risk. The risk that procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists, and that could be material either individually or when aggregated with other misstatements. That means you are performing audit procedures, but your audit procedures were not able to detect a material misstatement in the financial statements. And what is the interrelationship? They have which kind of relationship? They have inverse relationship. Now, if I put it in, there should be one question regarding this. So if I write that formula, on that formula they have asked a question. So what is the formula for audit risk? Audit risk is risk of material misstatement into detection risk. And risk of material misstatement is further a product of inherent risk and control risk. So which put together give rise to risk of material misstatement into detection risk. So if you do that, the final figure, the resulting figure, whatever you get, that we call it as audit risk. Now we have a question regarding this. Yes, see here. Come on, pay attention. Compute the overall audit risk. If looking into the nature of the business, there are chances that 40% bills of service provided would be defalcated. Inquiring on the same matter, management has assured that internal control can prevent such a defalcation to 75%. Let us analyze this statement. So some entity, when you are making an overall audit risk assessment, you came to know that there are chances 40% of the bills of service will be defalcated, will be misappropriated. And when I inquired with the management told, sir, if we are implementing internal control, we can reduce that defalcation to 75%. So you tell me, what is the risk before implementing internal control? Here in this case, 40%. So before implementing internal control, before considering any internal control, what is the inherent risk? 40% we have. By implementing internal controls, you can prevent to 75%. That means what is the control risk here? Control risk is what? 25%. 75% you are able to protect it by implementing controls. That means 25% will not be protected by internal controls. So control risk is how much? 25%. So now risk of material misstatement is a total component of inherent risk and control risk. So inherent risk is 40, control risk is 25%. So what will be the risk of material misstatement? 10%. If you calculate that, it will come to how much? 10%. Able to understand everybody? So before implementing internal control, we have 40. Because of internal control, we can reduce that to 75. That means control risk is only 25. So total risk of material misstatement is how much? 10%. Next. At his part, the auditor assessed that the procedures he could apply in the remaining time to complete audit gives him satisfaction level of detection of frauds and errors to an extent of 60%. He will perform audit procedures and he will get a satisfaction that he will be able to detect 60% of the frauds and errors. So which element, which component they are referring to? What is the detection risk here? 40 only. He is able to detect 60%. That means he is unable to detect 40%. So detection risk will become here 40%. So analyze the risk of material misstatement. We have already calculated, which is 10%. And also, what is the overall audit risk? So we know audit risk is risk of material misstatement into detection risk. Risk of material misstatement is 10. Audit detection risk is 40%. If you calculate that, it will come to 4%. Total audit risk is how much here? 4%. That's what even you will be able to find it in the answer. This was a question from the study material, the test your knowledge category. They have given this question. Compute the audit risk from the given facts. And these all facts they have given. Understood? Shall we go back into the concepts and understand them? Right. So let us have a look at it. So now let us come to the next concept. So we have seen that as an auditor, you have to identify risk of material misstatement. And I told that there are two components of risk of material misstatement. One is what? Inherent risk. Other one is control risk. Now they say that whatever risk of material misstatement that you have identified, that you need to classify into two categories. I'm not talking about components. So you will identify detection risk, you will identify control risk, you will identify inherent risk, and total risk of material misstatement you will identify. Whatever risk of material misstatement you have identified, that can be classified into two categories. Number one is risk of material misstatement at the financial statement level, and the other one is risk of material misstatement at the assertion level. Risk of material misstatement at the financial statement level and risk of material misstatement at the assertion level. Let's try to understand what are these two. First of all, what is the meaning of risk of material misstatement? The chance of happening of misstatement in the financial statements even prior to the audit. Now, what do you mean by risk of material misstatement at the financial statement level is, by performing risk assessment procedures, you identified some risk. There is a chance of happening of misstatement. And because of that circumstance, the chance of happening of misstatement is there in the entire financial statements. You found some circumstance because of which or that circumstance, that risk is having the potential to cause a misstatement in the entire financial statements, not just in one or two items, that particular circumstance will have a possibility to affect the entire financial statements. Let me give you one example to make you understand. So you are conducting audit of an entity. You came to know that the person, whoever is responsible for preparation of financial statements, there will be some person inside the company who will prepare the financial statements. The person who is responsible for preparation of the financial statements, he doesn't know Schedule 3, he doesn't know accounting standards. He doesn't have a good knowledge of it. He is not a qualified person. Such a person is preparing the financial statements. The moment you came to know about that circumstance, don't you think here there is a risk of material misstatement? Because of the circumstances, there is a chance of happening of misstatement in the financial statements. This risk is having a potential to cause misstatement in the entire financial statements, or this risk is having potential to cause misstatement in just one or two items. If the person who is preparing a financial statement, he doesn't have a knowledge of Schedule 3 and accounting standards, there is a possibility of entire financial statements getting affected. So this risk, I call it as a risk of material misstatement at the overall financial statement level. On the other hand, when I am conducting audit, I came to know that the billing software, whatever they are using for the purpose of recognizing revenue, that billing software is having some issue. Then in that billing software, some coding error is there. Is that causing a risk of material misstatement? Yes. Is that risk having a potential to cause a misstatement in the entire financial statements, or one or two specific elements? One or two specific elements. Which item will get affected? Revenue will get affected here. So that risk, we call it as risk of material misstatement at the assertion level. Clear, everyone? So we perform risk assessment procedures. We identify the risk of material misstatement, and whatever risk of material misstatement that we have identified, we have to classify into two categories: risk of material misstatement at the financial statement level, risk of material misstatement at the assertion level. Risk of material misstatement at the financial statement level means that risk which is having a potential to cause a misstatement in the entire financial statements. Risk of material misstatement at the assertion level means that risk which is having a potential to cause material misstatement at one or two specific elements of the financial statements. Understood? So like this, we have to classify into two, to which we have to pay more attention, where we have to get worried. Risk of material misstatement at the financial statement level, for that we have to pay more attention. So that's what they say here in the 6.2, risk of material misstatement at the financial statement level, risk that relate pervasively many items of the financial statements as a whole, and they affect many assertions. They affect so many items, not just one or two items. Examples: if the top accountant is not competent, it can lead to errors in the financial statements that affect many areas, not just one account or assertion, but also accuracy, existence, completeness, valuation. Every assertion might get affected. On the other hand, risk of material misstatement at the assertion level, it relates to risk identifiable with specific assertion. At a class of transaction, account balances, or disclosure level, an assessment of risk such as high, moderate, or low should be made for each individual assertion being addressed. For each item of the financial statements, we have to identify whether the risk is high, risk is low, risk is moderate. Like yesterday, I have shown you audit strategy, planning, and program. There we identified whether risk is high, low, for which assertion risk is high, for which assertion risk is low. So that you have to identify it. So like this, you have to identify risk of material misstatement at two levels. Then comes the next part. What are the various steps for risk identification? What and all are the steps you have to perform to identify the risk and to assess the risk? Overall, when you are analyzing and assessing the risk, what and all are the steps that you are required to perform? So if you look at the list here, they say one list here. Let us try to have a look at it. First one, you need to assess significance of the assessed risk. Whatever risk you have identified, that risk significance, you have to find it out. What is the importance of that risk? And if that risk materializes, what is its impact? You found that at the inventory there are no internal controls. What is its significance? Is it important or not important? Or if I put it in other way around, is it at the financial statement level? Is it at the assertion level? That you have to analyze. And also its impact. If at all, if someone comes to know that there are lapses in the internal control, they might steal an inventory. How much impact of loss can happen? And also you have to revise materiality for specific account balances. This revision of materiality we will see in SA 320. But just remember, depending on the risk, we decide the materiality. Depending on the risk, what we will do? We will decide the materiality also. How to decide that materiality? We will see at the end of this chapter. So first step, you have to assess significance of the assessed risk, what will be its impact, and also determine materiality accordingly. Number two, determine the likelihood for assessed risk to occur and its impact on audit procedure. See, for example, you found some risk of material misstatement. Just because risk is there, there might not always be a misstatement. There might be a risk in the organization, but there might not always misstatement can happen. So you need to assess how much possibility is there for that risk to materialize. If there's a lapse in internal control system, how much percentage of risk will happen? What is the probability? Is there 70% chance of happening misstatement? Is there 80% chance of misstatement? Or I came to know that the company is completely automated. Very less human involvement is there. There are no internal controls. Yes, risk is there, but the possibility of converting that into misstatement is less. Why? Because human involvement is very less in that company. So risk is there. You need to identify what is the likelihood of occurrence, how far that risk can materialize into a misstatement. Next, document the assertions that are affected. Which assertions are getting affected? Like if you are conducting audit of the balance sheet items, you need to verify, because of this risk, will existence be affected? Will completeness be affected? Will the assertion of ownership might be affected, or will the assertion of valuation might be affected? So make a list of one risk, what assertions will be affected. Make a list of that. Next, consider the impact of the risk on each assertion: completeness, existence, accuracy, etc., which are relevant to account balance, class of transaction, and disclosure. Like we have seen previously, whenever you find risk of material misstatement at the assertion level, you have to classify it, whether the risk is high, moderate, low. So that matrix you have to prepare. Next, identify degree of significant risk that requires separate attention and response by the auditor. Out of all the risks you have identified, you need to find out what are the significant risks, what are major risks which requires more attention from you, and what audit procedures you are planning to tackle that risk. Next, inquire and document management responses. Once you have identified all the risks, you have to go and discuss with the management once or not. Sir, these risks are there. What is your responses? How you are going to tackle that? Next, consider the nature of internal control system. You have identified the risk. For that risk, management could have implemented the internal controls also. Go and discuss with the management what nature of internal control system is in place and whether that internal controls are effective or not, ensuring whether the internal controls are routine in nature or periodical. Like for example, some companies there which is making a lot of cash sale. Now they want to verify, they want to implement some internal control that cash is not getting misappropriated. What they can do is they can run internal control on daily basis. At the end of every day, that concerned cashier will do the counting of the ledgers and counting of the cash collected, and he will give a report. That is a routine checking. And the other one is monthly checking. The cashier is not doing everyday reconciliation. He is doing reconciliation only in a month. Tell me where risk will be mitigated better if you are doing it on a daily basis. And also whether the internal controls are designed to prevent or detect and correct the errors. And also whether the controls whatever client is operating, whether they are manual or they are automated. And also unique characteristics of the risk. Sometimes some risk will have unique characteristics. This is typically the case. Say for example, you are conducting audit of this emerging technology related companies. One company is dealing in the cryptocurrencies. That will have a unique risk. What is the unique risk is, see, this blockchain, this cryptocurrencies and all are highly fluctuating. So the company might have huge amount of cryptocurrencies. Currently the value might be very high. But since these cryptocurrency markets are very much unregulated, all of a sudden cryptocurrency prices might crash and their assets will value now nothing, which can have an impact on the going concern. So like that, some risk will have a unique characteristic. Try to find out whether any such risks are there which have unique characteristic. So right here for the example, risk of cryptocurrencies, cryptocurrency related risk. Crypto risk. And also consider existence of any particular characteristics in the class of transaction, account balance or disclosure that need to be addressed in designing further audit procedures. And whatever risk that you have considered, that you need to even pay attention while designing your further audit procedures in the class of transactions, account balances or disclosures. So very much a vague question, I know that, but this is what you have to remember. So what are the different steps for identification of risk? Even there is one question also, right? If I let me show you that. See, like this one simple question is also there, but sometimes they can even give a concept kind of question also. Your engagement is seeking advice from you as an engagement partner regarding what are the steps for risk identification. So just now we have seen what are the various steps for risk identification. Come on, repeat everyone. Number one, you have to identify the significance of the assessed risk, what is its impact, and also determine the materiality. Number two, you have to determine what is the likelihood. Risk is there, but what is the possibility of that converting into a misstatement? That likelihood you have to decide. Number one, what and all are assertions that are getting affected that you need to identify, and impact of the risk on each assertion, like whether risk is high, low, moderate, that you need to make a list. Then you have to identify significant risk. Out of this risk, which risk are significant risk, and how you are going to respond to that significant risk. And also you need to inquire what are the management responses. You need to see whether there are internal controls are there or not, which mitigate that risk. That internal controls can be either routine in nature, or they could be whether they are designed properly to prevent, detect or correct misstatement, whether they are manual or whether they are automated. And also if the risk is having unique characteristics, consider that unique characteristics, and also verify whether there is any specific characteristic which could have an impact on your audit procedures. So these are all the steps which you need to consider while you are doing the risk identification. Basically, whenever you are performing risk assessment procedures, these points you are required to keep in mind. Okay. So then we have one more general question: possible potential misstatement indicators. Generally, sometimes some circumstances will give us a hint that there could be a possibility of misstatement. So what are that indicators? They are just asking you some indicators. This point is not related to any concept. This is somewhat a general question. So what are the instances, what are the facts or circumstances which give a hint to you that there could be a possibility of misstatement? They have given assertion wise. First of all, let us talk about completeness. What do you mean by completeness assertion? Completeness assertion. All transactions should have been recorded. Nothing should have been missed out. When I have an indication regarding completeness misstatement, what do I mean by that? Sometimes from the circumstances, I get a hint that management could have missed out some transactions in the books of accounts. That is what the indicators of completeness, right? Indicators of misstatement and completeness means what? Sometimes some events or circumstances might give me a hint that management might have missed out something from the books of accounts. When I will get that hint, as you could see here, transactions which are not identified. You are able to find one entry in the books of accounts. So you are able to find one supporting document. Say for example, you are able to find one purchase invoice, but you are not able to find an entry regarding the books of accounts, regarding the same invoice in the books of accounts. Don't you think that is a indication of completeness? Management might have missed other entries also. So that is one example. Source documents not prepared. That means companies are entering into transaction, but documents are not getting generated. A company is making cash sale, but whenever they make a cash sale, they are not generating a sale bill. When they are not generating a sale bill, it will not be recorded only. So indicator of misstatement regarding completeness. Source documents not captured. See, first point and third point both are same. Source document is there, but you find that it is not there in the books of accounts. Next, rejected source documents not represented. Say for example, one employee has submitted his expenses. Generally, companies will do reimbursement of their sales staff related expenses. So one sales related staff went to the other place. He incurred some expenditure on his hotel accommodation travel. He submitted the bill. Now one of the officer, he did not find the expenses satisfactory. He find that in the hotel bill it was 1000 rupees, but the employee has claimed 1200. Now what the officer will do? He will reject it. He will say that no, these expenses will not be approved. See, when this expense is rejected, that employee should have submitted another bill. When this is rejected, he will submit a correct bill. No, but you are able to find that one document was rejected, but but subsequent entry was not found. What does that mean? That employee might have resubmitted, but they have missed it out. No employee will leave his expenses. No, if it was rejected at once, later they will resubmit it. That means at later point of time that entry should have come, but I did not find any entry. It was rejected. Subsequent entry was not there. Might be that might have missed it in the books of accounts. So these are few indicators that indicate that there could be a misstatement with regard to the completeness assertion. What are they? Number one, transactions not identified, source documents not prepared, source documents not captured, rejected documents are not represented. Next, existence, possibility of misstatement regarding existence assertion. What do you mean by existence assertion? Whether assets and liabilities are existing or not, as on the balance sheet date, whether they are existing or not. If I say there is an indicator of possible misstatement regarding existence, what do I mean by that? Sometimes there might be an indication that assets might not be existing. Even without existence only, the assets might have been recorded in the books of accounts. So which factors will give me indication regarding existence? Number one, fictitious or unauthorized transactions on source documents. You are able to find fake invoices, fake bills. The company did not purchase the raw material only. Fake bill was created. On the basis of that fake bill, they will record the inventory. But will that inventory be in existence? No. Why? Because bill itself is fake. Next, source documents overstated. You purchased 1 lakh worth of stock, but entry was written for 10 lakh. On the books, 10 lakhs inventory will be there. But when I go and physically verify, only 1 lakh will be in existence. Next, transactions duplicated on source document. Single document recorded twice. In the assets, in the books, I will find 2 assets, but physically I will find 1 asset. One more asset is not in existence. Capture of source documents duplicated. Once again, same point. One single source document is getting duplicated. Invalid source documents captured on subsidiary ledgers. I am able to find some few source documents even without approval. Even without manager signing, even without manager approval also, entries have been recorded. That means that the transaction might not have even taken place without authorization. So these are all the indicators of possible potential misstatements regarding existence. Then we have recording. Recording in the sense, sometimes there will be an indication that entries might have been wrongly recorded. So when you get that indication, source documents captured incorrectly. Once again, same. 1 lakh entry was recorded as 10 lakh by wrongly entering 0. That is clearly indicating there might be a misstatement in the recording. Processing of transactions is inaccurate. Say for example, today companies use billing softwares. In Tally also you will have a feature where you feed on the basis of HSN code, it will automatically capture the GST rate. Say for example, in the GST software, Tally software has not updated. Recently, you are selling one product which used to have 18% of GST, but it was now changed to 12%. But that update did not happen in the Tally. That means what will happen? Even after the change in the rate also, still invoices will get generated at 18% only. Is it a correct recording or inaccurate recording? Inaccurate recording. That is also one indicator. Inaccurate adjustments in the subsidiary ledgers. Without any approval, you are doing the adjustments. Without approval, you are adjusting discounts and all. So this is also a wrong recording. Next one, cut-off procedures. Cut-off procedures means what? Transactions related to previous or future periods are getting recorded in the current year. So one indication also, they say the same thing. Transactions that occur in one period are recorded in the another period. When you are checking the supporting documents, you found that one expense was related to next year, one expense incurred on 5th of April, but it was wrongly recorded on 31st of April. So there is an indication that there might be a mistake in cut-off assertion. So that's all. There is no concept here, and as I've told, it is not linked with anything, just a standalone question. What are the possible potential misstatement indicators and different assertions? We have seen indicators for completeness, we have seen indicators for existence, we have seen indicators for recording, and we have also seen indicators for cut-off procedures. So that's all. With this risk assessment part is completed. There is an extension of risk assessment part, which we generally call it as risk-based audit. What do we call it? Risk-based audit, we call it. See, traditionally, how audit used to happen is, traditionally businesses are very simple. Trading, manufacturing. Operations also used to be small. Like this, today we don't have this rapid adoption of technology. So one company used to operate in one certain area. So transactions used to be small in number. Regional distribution is also restricted. Business is also not complex. There are no significance on internal controls also. Companies don't used to concentrate on internal controls much. In those cases, how traditionally audit used to happen is, if we got the audit of one entity, we will generally try to allocate time for each area equally. Say for example, if I have 10 days of time, in that 10 days of time, I have to cover assets, liabilities, incomes, expenses. And I have to do reporting also. Traditionally, what auditors used to do is, since the businesses are simple, volume of transactions is very less, there is no importance of internal controls also. Out of this 10 days of time, asset 2 days, liabilities 2 days, income 2 days, expense 2 days, reporting 2 days, over. This is what the traditional audit used to be, where every area deserves equal importance. But do you think, is it still relevant today? Do you think, is it still relevant today? Still, can you go by the traditional methods where you allocate equal amount of time for each and every item of the financial statements? No. That's why today what we are doing. So like even yesterday also I have told, what is the process of audit? We are getting appointed. We perform preliminary engagement activities. Then we first perform what? Risk assessment procedures. So by performing risk assessment procedures, what we do? We identify risk of material misstatement. Depending on that risk of material misstatement, wherever risk is high, there we allocate more amount of time. Wherever risk is low, we will allocate less amount of time. Why? Because today allocating equal amount of time to all areas is quite not practicable, because there is a huge volume of transaction. More importance has been given to internal controls Business complexity has increased. So that's why we should shift from traditional approach to such an approach where our audit is guided on the basis of assessing the risk. How we have to do the audit, where we have to spend the time, where we have to do more procedures, where we have to do less procedures. If our audit is getting guided on the basis of identification of the risk, where we spend first our time on identifying the risk, then we decide where we have to perform which procedures, that we approach only, we call it as risk based audit. Today whatever audits we are doing, those all audits are risk based audits only. We are not blindly allocating equal amount of time for each and every area. First we do risk assessment, we will try to identify the risk, accordingly we will respond to that risk, finally we do the reporting. Understood? Nothing, whatever audit we do, that is only risk based audit. Understood? So there will be three phases broadly in the risk based audit. There will be three phases. First one is risk assessment. First phase is what? Risk assessment. In risk assessment what will happen? Same risk assessment procedures, we identify the risk, where risk is higher, where risk is lower. Then we do something called risk response. What do you mean by risk response? Performance of further audit procedures. On the basis of whatever risk you have identified, you will plan your audit procedures. Wherever risk is high, more audit procedures. Wherever risk is low, less audit procedures. So you will respond to that risk. By responding to that risk, you will get the evidence, you will form an opinion. Last stage is reporting. What is that? Last stage is reporting. Basically, we will report on the basis of our findings, where we express our opinion. So these three are different phases of the risk-based audit. Tell me, what are the three phases of risk-based audit? Risk assessment, risk response, and finally reporting. Okay, so let us see how they have defined it. Risk-based audit is an approach to audit that analyzes audit risk. So first we analyze audit risk. On the basis of the audit risk, we develop materiality. First we will identify the risk, then on that basis we will decide what is material, what is not material. Once again, how to decide materiality, we will see it in the essay 320. But the first step is audit risk, then we set what? Materiality threshold based on audit risk analysis, and finally we develop audit program that allocate larger portion of audit risk to high risk areas. That has been the whole objective. Whatever area risk is very high, we have to allocate more resources to that area. So tell me, what are the three steps? What is the definition of risk based audit? What is an approach? First we will analyze audit risk. On that basis we set the materiality limits. Then we draft the audit program where we allocate large portion of resources to risky areas. Next, audit should be risk based or focused on areas of great risk to achieve objectives. Once again, repeated point, no, we should focus more on high risky areas. It is an essential element of financial audit, both in attest audit of the financial statements and in audit of financial systems and transactions, including evaluation of internal controls. So risk based audit is very important even in financial statements audit. But apart from the financial statements audit, today we are doing various other engagements also. I told assurance. Assurance is a very broader term, no? So one of such assurance engagement is we might be called upon to only verify internal controls. You might be called upon to verify only internal controls. I will teach a standard called SAE 3402. SAE 3402 we will see where auditor will verify internal controls and give a report. So even if we are called upon to do such engagements where we are verifying internal controls, there also we do risk based audit only. Wherever risk is higher, in that area internal controls we will verify more. Wherever risk is lower, in those areas we will verify less resources. So risk based audit is not just for financial statements audit, it is also relevant for internal controls related audit also. It focuses primarily on, risk based audit focuses on what? The identification and assessment of the financial statement misstatement risk, and it will provide a framework to reduce impact on the financial statements of the identified risk to an acceptably low level. Once again, I have told you this objective. Our overall objective is to reduce audit risk to an acceptably low level. This affords an opportunity. This gives an opportunity to the auditee, basically client, to improve its operation from recommendations that impact its operational strategies and performance over long run. Because of doing risk-based audit, not just you as an auditor will be benefited, who also will be benefited? Client also will be benefited. Why? Because we will identify the risk. We will tell to the client, sir, in this organization, in this area, risk is very high. You follow so and so recommendations, you can reduce the risk in the organization. So by doing the risk-based audit, both will be at a mutual advantage. Auditor also will be at advantage because his overall audit risk will reduce to an acceptably low level. Client also will be advantage because he will improve the organization on the basis of recommendations given by auditors. Then audit risk analysis. So whatever risk you have identified, that you have to do the analysis. Let us see how we have to analyze. Number one, auditor should analyze audit risk that impact auditing before undertaking specific audit procedures. Don't directly jump into performing audit procedures. First, you have to analyze the risk. Risk assessment is a subjective process. It changes from person to person. For example, I might feel risk as very high. The other person might not find the same area as risky. So risk assessment is a subjective process. There is no absolute things here. And audit risk, it is a part of professional judgment. On the basis of professional judgment, we do the risk assessment. And audit risk are brought by fraud and error. Risk can happen because of error also. Risk can happen because of fraud also. Differentiating factor between the two, intention behind it. And the auditor must plan and perform the audit to obtain a reasonable assurance, blah, blah, blah. All this we know here. So repeat the things. Whatever we know, the same thing they are saying. Now, phases of risk-based audit. How many phases we have? 3 phases we have. What are they? Risk assessment phase we have, risk response phase we have, and then finally we have reporting phase. Let us see what do they say here. Risk assessment. The risk assessment phase of audit involves the following steps. What and all will be included in the risk assessment phase? Performing client acceptance or continuance procedures. Like I have told yesterday, preliminary engagement activities. Before you accept or continue client relationship, 4 factors we have to consider. What are they? Integrity of the client, competence of the engagement team, evaluation of ethical requirements, significant matters. Yesterday we have seen. This will form part of risk assessment phase. Planning the overall engagement. This also will form part of assessment phase. Then we perform risk assessment procedures to understand business and identify inherent and control risk. Then we verify internal controls to design which are implemented to design which are designed and implemented to prevent, detect or correct the misstatements. Then we will assess the risk of material misstatement in the financial statements. Out of all the risk, we identify significant risk which require special consideration, and whatever material weaknesses are there, that we will communicate to the management. Whatever weaknesses we have found it in the internal controls, that we are required to communicate to those charged with governance and management. How to do that reporting? At the end of the chapter, we'll have one paragraph reporting deficiencies in internal controls to the management. There we will see how to report it, and making an informed assessment of risk of material misstatement at the financial statement level and also at the assertion level. Just previously we have discussed risk of material misstatement is at 2 levels, at the financial statement level and the assertion level. So basically you have to make a complete analysis of the risk at the risk assessment phase. Then we do what? Respond to that risk. How do we respond to that risk? By performing further audit procedures. This phase of an audit is to design and perform further audit procedures that respond to assessed risk of material misstatement and that will provide the necessary evidences. Some matters that auditors should consider when planning audit procedures. When you are planning audit procedures, what matters you have to consider? Number one, assertions that cannot be addressed by substantive procedures alone. For example, highly automated processing of transactions with little or no manual intervention. Sometimes you can't obtain audit evidence only by performing substantive audit procedures. You might be required to go even beyond that verification of accounting records and understand the technology behind it. Like today, if the clients are getting driven completely by automated tools, if they're completely relying on softwares, in such a case, if you verify supporting documents, will that alone be enough? No. What you should do? Today it becomes necessary for us to test the softwares also. Whatever softwares they are using, are they effective or not? Are they functioning properly or not? So sometimes you have to go beyond the substantive audit procedures to get the evidence. Then we need to verify internal controls. If tested, can they reduce the need for substantive procedures? If the controls are effective, we perform less substantive audit procedures. If the controls are not effective, we perform more substantive audit procedures. Potential for substantive analytical procedures. Instead of doing routine test of details, check whether you can perform analytical procedures. What do you mean by analytical procedures? So studying the relationship between financial and non-financial items, that also you can do to respond to that risk. And the need to incorporate an element of unpredictability, surprise checks we call it. To the extent possible, you should keep unpredictability. You should not disclose everything whatever you are going to do. Maintain an element of surprise. The need to perform further audit procedures to address potential for management override of controls or other fraud scenarios. If you came to know management itself is overriding controls, there you have to perform more procedures or less procedures. There you have to become more aware or less aware. More aware you have to become. And need to perform specific procedures to address significant risk. Whatever risk you find it as significant, there you have to perform more procedures. So keeping all these factors in mind, you have to plan your audit procedures. And audit procedures designed to address the assessed risk could include a mixture of operational effectiveness of internal controls, nothing but we call it as compliance procedures, and substantive procedures. This we have already discussed long ago. When I say further audit procedures, it is a combination of compliance procedures, and the substantive audit procedures. So whatever it is, by performing all these procedures, you respond to the risk. Basically, you try to obtain audit evidence whether really that risk has been converted into misstatement or not. Finally, what we do? Reporting we do. The final phase of the audit is to assess the audit evidence obtained and determine whether it is sufficient and appropriate to reduce the risk of material misstatement to an acceptably low level, which is our one of the ultimate objective. It is important at this stage to determine if there has been a change in assessed level of risk. Nothing but, see, like the way we told planning is a continuous process, even risk assessment is also a continuous process. What do you mean by risk assessment is a continuous process? At the beginning of the audit, we perform risk assessment procedures. We come to one conclusion. Okay, this much risk is there. But throughout the audit procedures, we might get extra information, we might get additional evidences, which might make us conclude that risk is actually different here. In that case, what you need to do? If you reassess the risk of material, listen here, this point is very important. If you reassess the risk of material misstatement, initially we start the audit with risk assessment procedures. We have certain clarity regarding the risk. But during the course of the audit, if you find that your risk assessment is wrong, you need to reassess your risk of material misstatement. Initially, you thought risk as low. Now you determine that risk of material misstatement is high. When you reassess the risk of material misstatement, what impact it will have on the audit? What impact it will have on audit? So if you reassess the risk of material misstatement, it will have an impact on your audit strategy, audit plan, audit program. It will have impact on your audit procedures. It will have an impact on your audit evidence, and it will ultimately have an impact on your auditor's opinion also. So we will come across various circumstances in our subsequent discussion. They will say at various places, auditor need to reassess risk of material misstatement. Whenever there is a need for the auditor to reassess the risk of material misstatement, what do they mean by that is, when they reassess the risk of material misstatement, they need to revise their audit strategy plan, they need to re-perform the extra procedures, they need to form a new conclusion. So this is what the impact of reassessing the risk of material misstatement. So that's what they say at the final stage, at the reporting stage, reassess once again. Whatever risk that you have decided at the beginning, is it appropriate or does it need reassessment? Whether conclusions drawn from the work performed are appropriate. Whatever conclusions you have drawn, are they appropriate? If any suspicious circumstances have been encountered while forming the opinion, all these things you have to consider. Any additional risk should be assessed. Further audit procedures performed as required. As I have told, if you reassess the risk as high, perform more audit procedures. When all procedures have been performed and conclusions have been reached, those findings should be reported to management and those charged with governance, and also an audit opinion should be formed. The same should be expressed in the form of a written document. That written document only we call it as auditor's report. Understood? So this is what we have been discussing from the beginning itself, entire process of audit. To that process only, they have given one new name called risk-based audit. Understood? So with this, we have completed the risk assessment part. Done with that. So now we are going to proceed further with the internal control part. So let us try to understand what is this internal control. But before that, let us see whether any questions we can do. Right. So just we will have a look at test your understanding once. Just we will give a glance, then we will solve test your knowledge. So first question. Yeah. CAR is conducting statutory audit of a divisional office of a public sector insurance company on going through delegation of powers laid by the company's head office. It is noticed that surveyors in claims under property insurance policies beyond estimated amounts of 30 lakhs are to be appointed or approved by divisional claims committee. Nothing but insurance companies we have now. In that insurance companies, when the customer suffered some loss, they will raise a claim. So they have one internal control kind of thing in the organization, which says that if the amount of claim is more than 30 lakh rupees, that should be approved by one department called divisional claims committee. Whenever the claim of insurance is more than 30 lakh rupees, that should compulsorily contain approval of this DCC. However, on going through surveyor appointment details of 10 such claims during the year, 5 instances have come to his notice where above delegation of powers have not been followed and appointments were made by divisional manager in place of DCC. But while verification, it was found that there are total 10 claims have taken place, which are more than 30 lakh rupees. But out of that, they are able to find 5 instances. That means in 5 cases, even though the claim amount is more than 30 lakh rupees, it did not get the approval of DCC. It was approved by divisional manager only. So tell me, what risk is this? Which risk they are talking about? Broadly, specifically 3 components: inherent risk, control risk, and detection risk. Which risk they are talking about? Control risk, because they have a delegation, they have internal control in place. Which control is in place? When the amount is more than 30 lakh rupees, you have to, that has to go through DCC. But even after internal controls are there, 5 instances are there where the amount was not approved by DCC, it has been approved by divisional manager. So control is there, but it has been not followed. What risk it is? Control risk it is. In the beginning, the auditor has assessed the risk of material misstatement to be low. Describe why the above finding would change auditor's assessment in assessment in relation to the above. Initially, he thought risk as low, but now he got to know that this control is not followed. Does he need to revise his risk of material misstatement? Yes. Why? Because it is a control risk. Control risk is also going to have an impact on risk of material misstatement. So he needs to reassess the risk. So that's what they say here. Evaluation of internal control influence auditor's assessment of risk of material misstatement. Risk of material misstatement also consists of control risk. In the given situation of statutory audit of divisional office of a public sector insurance company, it is noticed that procedure relating to delegation of power has not been followed. And surveyor is noticed that surveyor appointments have been made in violation of laid down procedures. It is a serious violation and shows that controls are not operating effectively. Such deviations from established controls may lead the auditor to conclude that control risk needs to be revised. Revision of control risk assessment is likely to lead to revision of risk of material misstatement. If you are revising control risk, that will automatically have an impact on risk of material misstatement. And when you are revising your risk of material misstatement, it will have an impact on even your nature, timing, and extent of your audit procedures. I told you, whenever you are reassessing the risk, you need to change your audit strategy, plan, and program. You need to make changes to your nature, timing, and extent of the audit procedures. Next. Right, let us see this. You have recently been appointed as auditor of NGO working in the field of upholding democracy for the first time. The last year accounts of NGO were unaudited. Last year financial statements are audited. First red flag. Since the last year financial statements are unaudited, the risk is high or risk is low? Risk is high. And its activities were limited at a small scale. However, it is only in the current year that NGO has received substantial donation, including foreign funds. One more red flag. Why red flag? As I have told previously also somewhere, whenever NGOs in India today, majority of the NGOs are getting used as a vehicles for hawala transactions and money laundering transactions. So one more red flag here. The said NGO is also crowdfunding its donations. They are getting the donations from a larger number of people. Crowdfunding also they are doing. One more red flag. There could be a possibility of hiding of the donations from the books of accounts. Next, the government has now legislative power to cancel FCRA certification of NGO. Strict laws and regulations. If they change any laws and regulations, that could also have an impact on the functioning of this NGO. Since it is working in a field which encompasses political and social field, if you are working in a tight political and social field, that itself is a bigger risk there. Because if the political party changes, your operations will be affected. And counter accusations are flying thick and fast. So many people are accusing. What factors you may consider for assessing the audit risk? Whatever I have highlighted as red flags, all these things will be considered while making the risk assessment. That's what even you will be able to find it in the answer also. Next. RK Living Limited is engaged in manufacturing and processing of textile fabrics. It purchases its raw material from a company based in Silvassa, taxable at the rate of 12%. It takes about 3 to 4 days for a row for raw material to reach the company's plant. Just let me wait here. Okay, this is regarding internal control. Let us keep it aside. So this is regarding the internal control. This is also internal control. This is also internal control. One is materiality related question, two internal control, three not that we have discussed, four not that we have discussed. Okay, so all are related to internal controls only. Now risk based audit is there. Here we have something. See here. ST Limited is a growing company and currently engaged in the business of manufacturing of tiles. The company is planning to expand and diversify its operations. The management has increased the focus on the internal controls to ensure better governance. The management had a discussion with the statutory auditors to ensure the steps required to be taken so that statutory audit is risk based and focused on areas of greater risk to the achievement of the company's objective. Please advise the management and the auditor on the steps that should be taken for the same. So what are the risk based audit? In that, what steps you have to take? Nothing but, as I've told, risk assessment, risk response reporting. Along with that, what is the definition of the risk based audit? That if you write, that will be enough. Okay, next. This we have already covered, steps for risk identification. Materiality. Okay, so remaining things we can do it later. So this is also same question regarding risk-based audit, something we have seen. Just name of the company has been changed and they're asking you to write the steps of risk assessment, risk-based audit, sorry, that you can, same question, you can handle it. All right, that's it. So remaining questions are all related to internal controls. So let us try to have a look at that internal control related concept. Fine. So is it the first time we are hearing the term internal controls? No, we already are very much aware of this internal control system. So tell me in a simple terms, what did I say? What is the meaning of internal control? Internal control refer to any policy or procedure which is designed, implemented and maintained by the management to prevent something from going wrong in the organization. This is what a simple meaning I have told. Now let us try to understand the technical definition. Let us try to understand technical definition of the term internal control. So how they have defined the term internal control is any process, or you can say any procedure, which is designed, implemented and maintained. What is it? Designed, implemented and maintained. Designed means what? Deciding. See, for example, to prevent this procedure must be placed. That designing. Implementation. Once you have designed, that should be put into action. That is implementation. Maintenance means what? Once you have put into action, periodically you have to review it. If at all required, you have to make the changes. That is what maintenance. So any process which is designed, implemented, maintained by what they say here is by the management or by those charged with governance or by other personnel also, they say here. What do they say? Other personnel. So any process which is designed, implemented, maintained by the management or those charged with governance or other personnel. So management, we know generally the board of directors and all these people will come under management. Those charged with governance, those people higher level, top level of management. Now who is other personnel here? Who is the other personnel whom they are referring to? So that could be employees. Yes, you could say employees. See, management will design internal controls, but who will do the actual implementation? Employees will do it. Sometimes management might not be in a position to design the controls only. Then they take the help of the external consultants. So whatever it is, any process which is designed, implemented and maintained by the management, those charged with governance or other personnel. For what purpose? Technically, they say that to achieve the objectives. To achieve what? To achieve some objectives. So what specific objectives this process is expected to achieve? So they say internal control is a process designed, implemented and maintained by management, those charged with governance or other personnel to achieve certain objectives. Which objectives? They say specifically 4 objectives. How many objectives they say? 4 objectives. Number 1 is reliability of financial reporting. What is the first objective? Reliability of financial reporting. Number 2, safeguarding of assets. What is the second objective? safeguarding of assets. Number 3, efficiency and effectiveness of operations. Efficiency and effectiveness of operations or business also you can say. And then some objective to ensure the compliance with laws and regulations. So tell me, what are the 4 specific objectives which any internal control will try to achieve? Number 1, reliability of financial reporting. Number 2, safeguarding of the assets. Number 3, efficiency and effectiveness of the operations. And number 4, compliance with the laws and regulations. Any internal control you take in the organization that will try to fulfill at least one of the 4 objectives. Pay attention. So any internal control you take in the organization that will try to fulfill at least one of the 4 objectives. That means some internal controls can fulfill more than one objective also. Some internal controls can fulfill more than one objective. Some internal controls can fulfill simultaneously all the 4 objectives also, we can't say. But any internal control that will try to fulfill at least one of the 4 objectives. So let us try to understand some examples. What are those controls which will fulfill each of the objective? Say for example, safeguarding of the assets. Any internal control you take, majorly many internal controls will try to safeguard the assets, will try to protect the assets. Say for example, very common examples, whatever I was saying, having a CCTV camera. Why the CCTV camera has been implemented? To safeguard the asset, to safeguard the inventory, to safeguard the fixed assets. Appointment of the security guards. Why it has been implemented? To safeguard the assets once again, to safeguard the assets of the company. So having the access, if you say in IT company or big companies, they will allow only authorized person to enter inside the company. If you have to enter inside the company, you have to give your biometric access, you have to give your fingerprint, you have to give your retinal scan. In big organizations, even retinal scans also will be there. That is also an internal control. What is the objective of that internal control? To safeguard the assets, to prevent unauthorized person from entering inside the company. If unauthorized person enters inside the company, what will happen? There is a loss of theft of assets. To protect that assets, what they have kept? They have kept that biometric access. So these are examples of internal controls which will protect the which will work with the objective of safeguarding the assets. Then there will be some internal controls which will work with the objective of increasing the reliability of financial reporting. Sir, what are the examples? Say for example, they have appointed one qualified person. Organization has appointed one qualified chartered accountant for the purpose of preparation and presentation of financial statements. That is also an internal control. Why they have appointed a qualified chartered accountant? So that their financial statements will be prepared as per applicable financial reporting framework, then they become more reliable. Or you can say bank reconciliation statement, preparation of BRS, that is also internal control. See, this internal control will fulfill 2 objectives. Bank reconciliation statement. Number 1, it will make sure that bank balances in the financial statements is correct. That means it will increase the reliability of financial reporting. It will also make sure that nowhere there is a leakage of amount in the bank. That means it is safeguarding the assets also. So like as I have told, some internal controls will fulfill more than one objective. So this is one such example. BRS, it will achieve the objective of increasing the reliability of financial reporting. It will also achieve the objective of safeguarding of the assets. Next. Some internal controls will achieve the objective of increasing the efficiency and effectiveness of the operations. Like for example, many a times, sometimes, especially when you are dealing with the SBI bank, there will be server maintenance. Sometimes transactions will not happen. They will tell you well in advance. So and so time the server will undergo maintenance. That server maintenance is also internal control. Why? Because SBI databases servers will be handling large volume of transactions on everyday basis. Lakhs of transactions will get processed. So periodically, once in 15 days, once in a month, they will have that maintenance. In that maintenance activity, what they will do is they will take the backup. They will see whether something is going wrong or not. So that's why they will have that server maintenance. That is also internal control only. Why that internal control? Because if you don't do that maintenance, what will happen? All of a sudden, if the server crashes, my operations of the SBI will come to halt. That means that is going to affect the efficiency and effectiveness of operations of the SBI. So that server maintenance is one example of internal control. One more example of internal control. See, if you are working in audit companies, even if you are working in the audit firms, your firms will have access to internet, right? Your firms will have access to internet. So you will also be given access to your systems also, internet. So say for example, if there is no restriction on the usage of the internet, what will happen? You come to the office, you open your system, instead of working, you will open your social media platforms and other platforms, you will kill your time. That's why your employers will have one control, firewall they will have. They will introduce that firewall or something, which will restrict the access to the internet. Apart from the GST website, apart from the income tax website, apart from accessing your company mails and all, you will not be permitted to access the other sites. So this they will do it by implementing a firewall. That implementation of firewall is also internal control only. A process which is designed, implemented, maintained by management, those charged with governance. With what objective, sir? To make you more efficient, to make you more effective. If there is no restriction, you will waste your time. The work will get affected. To avoid the work from getting affected, they have restricted your access to internal control, access to internet. This is also internal control with the objective of ensuring efficiency and effectiveness of operations. Now, some companies will have internal control to ensure compliance with the laws and regulations. Like say, for example, IT company, if you take, see in IT company, there will be so much of public disclosure related acts will be there. Information has to be kept highly confidential since IT company deal with a lot of client data. If there is any breach of data confidentiality in IT company, they have to face a huge consequences. So that's why what these IT companies will do is they will have a internal legal team will be there. In-house legal team will be there. This in-house legal team will monitor, or they will have this data protection team inside the company. They will make sure that the entire systems are getting covered under antivirus systems. There is no attacks happening. They will always try to monitor that. So appointment of that team is also internal control. But what that team is achieving, which objective they are achieving, they are ensuring the compliance with the laws and regulations. So like that, in an organization, you will find plenty of internal controls, and every internal control will try to achieve at least one of these four objectives. What is that four objectives? Reliability of financial reporting, safeguarding of the assets, efficiency and effectiveness of operations, and even compliance with the laws and regulations. So that's what you will be able to find it here. So meaning SA 315 defines the system of internal control as what? A process which is designed, implemented, and even maintained by whom? By the management, those charged with governance, or other personnel. In the other personnel, will the auditor come here? Auditor will not come in the other personnel. Auditor will nowhere be involved in the design, implementation, maintenance of internal control. Auditor will only review it. So when I say other personnel, who will come here? Employees will come here, external consultants will come here, internal auditors might come here, but external auditor will not come in the definition of other personnel. Nowhere he will be involved. He should be involved in the design, implementation, and maintenance of the internal control. He should not get involved. Next, for what purpose? To provide reasonable assurance about achievement of some objectives. Which objectives? Reliability of financial reporting, efficiency and effectiveness of operations, safeguarding of assets, compliance with the laws and regulations. Now, who is responsible for internal control in the organization? Who is having the responsibility? Management is purely responsible for designing and implementation of internal controls. Auditor is responsible for verifying only. But do you think will he verify all the controls? Only those controls which are relevant to financial reporting, those controls only he will verify. Auditor will not be required to verify each and every internal control also. But primary responsibility for designing, implementation, and the maintenance of internal controls is always and always going to lie with whom? Management. Now, when I say internal control, as I have told, will internal control operate only in the accounting department? No. So there will be administrative controls also. There will be compliance related controls also. Like as I have told, some controls will work with the efficiency and effectiveness of operations. Some internal controls will work for compliance with laws and regulations. So an organization will have multiple controls. It will not just restricted to accounting related controls. They will also have administrative controls. Like if I have to give you one example, companies will have an internal control that whatever product they are manufacturing, that should comply with ISO 9001 certification. So you often see on the products labels ISO 9001 certified product. So that is also an internal control. Inside the company, there will be a department which will make sure that their product is complying with that ISO 9001 certification. That is also an internal control. But is that accounting control? No, that is not an accounting control. That is an administrative control. So the scope of internal control extend beyond accounting controls. It includes controls in other aspects also. But as an auditor, we are mainly concerned with what? Accounting controls. We are mainly concerned with accounting controls. We have nothing to do with the administrative controls or other controls. So that is what they say here. Scope of internal control. The scope of internal control goes beyond accounting control. It also includes what? administrative controls relating to decision making, such as authorization of transaction, production methods, like I have told, ISO 9001 certification, pricing policies, quality control, work standards, budgetary control. These administrative controls also will come into picture. Next, in an independent financial audit, when you are doing a financial audit, the auditor is concerned with only those policies and procedures which are bearing assertions underlying the financial statements. If I put it in simple words, if you are doing this audit of the financial statements, you will be worried about only those internal controls which are going to have an impact on financial statements. Mainly controls relating to safeguarding of the assets, those controls which are related to prevention and detection of frauds, those controls which are related to accuracy and completeness of accounting records, and those controls which are relating to timely preparation of reliable financial information. So whatever internal controls are there which are related to these matters, regarding this only financial statement auditor will be concerned. So tell me, which controls the financial statements auditor should be worried about? Those which are related to safeguarding of the assets, those which are relating to prevention and detection of the frauds and errors, those which are related to accuracy and completeness of the accounting records, and those which are related to timely preparation of the reliable financial information. Then administrative controls have remote relationship with financial records. As I've told, these admin controls and all, they have very remote relationship with the financial records, and auditor may evaluate those administrative controls which have a bearing on reliability of financial records, which means generally we will ignore administrative controls. But if some administrative control somehow it is having a linkage with the financial records, then only we will verify. If some admin control do not have any relationship with the financial records, we will not verify it at all. We will not consider it at all. Next, objectives of internal control related to accounting system. As I have told, as an auditor, we are mainly concerned with those internal controls which are related to accounting. No. So what characteristics should be there for accounting controls? What objectives accounting controls should fulfill? What objectives accounting generally, if there are some controls in the accounting department, what features you expect from that controls? They should make sure that transactions have been authorized, they have been recorded properly in the correct accounts, they should be recorded under correct headings, yes or no? So they should be measured properly. They should be supporting documents. Generally, this is what we expect from accounting controls. So whatever internal controls which exist in the accounting department, we have some expectations from that accounting controls. So what expectations we have from accounting controls? That's what this paragraph says. The objectives are determined by the management after considering nature of business, scale of operations, professionalism of the management. Generally, the objectives of internal controls relating to accounting system are whatever controls which are working in the accounting system, what objectives they should have. Transactions are executed through authorization. Either there should be general authorization or there should be specific authorization. Like generally companies will have a policy, their sale agents. Company is having a general policy that a sale agent can give a discount of 5% without any specific approval. When they are dealing with the customers, every sale agent has been given general permission to give 5% of discount. If some sale agent has to give a discount of more than 5% to the customer, he needs an approval of the concerned manager. So first case is general authorization. Second case is specific authorization. Whatever it is, there should be some authorization, some approval for every transaction. Next, all transactions should be promptly recorded. So these accounting controls should make sure that transactions are getting promptly recorded in an appropriate manner to permit preparation of financial information and to maintain accountability of assets. Assets should be properly accounted for. And these accounting controls should make sure that assets and records are safeguarded from unauthorized access, use or disposition. Like for example, to the accounting software, they will keep the username and password. No other person apart from the financial department should have access to the financial data. Especially HR people should not have access to the financial data. Which person is paid, how much amount of salary. This information should not fall in the other hands. This information should remain only with the finance department. And also assets are verified at reasonable intervals. What do we call it? Physical verification we call it. So generally those controls which are working in the accounting system, it is expected to fulfill at least these 4 objectives. What are they? There should be authorization, either general or specific. It should make sure that there is a prompt recording of the transactions. Assets should be safeguarded from unauthorized access. And then finally they should be verified at reasonable intervals. Exam question. Repeat carefully. Come on, once again. So what are the objectives which controls in accounting system are expected to fulfill? Number 1, authorization, either general or specific. Transactions are promptly recorded. assets and records are safeguarded from unauthorized access, and then finally they are verified at the reasonable intervals. These minimum 4 things are expected from the accounting controls. Clear? Now, see, if you remember here, we missed on one important phrase. When we are reading the definition of the internal controls, they have told that internal controls refers to those processes designed, implemented, and maintained by those charged with governance, management, and other personnel to provide reasonable assurance. What they are telling? Internal controls will give you only reasonable assurance. That means if you have internal controls in place, we have 4 objectives: safeguarding of the assets, reliability of the financial reporting, efficiency and effectiveness of the operations, and compliance with the laws and regulations. See, if we implement internal controls, we have a confidence that these objectives will be met. If I implement internal controls, I will have a confidence that assets are safeguarded, financial statements are reliable, and also operations are efficient and efficient, and entity has complied with the laws and regulations. Generally, we get that confidence. But the definition says that by implementing internal controls, you get only reasonable assurance. You get only high level of assurance. They will give you high level of assurance, but they will not give you absolute assurance. What do you mean by not giving absolute assurance? If I put it in simple terms, if you implement internal controls, there is no guarantee that objectives will be achieved. You can get assurance. You will get high level of assurance that yes, if I implement internal controls, my objectives will be met. But however, by implementing internal controls, you will not get a guarantee that all these objectives are met. That means even after you have implemented internal controls, still some assets might not be safeguarded. After you have implemented internal controls, still there is a possibility that financial statements might not be reliable. After you have implemented internal controls, there is always a possibility that operations might not be efficient, and even after implementing internal controls, there is always a possibility that entity might not have complied with laws and regulations. That guarantee we are not going to get it. Why we are not going to get that guarantee? Like for audit also we have told, audit will give you only reasonable assurance. Audit will not give absolute assurance. Why? What did we say? Why auditor cannot obtain absolute assurance? Why? Because the process of auditing is suffering from some limitations which are unavoidable in nature. Which are what in nature? Which are unavoidable in nature. We call that limitations as what? Inherent limitations. Since the process of auditing is suffering from some inherent limitations, audit cannot obtain absolute assurance. The same logic is here for internal controls also. Since internal controls are also suffering from some limitations, which are of what nature? Unavoidable nature. Internal controls are also suffering from some limitations which cannot be avoided. No matter whatever you do, that limitations will always be there. So since the process of audit is suffering from since the process of internal controls is suffering from some inherent limitations, internal controls will only give you reasonable assurance but not absolute assurance. Why, sir? What are that limitations? Number one, implementing internal controls is not an easy task. It is a costly affair. It is a what? Costly affair. So which means if you want to implement internal controls, you have to invest in the systems. You have to invest in the persons. You have to invest in resources. Like for example, let us take one simple example of implementing internal control of security guards. There is one small chain retail store is there. There are no security guards and all. So because there are no security guards, theft is happening. That management has decided to implement internal controls. So they have thought, okay, let us appoint 2 security guards, because a person cannot be expected to work for 24 hours. Minimum 2 shifts are required. So this small scale retail store, what they have done is they have started implementing internal control. 2 security guards they will appoint. So minimum 15,000 you have to pay the salary. So 30,000 per month salary for the security guards. For 12 months, the cost of implementing a simple internal control of security guards will cost 3,60,000 rupees per year for the company. So after the completion of 1 year, I started analyzing. Last year, there are no security guards. I avoided this 3,60,000 rupees of cost, but because of that, theft has taken place. But last year, theft has taken place only for 1,50,000 rupees. But to protect that theft of 1,50,000 rupees, I have to incur a cost of 3,60,000. Basic cost benefit analysis anybody will do, no? Now what these people will start doing is, why this unnecessary cost? I will appoint only 1 security guard. 1 shift only I will keep the security guard. So now you tell me, if you run the security, if you run that store with 1 security guard, will the control work effectively? Definitely not. So that is what the first case, cost exceeding benefits. So implementing internal controls is not a simple affair. It is a very costly affair. So because of that, some entities will design internal controls, but they will not effectively implement it. Number two, cannot handle transactions of unusual nature. Cannot handle transactions of unusual nature. Generally, we decide internal controls for routine transactions. We will implement internal controls for those transactions which are routine in nature. Say, for example, one company is there, which is a manufacturing company. Till now, it was purchasing all the raw materials locally. Since it is purchasing all the raw materials locally, they have designed internal control to tackle that purchase transaction. But all of a sudden, they are required to import one lot. They have to buy the thing from foreign country. So this is an unusual transaction. Till now, company did not do import. For the first time, company is purchasing from abroad. Now, since the internal control was not designed for that, when it comes to foreign currency exchange and translations, there might be a misstatement. They might have got converted at a lower rate or higher rate, whatever it is, misstatement could happen. Why? Because we have designed internal control only for usual transactions. Sometimes unusual transactions will happen. When we say a transaction is unusual, when we are not expecting it. When we don't expect something, how can we design internal control for that? So that's why sometimes unusual transactions could happen, which cannot be handled by this internal controls. Next, collusion among individuals. Third factor is what? Collusion among individuals. So generally, one of the important aspect in the internal control is segregation of duties. We'll see it at a later point of time. The most important characteristic, the most important element of the internal control is segregation of duties. The duties should be segregated among different people. So say for example, inventory handling. Earlier, what company used to do is one person used to handle the inventory, the same person used to maintain the records. So what that person has done is that person has absconded. Previously, he created theft of some stock and he absconded with 1 lakh rupees of money, 1 lakh rupees worth of stock. Now management realized the importance of internal control. Now what they have done is they have appointed one more person. One person will handle inventory, one person will maintain the inventory records. Segregation of duties they have done. Now, after some period of time, these two people have colluded with each other. They went for a tea break and both have discussed, a last time one person used to do entire activity. He committed 1 lakh rupees of theft. Now we are two people. No, you 1 lakh, I 1 lakh. Let us commit 2 lakh rupees of theft. So there is chance of collusion will always be there. No matter how much effectively you implement internal control, the people who are involved in the internal control chain, they might collude with each other and they may make the internal control fail altogether. The same thing with Punjab National Bank, 11,400 crores worth of fraud. Don't you think internal controls are there in the bank? Especially nationalized bank. Don't you think internal controls are there? Definitely there. When you visit the nationalized bank, you will realize how much that internal controls will make your life a hell. For doing everything, we have to write it on a piece of paper. We have to go to 3-4 people, get the transaction processed. Nothing will get easy approval. So many internal controls are there. Even after having that many internal controls, that too in the nationalized bank, but still this person like Nirav Modi was able to successfully work out 11,400 crores worth of scam. How he was able to do it? Collusion. So in that PNB scam, the people at different levels have colluded with each other. One outsider, third party, Nirav Modi, who is a customer. One top level management, middle level manager, low level manager, and even a peon, a clerk at the bank. So people at different level have colluded with each other and they are able to successfully carry out 11,400 crores worth of scam. So collusion is something which can't be avoided no matter whatever we do. So that is one more reason, one more inherent limitation. Misuse of authority. See, who will implement internal controls? Management, top level management, right? Sometimes those people who created internal controls, they themselves will override the internal control. Say for example, purchase head is there. This purchase head has designed internal control. What internal control is? If the company has to purchase a raw material, it should call for quotations, tenders, kind of thing. So once they have received all the quotations, they have to analyze the quality, quantity at the best price. They have to give a contract to that vendor. But what the same purchase department head has done is, his friend is running that business. Whatever product they want. Say for example, one company needs a steel. They want to purchase it. Now what is a regular internal control? They should call for tenders, they should call for quotations, finalize on the price and quantity, and then they have to give the order for them. But what this purchase head has done is, his friend is also in a business of steel. Now even though his friend has given the higher price for the same quality, still the purchase department head has given the order to him. Is it a violation of internal controls or not? Why this has happened? Because the person who is having a power, he has misused his power for his own personal advantages. This also could happen, which can make the internal control fail. And then finally, manipulation of assumptions and judgments. Especially this will be done by the management, finance team. We only will do it. The company might be under a pressure to report more profits. Now, what this finance department, what this management will do, they will do under provisioning. They will do under provisioning. They might be required to create a provision for bad and doubtful debts. They do under provisioning, or they do overvaluation of the stock. So this also can lead to a internal control failure. So these are the 5 inherent limitations of internal control. Tell me, what are the 5 inherent limitations of internal control? Number 1, cost exceeding the benefits. Number 2, it cannot handle transactions of unusual nature. Collusion among the individuals could happen. Authority misuse. Manipulations of assumptions and judgments. Clear, everybody? Right. So this is what regarding limitations of internal controls. Now we will do 6.8, which is structure of internal control, or what kind of policies and procedures to be covered in the internal control. If you want to implement an internal control in the organization, what policies it should have, what characteristics it should have. Very simple. Number 1, segregation of duties should be there. What do you mean by segregation of duties? One person should not handle the entire transaction. Work should be divided among so many people so that no one person will have a control over it. Number 2, you should follow a authorization mechanism. What do you mean by authorization mechanism? Approval mechanism. No activity should happen in the organization with one person. One person should do it, another person should approve it. Without approval, either general approval or specific approval, without approval, transaction should not happen. There should be proper approval mechanism, authorization mechanism. Third one, adequacy of records and documents. Whatever transaction that is getting done, regarding the transaction, documents should be maintained, records should be maintained. Like if you are doing a purchase transaction, in the purchase transaction, many documents will be involved. So first there will be a purchase order. Then there will be purchase invoice, goods receipt note will be there, inspection report will be there, accounting entry should be there. So all these documents, whatever associated documents with the transaction are there, all that records should be kept safe, all the documents should be kept safe. Number 4, accountability and safeguarding of assets. Whatever internal controls are there, that must ensure that assets are safeguarded, assets are protected. And finally, independent checks should happen. That means having internal controls alone will not be enough. Periodical checks should happen, like physical verification, you can say, or internal audit mechanism should be there to make sure that controls are working effectively or not. So for any internal control to work effectively, it should have these 5 characteristics. What are the 5 characteristics? Safeguarding of assets, authorization of transactions, adequacy of records and documents, accountability and safeguarding of the assets, and finally independent checks. So even if we start reading also the same points, whatever we are aware, the same thing will be there. Like if you see here, transaction processing shall be allocated among different persons so that no one person completes the transaction alone, or that each person's work is complementary, each person's work is supporting to the another person's work. The purpose is to minimize occurrence of frauds and errors. If you do the segregation of duties, what will happen? It will reduce the occurrence of the frauds and errors. If at all they have happened, you can detect it on a timely basis. There will not be time gap if you segregate the duties. What functions are required to be segregated? So authorization, execution, physical custody, maintenance of records. 4 duties should never remain in the hands of one person. That 4 duties should be divided among 4 different people. What are that 4 functions which should be segregated? Authorization, execution, physical custody, maintenance of records and documents. Like if you say, for example, purchase manager will authorize a transaction. Purchase in charge will execute the transaction. He will place the order and he will get it. Warehouse in charge will take the custody of the goods. He will receive the goods, keep it in the warehouse. Accountant will record the entry. Accountant will record entry, maintenance of records. If you see here, authorization, purchase manager is approving it. Execution, purchase in charge is buying that goods, execution. And physical custody, warehouse manager will receive the goods and keep the goods in his custody. Maintenance of records, accountant will pass an entry. So these 4 functions must be segregated. Repeat, everybody. What are the 4 functions which are required to be segregated? Authorization of transactions, execution of transactions, physical custody of the assets, and maintenance of records and documents. Now they might ask a MCQ from this. How they might ask a MCQ from this is, they will say which of the following activities should be segregated. In one option, all these 4 elements as it is will be there. In remaining 3 options, what they will do, they will replace one element with something else. Like they will say authorization, execution, physical custody, accountability, they will say. That is not there. So 4 elements. Authorization, execution, physical custody, maintenance. So you have to look for that option which contains all the 4 elements. Next, While allocating duties, cost and efficacy must be considered to avoid over allocating tasks, which can lead to cumbersome procedures, excessive record keeping, high administrative cost. See, you have to do segregation of duties. You should not do over segregation of duties also. For a transaction, 10 people are not required. You can do it in the 4 people also. So to the reasonable level of segregation you have to do. If you do more segregation, if you involve too many people in the process, what will happen? Number one, cost will be high. Number two, procedure will become very complicated. Procedure will become very much time taking also. So you should avoid it. Reasonable level of segregation, you do it. Number two, apart from segregation of duties, periodic rotation of duties of the personnel is also desirable. This is very common if you see the bank employees. So if you are if any of your family member is a bank employee, you often find them for every 2 years they will change their branch. That is also one internal control. They don't keep the employee in the same position for a longer period. Why? Because the longer you are in the job, the better control you get it. The more control you get it, the more chance you have for committing the fraud. So that's why in the banks you find the rotation of the duties at very regular intervals. Even in the finance departments of the listed companies also it is quite common. Finance departments of the listed companies also it is quite common. For example, they will segregate the finance department in the Infosys company. Let me give you one example of the Infosys company. In the Infosys company, finance department is segregated into multiple wings. There will be a separate team for business strategy, business negotiation, finance related terms. There will be accounts receivable team, accounts payable team, taxation team, general ledger team, finalization team. So if you start your job in the business finance team, within 2 years, you have to compulsorily go on rotation. You have to go to some other department. You have to go to GL team. So within 2 years, from there, you have to move to other department. So generally, we are resistant to change. As human beings, we are resistant to change. No, we don't want to change our position. Why? Because we become comfortable in a position when you have worked 2 years. You will get to know ins and outs. You become better at managing. Now, within 2 years, company will come to you and say, boss, you have to shift to another department. Now we will become resistant to change. We don't want to change. Why? Because if you shift to a new department, new people, new things, you have to learn. But management play a very tactics there. Some 2 months well in advance, they will start the planning. Somehow they will make the word reach you that in so and so department something is going wrong. Nothing will be going wrong there. So in listed companies and all, they have set SOPs. Everything will happen according to SOP. But somehow they will bring a word to you. They will create rumor or something. They will plant something in your mind. They will try to say that, for example, they want you to change to GL team. They will say in the GL team someone is leaving, something is going wrong. Somehow 2 months before only they will bring the information to you. Now these 2 months they will do unnecessary praising to you. Hey, you are very good, your performance appraisal. If required, they will give in between some hike and promotion also. Now, finally, the word will come to you. Now, how also they will put it, that concerned department's head will come to you and he will say, you have done excellent job in your particular section. Sometimes you will also get surprised regarding whom he is talking about. Okay, so he will give all the unnecessary boost up. He will do all the unnecessary praises. Then he will say, in that concerned department, some issue is there. Only you can handle it. Only you can handle it. Your expertise will be required. Now you melt down and shift your position to the other department. But in fact, ground reality is nothing like that is happening. Just they want to make sure that management is following their SOPs. That is their script to make them comply with their SOPs. Okay, so like this, rotation of duties is also one of the important internal control. Next one, rotation of duties helps ensure that fraud and errors do not remain undetected for long and prevent individuals from developing vested interest. Same point. If you stay in a longer position, you get more interest in that, you get better control of it. Rotation also ensures employees keep their work up to date and remain careful, knowing their task will be reviewed by others. And also it will instill a fear that if you stay in the same department for a shorter period of time, at some point of time, your work will be taken by another person and he will tell all the shit about you that you have done in your work. Next, authorization of transaction. Second important element of internal control, authorization of transaction. So delegation of authority to different levels and to particular persons must be established by management to control transaction execution as per set conditions. Like generally in the management, they set different levels of authority. Up to 10,000, cashier can approve. 10,000 to 1 lakh, finance manager can approve. More than 1 lakh, finance director has to approve. More than 10 lakhs, CFO has to approve. So like that, delegation should be there. Authorization can be either general or it might be specific. I already told you that customer agent related example. It is necessary to establish procedures which provide assurance that authorizations are issued by persons acting within the scope of their authority and the transaction conforms to the terms of authorization. So there will be a document, like I have told, limit related approvals will be there. We should make sure that only that person is giving approval. Sometimes people will also pay cheap tricks here. Say for example, if the transaction is more than 10,000, it needs approval of the finance manager. Now cashier has to make one payment. The amount is 15,000 rupees. Now what he will do, no, instead of making one payment, he will split the check into two, 7,500, 7,500, so that it will not go to the next higher level. So that's why you have to make sure that is that splitting up is a genuine, or to avoid the next higher level of authority, he has done that. Next, the objective can be achieved by making independent comparison of transaction documents with a general or specific authorization, nothing but checking of the supporting documents. Next, third element of the internal control, which is adequacy of records and documents. Proper records and documents are required to be maintained. So accounting controls should ensure that transactions are executed in accordance with management's general or specific authorization. For every transaction, there should be authorization. Transaction and other events are promptly recorded. Something sounding familiar? We have seen the same things, no? Accounting controls. What should be the objective of accounting controls? More or less the same points will get repeated here. Next, transactions shall be classified in appropriate accounts and in appropriate period. Transactions should be recorded in a manner so as to facilitate timely preparation of financial statements, that too as per applicable accounting standards. A recording of transactions should facilitate maintaining accountability for assets. You have to maintain records in such a manner that there is an accountability for assets. Assets and records are required to be protected from unauthorized access, use, or disposition. Records of such record of assets such as sufficient description of the assets, its location should also be maintained so that assets could be physically verified. It's the same point we have seen even in the CARO also, which will show quantitative details and situation. So this point, this paragraph and this paragraph, both are more or less the same. Which one is here? This one. What are the objectives of internal controls relating to accounting system? Here they have told 4 points, and when it comes to adequacy of records and documents, they have extended this list only. That 4 points, along with that some 2-3 points they have added, like this point, C point, they have added transaction should be classified in appropriate accounts and appropriate period. D point is also in addition, transaction should be recorded in a manner so as to facilitate preparation of financial statements in accordance with applicable AS. Accountability is there, protected from unauthorized use is there. This is also they have added. Why I am telling you this comparison is you will find some interchangeable answers for some questions. They will say what are the objectives of accounting controls, but you will find 7 points written here than the 4 points we have read in that paragraph. So why? Because both are more or less conveying to the same thing. So what I will say is, remember these 7 points only directly. Remember the 7 points only directly. Even if they ask you what are the objectives of accounting control, or even if they ask you what is the element regarding adequacy of records and documents, you write the same 7 points here. Next, accountability and safeguarding of the assets. One more important element which should be there in your internal control, that is there should be accountability, there should be responsibility and safeguarding of the assets. What is that? The process of accountability of assets commences from acquisition, its use and final disposal at all the stages of the asset. At the time of buying it, there should be safe protection. While you are using it, it should be protected from unauthorized usage. While you are making final disposal, then also there should be protection for that asset. Safeguarding of assets require appropriate records, their periodical reconciliation. Nothing but physical verification you have to do. Reconciliation you have to do. Assets like cash, inventory, investment, scripts require frequent physical verification. Frequency of reconciliation would differ for different assets depending upon their nature of the amount, depending on materiality. If the cash is very less, generally today nowadays companies are maintaining very less amount of cash. There you need not do multiple times of physical verification. But inventory, a company is inventory oriented, retail company it is, so much of inventory is there. There you can do more frequent physical verifications. Assets which are considered sensitive or susceptible to error needs reconciliation more frequently. Whatever assets are susceptible to errors, there you do more verification. To ensure proper safeguarding of assets, only authorized personnel should have access, both physical access and control over document relating to authorization, use, disposal asset. Here they are talking to that security guards, CCTV cameras, all that assets. It is essential to have effective controls over physical custody of cash, inventories, investments and other fixed assets. Like here also once again physical controls, security guards and CCTV cameras. In some cases, special procedure regarding physical custody of assets have to be designed by the management, especially server rooms and all. Wherever server rooms are kept in the organization, generally when we see biometric, only fingerprint will be there. But in that server rooms and all, they will ask you to give your biometric along with that retinal scan. So according to the studies, the highest security in biometric can be achieved with the retinal scan. Fingerprint, somehow you can do that. In movies generally they show, no, they do some wax thing and all they will do. But if you have to manipulate the retinal scan, you have to take his eye out, which is quite not possible. So in some areas, some special procedures regarding physical custody will be required. And the last element of the internal control is independent checks, independent verification of control system involving periodical review by independent persons, generally internal auditors, to assess whether management designed control procedures are operating effectively. Such process may be carried out by specifically assigned staff under the banner or external audit. Even external auditor can do it, or internal team also can do that independent checks. So these are the policies and procedures which must be there in the internal control. Once again, they will not ask you the full question. Never they will ask you one component, they might ask you. So 5 components, what are they? Segregation of duties, authorization of transactions, adequacy of records and documents, accountability and safeguarding of the assets, and independent checks. Understood? Need some break? Okay, so take some 5 to 10 minutes of break and come back. Fine. So let us resume our discussion. So what and all concepts we have covered in the internal control? Let us have a quick recap. So first we have understood, come on guys, everybody participate. I know this contains a lot of contents in the internal control, and many questions, descriptive wise, point wise questions will be there. So here we have to do more repetitions. So first we have understood internal control meaning. What is the meaning of internal control? Process which is designed, implemented and maintained by the management, those charged with governance and other personnel, to provide reasonable assurance regarding achievement of objectives. What are that objectives? Safeguarding of the assets, reliability of the financial reporting, efficiency and effectiveness of operations, compliances with the laws and regulations. Who is responsible for implementation of internal control? Management is responsible for implementation of internal control. What is the scope of internal control? Is it includes only accounting controls? What else it includes? Administrative controls. But accounting controls are mainly related to what? Auditor will be concerned about only those controls which are related to safeguarding of the assets, prevention of frauds and errors, accuracy and completeness of accounting records, timely preparation of the reliable financial statements. So auditor will verify administrative controls only when they have some sort of connection with the financial statements. Next, whatever internal controls are there which are related to accounting system, it should fulfill some objectives. What objectives? The transaction should be authorized, either general or specific authorization should be there. Number 2, there should be proper prompt recording of the transactions. It should make sure that assets and records are prevented from unauthorized access, and also finally they should be verified at reasonable intervals. And we have seen some extra points here, like when we have seen that I have linked with other element, some 2-3 points you can add to that list. Transactions are recorded in the correct accounting period and correct head. So that is one more point. That's what we have now. Some 2 points I have marked, right? 3 I have marked. So transactions should be classified in appropriate accounts and appropriate heads. They should facilitate preparation of financial statements as per accounting standards and applicable financial reporting framework. And they should give sufficient description of the assets and location. Right. Next one. So then we have seen limitation. No matter how effectively you implement internal controls, they only can give you reasonable assurance regarding the achievement of objectives. Why? Because they are suffering from some inherent limitations. When I say inherent limitations, are they avoidable or unavoidable in nature? They are unavoidable in nature. What are that 5 inherent limitations? Number 1, cost exceeding benefits. Cannot handle unusual transactions. Collusion among individuals. Misuse of authority, manipulation of assumptions and judgments. Next, what is the structure of internal control, or what policies and procedures should be covered in the internal control? Number 1, segregation of duties. Number 2, authorization of the transactions. Number 3, adequacy of the records and documents. Number 4, accountability and safeguarding of the assets. Number 5 is independent checks. In all this discussion, a point for MCQ could be, what are the activities which are required to be segregated? I told 4 activities required to be segregated. Number 1 is authorization. Number 2 is execution. Number 3 is physical custody. Number 4 is maintenance of records. Right. So this is what we have seen till now in the internal control. Now we will discuss the next most important concept, which is components of internal control. So what are various components of internal control system? So let us try to understand it. See, if an organization want to implement internal control, Say for example, I'm freshly starting an organization. I wanted to run an IT company. So in my IT company, I want to implement internal control. It is not that easy, no. When I have to implement internal control and when I want to make sure that that internal control should work effectively in my organization. Why? Because no business owner wants to just implement internal control and not work effectively. That is not the objective. If I am implementing internal control, I do have an expectation that that internal control should work effectively. But if I expect that internal control to work effectively, just designing a policy and implementing alone will not be enough. There are various steps involved here. There are various components which are required to be taken care of. If I want to implement internal control and if I expect that internal control to work effectively, just designing and implementation alone will not be enough. I have to take care of 5 components. How many components, guys? I have to take care of 5 components. So if you can properly take care of that 5 components, then you can effectively implement internal controls and those internal controls also will operate effectively. So if you have that expectation, then you should compulsorily, then your internal control implementation, your internal control adoption in the organization should undergo 5 components. How many components? 5 components it should undergo. So what are that 5 components? Let us try to have a quick look at it. So first I will name the 5 components. Number 1 is control environment. Control environment. Number 2, entities risk assessment process. Entities risk assessment process. Very important concept. From here questions comes a lot. And third one, control activities. Control activities. Number 4, information system and related business processes relevant to financial reporting. And then finally monitoring. And finally monitoring of controls. So if I want to successfully implement internal control in the organization, I have to take care of 5 components. What are that 5 components? Come on, tell me. Number 1, control environment. Number 2, entities risk assessment process. Number 3, control activities. Number 4, information systems. Number 5, monitoring of controls. Once again, for one last time, please do repeat it. What are the 5 components of internal control? Control environment, entities risk assessment process, control activities, information system, and monitoring of the controls. Let us try to understand what happens in each of this component. I will tell you brief. I will talk about the entire 5 components. With that background, if we read, we can complete in no time. First of all, see, if I want to implement the internal control in the organization, as I've told, I'm a new organization. So I have somewhere around some 10 staff, I have some managers, I have some low level employees I have, and I'm the owner. I want to implement an internal control in the organization. Before I could implement an internal control in the organization, first I should create a good culture in the organization. First I should create a good culture. At the top of the management, at the top of the organization, I have to set a proper tone. So this phrase is very important. Often you find this phrase, tone at the top of the organization. The internal control cannot go beyond the tone at the top of the organization. That means if you don't set the proper tone, if you don't set proper culture in the organization, no matter how effectively you implement internal control, that will not work. So what kind of culture I have to create in the organization? I have to create a culture of honesty. I have to create a culture of ethical behavior. I should try to educate my staff how important it is to remain honest, how important it is to maintain ethical behavior. So as a top level management, as a top person in the organization, I should participate more in the business. Frequently I have to show my face to the people. I should not be like I am somewhere sitting in my cabin, I am never involving in the operations. Good culture will not be created. Employees will not have any fear. And also as a management, I should demonstrate good quality. I should have good attitude. I should have good philosophy. I should educate my people that, hey, we have to do good business. We have to maintain, we have whatever results are there, whether we make profit or losses, we have to show the correct information in the financial statements. We should not be manipulative. If we are facing any risk, we should be ready to communicate to our shareholders. We should not hide any risk from our shareholders. So like that, I should maintain proper philosophy. I should communicate with my staff how important it is to maintain culture of honesty and ethical behavior. I should frequently participate in the business. I should create a proper structure. Who is top level management? Who is middle level management? Who is low level management? I should create a structure. I should properly assign the responsibility. I should properly assign responsibility. I should create authorization mechanism. Who has to approve what? So like that, if I follow all these policies, at the top, a good culture will be created. And not just communicating, you should enforce it also. See, just if I keep on communicating, you should maintain good culture, you should maintain honesty. I am continuously communicating with my staff. But I found one employee who committed a theft. What I should have done? I should have immediately removed him from the company. But that person is some recommendation. That person, I know him very well. I spared him. Even I came to know that that person has committed a fraud, committed a theft. I did not take any action on him. Tell me, will good culture be created? No. So communication of values alone will not be enough. Even enforcement is also required. What is required? Enforcement is also required. So by doing all these activities, you create a good culture. That creation of good culture, we call it as control environment. Creation of a control environment. So the first and foremost step, if you want to implement internal controls and make sure that controls are working effectively, first you have to work on creating a good control environment in the organization, creating a good culture of honesty, creating a good culture of ethical behavior. By way of frequent participation, by way of frequent communication, by showing your attitude, by creating a structure, by assigning responsibilities and authorities, by doing all that, create a good culture. Okay, I have spent some time, created a good culture in the organization. First component I have fulfilled. Next is what? Why we are implementing internal control? What is the purpose of internal control? To prevent, detect or correct a misstatement from happening. Nothing but in my organization, I don't want the mistakes to happen. So that's why I want to implement controls. See, before I can stop a misstatement from happening, first I should know where the misstatement will happen. As a management, before I can implement internal controls, the main objective of me implementing internal control is to prevent mistakes from happening in the organization. But before I can implement that internal controls, first I should know where there is a risk of material misstatement, where there is a chance of happening misstatement. As a management, I should know. So like the way auditor is doing risk assessment, even management also should study their organization before they can implement internal control. Find out where there is a risk. There might be a risk in revenue. There might be a risk in technology. There might be a risk in one product. There might be a risk in new laws and regulations. So find out where there is a risk in the organization. Like the way auditor will do analysis, like the way auditor will perform risk assessment procedures, management also should study their organization to find out where there is a risk. Guys, when I say components of internal control, I'm talking from the management perspective, not auditor's perspective. Because management is responsible for internal controls, no? So whatever it is, second phase, I will study the organization. As a management, I will study my own organization, find out what kind of risk my organization is going through. So first, I have created good culture at the top. Number two, I have studied the organization, found out the risk. Number three, now you have to start working on the control activities. Control activity in the sense, you have to now start designing the controls. What activities I should implement as a part of control, like segregation of duties I should have, reviews I should have, periodical reviews I should have, whether I should go for automated controls, I should go for manual controls. So actual planning of the controls, actual designing of the controls you should do. Designing and implementation of controls you should do. That is the third phase, which we call it as what? Control activities. Actual implementation and design of internal controls will happen. So I have set the control environment at the top. Then I studied the organization, find out the risk. Then I identified what control activities I have to do, what exact activities should be implemented in my internal controls I have designed and I have implemented. Then I should have proper information system. Information system means what? Technology. See, you are implementing internal controls. Because of this internal controls, whatever things you are doing, is that required to be communicated to the concerned persons or not? Say for example, you have implemented an internal control. Every month you have to prepare a BRS. BRS is prepared. But if you keep the BRS to yourself, will it be of any purpose? No. You have to send it to the bank in charge or finance department in charge. You have to send it. No. If you are just preparing the BRS, if you have implemented control, if you have prepared the BRS, but if that information is not getting communicated to the concerned person, what is the purpose of having the internal control? So that's why you have to invest in investment information systems. Information systems means hardware, software, network. You have to buy accounting software, and that accounting software you have to make sure that that software is recording entries in a proper manner at accurate amounts in correct heading, and information is periodically getting circulated to the concerned person so that action can be taken. A control implemented without an action is waste of time. If you are implementing control but that information is not getting passed on to a concerned person, what is the purpose of having the control altogether? So that's why you should invest in the information system which makes sure that all the details are recorded properly and information is communicated to the concerned person at reasonable intervals. Okay, so you will invest in the information system and communications. And then finally, okay, you have set the control environment, you did the risk assessment, you implemented controls, you have also implemented information systems for communication. That's all, your responsibility will be over? No. Why? Because if you just implement the internal controls and ignore it, you don't know whether your control is achieving your objective. So periodically you have to do verification. Whatever control you have designed, whether the same is in operation or not. Is something required to be removed from this internal control? Is any new step is required to be added to the internal controls to make it more effective? So that continuous monitoring and continuous updation and review should happen. So whenever the continuous monitoring is happening, then only we make the changes whenever required, and when we make the changes, then once again controls will become effective. So that last stage we call it as monitoring. First four is important and the last four is even more important. You should not just implement the controls and leave it out. You have to continuously do the monitoring and make changes wherever necessary. So if you do that monitoring, then controls will remain effective. Then whatever outcome you have expected from that internal controls, you will be able to achieve it. So if you take care of these 5 components, then internal control objective can be achieved. So what are the 5 components? Repeat everybody. Control environment, entities risk assessment process, control activities, information systems, monitoring of activities. What happens in the control environment? We create a good culture of honesty and ethical behavior. What happens in the entities risk assessment phase? We study the organization and we find out the risk where there is a possibility of going wrong. What happens in the control activities? We actually design the activities, we start implementing them. Fourth one, information system. What happens there? We acquire the information systems and do periodical communications. And then finally, control monitoring of controls, whether the controls are working effectively, are they requiring any changes, that monitoring has to take place. So these are the 5 components of internal control. So with this background understanding, if we could start reading it, we will get the better clarity now. So let us see here. Communication and enforcement. So first one is control environment. The control environment involves the following things. What does it involve? Number one, communication and enforcement of integrity and ethical values. So as an auditor, you have to communicate, not just communication. Communication alone will not be enough. What you should also do? Enforce. Enforcing means what? Putting into action. So if you just communicate integrity is important, ethical values are important, that alone will not be enough. What should also do? If you find someone who is not honest, if you find someone who is not committing to ethical behavior, you should put into action. You should enforce it also. Take that employee out of the company. So you have to communicate as well as enforce. So what I should communicate, sir? The effectiveness of controls cannot rise above integrity and ethical values of the people who create, administer and monitor them. The meaning of this is, if you want effectiveness of internal controls, first you should have integrity and ethical values of the people who have created. If the management itself is not having integrity, if the management itself is not monitoring it, no matter how effectively you implement internal controls, there will be no use of it. Next, integrity, ethical behavior are the products of entities' ethical and behavioral standards. How they are communicated, how they are reinforced in practice. Whether ethical behavior is there in the organization or not, it depends on what standards you are following, how you are communicating them, and how you are putting it into action. Enforcement of integrity and ethical values includes like management actions to eliminate or mitigate incentives, temptations that prompt personnel to engage in dishonest, illegal or unethical acts. So what do you mean by enforcement is, first one, if you find anyone doing wrong, you have to take action. And first of all, you should remove all the opportunities in the organization that create a possibility of misstatement, that create a possibility of fraud or error. So first step in creating control environment, you have to communicate, and not just communication, you have to also enforce integrity and ethical values. Number two, commitment to competence. What do you mean by commitment to competence? See, if you want the control to work effectively, you should have such people in the organization who are capable, who are competent. You can't get the best results with ineffective people. Do you agree with me? If you have good objectives, if you have a good thought process, if you have good processes, but if the people are not competent enough, will you be able to achieve your objective? No. So if you want to create good culture in the organization, you should have competent people, you should have capable people. At the time when you are recruiting the people, recruit such people who are committed to the integrity and ethical values, who have that necessary capability. Don't give importance to that recommendations and all. So that is what the second component. Commitment, competence is the knowledge and skill necessary to accomplish tasks that define the individual's job. Third one, participation by those charged with governance. As I have told, top level management. Since they are top level management, should they always restrict to their cabins? Should they not come and participate in the business? No. The more they participate in the business, the better control they will have over the people, the better control environment they have to be created. That will be created. An entity's control consciousness is influenced significantly by those charged with governance. Responsibilities of those charged with governance include oversight of design and operational effective operation of whistleblower procedures and the process for reviewing effectiveness of entities' internal control. So one of the responsibilities of those charged with governance is they should make sure that whistleblower mechanism is working effectively. That means they should create such a culture. If anybody finds something wrong in the organization, they should be able to come and openly communicate with that. Such a good culture those charged with governance should create in the organization. Summary, the more they participate, the better control environment will get created. It also depends on management philosophy and operating style. As I've told, what philosophy management is having. Like if the management is honest, if the management always communicate, we have to show correct results. Like two attitudes of the management will be there. Some managements will have an attitude, whether we show profits or losses, we have to show correct information. Some management will have an attitude, whether we show correct information or not, our financial statement should always show profit. So here philosophy, what kind of philosophy your client is having. Next, so management philosophy and operating style. Like example, management attitude towards financial reporting is reflected in their choice of accounting principles and the care taken in developing accounting estimates. If the management's philosophy is good, they will choose appropriate accounting policies. If the management is having bad philosophy, bad attitude, they will be biased when selecting the accounting policy. They will prefer those accounting policies which show higher profits. So it depends on management attitude. And also organizational structure, nothing but hierarchy, the way you are structuring the organization. Establishing a relevant organizational structure involving defining key areas of authority, responsibility, appropriate reporting lines which should align with entity size. Nothing but you should have hierarchy, like as I've told, who is top level management, who is middle level management, what is the responsibility, who should report to whom, that clear organizational structure you should have. Then assignment of authority and responsibility, nothing but that approval mechanism also you should have. So assignment of authority and responsibility may involve policies on business practices, key personal's knowledge and experience and available resources. That means you have to assign the responsibility keeping all these factors in mind. You have to assign the authority depending on these practices, like business practices, what is that person's knowledge is, what is his experience, keeping all these factors, you have to assign the responsibilities. It may also include policies and communications to ensure that personnel understand entities' objectives, how their actions contribute, and what they are accountable for. You should hold discussions with the people, what role they play in the organization. Their work, what role their work plays in the entire organization's objectives. So you have to make them aware of it. And then finally, human resources policies and practices, HR policies. Companies will have HR policies, no? Even in the HR policies also, you have to demonstrate what company will do, if you do something wrong. At the time of recruiting only, make them very clear. In the HR documents only you include, if you are found committing a fraud, we will remove you without any compensation pay. So like that, even in the HR policies and procedures, you reflect that statements. So HR policies and procedures often demonstrate important matters in relation to control consciousness of an entity. Like for example, recruiting qualified individuals based on education, experience, accomplishments, and integrity shows the entity's commitment to competence and ethical behavior. At the time of recruiting only, give importance to these factors, not recommendations. Training policies that communicate prospective roles and responsibilities and include practices such as training schools, seminars illustrate expected level of performance. That's when the corporate companies, whenever you go and get the appointment, directly will not be given a job. First, there will be some orientation sessions will be happening in which they will educate all these things, especially in IT companies, they will educate you. There will be something called NDA, non-disclosure agreement, they will make you sign. So where if you sign the non-disclosure agreement, you are signing that you will not disclose company's information to anybody, even in your personal relationships also you should not discuss them. So those kind of trainings and seminars should be conducted. And promotions driven by periodical performance appraisals demonstrate entities' commitment to advancement of qualified person to higher levels of responsibility. Like if you find any person who is doing the work in a qualitative manner, who is honest also, who is doing ethical behavior also, you should promote them. So the promotion should be on the basis of the skills and knowledge, not once again on the basis of recommendations, which will never happen in the today's industry. Right. So all these things will be there in the control environment. So tell me what and all are different aspects of the control environment. Number one, communication and enforcement of integrity and ethical values, commitment to competence, participation by those charged with governance, management's philosophy and operating style, organizational structure, assignment of authority and responsibility, HR policies and procedures. Okay, next. Second element. What is the second component? Once you have established the good culture, now you have to do entities risk assessment process. Who should do that risk assessment process? Management should do it. So entities risk assessment process includes how management identifies potential risk in the organization. So you have to study the organization and identify the potential risk. Risk relevant to relevant financial reporting include external and internal events, transactions or circumstances that may occur and adversely affect on entities' ability to initiate, record, process, and report financial data consistent with the assertions of the management. Basically, when you are identifying the risk, pay attention to internal events also, external events also. Risk can happen from third party, risk can happen from internal parties. And also, risk can happen because of transactions, risk can happen because of circumstances that could adversely, that could badly affect the functioning of the company. So find out all that events or transactions, find out all that internal, external events which have an adverse effect on the entity's ability to initiate, record, process, and report the financial data consistent with assertions of the management. Next, management may initiate plans, programs, or actions to address a specific risk, or it may decide to accept a risk because of the cost or other consideration. So whenever risk is found, the management can take three actions. Either they can accept the risk, either they can avoid the risk, or either they can mitigate the risk. Three things. Whenever management has identified the risk, they should do three things. Either they should accept the risk. Generally, when they will accept the risk is when the risk is very, very minimal. Chance of happening misstatement is there, but the risk is very low. Like for example, hardly 0.001% of the misstatement will happen. Risk is there, but very minimal, very negligible. That they will accept it. They will not implement any internal controls. Avoiding means they will ignore altogether. That means they know something is going very badly wrong if this risk is there, but they will not take any action on that. That is avoiding, which is very dangerous. Third step is what? Mitigation. When they find the risk, they want to mitigate it. How they can mitigate it? Here the role of internal controls will come. If they accept it, no role. If they avoid it, then also no role. When they have decided to mitigate the risk, then the need for internal controls will come into picture. Right? So that's why management will initiate plans, programs, or actions to address specific risk, or it may decide to accept a risk because of the cost or other considerations. Next, risk can arise or change due to circumstances. See, risk can happen from various factors. The management, while doing risk assessment, they should consider this. From which and all factors the risk can happen. Like as you could see here, change in operating environment. Changing operating environment. For example, some new law or regulation has come into picture, which is affecting your industry. Like as you could see here, changes in regulatory environment, changes in operating environment can result in changes in competitive pressures and significantly different risk. Like for example, say you are into a food business. You are into a food business. You are a small scale business. You are in a small scale business. Food delivery business you take. Like cloud kitchens we have, no? So cloud kitchen business you are into. Say for example, government brings some new law. Plastic usage is completely banned. So if the plastic usage is completely banned, that could have an impact on the delivery. That could have an impact on your packing cost altogether. See, there is one strong competitor is a very big food chain is there. So what they have done is they have assessed this regulatory impact, and now they are shifting it to some natural packaging. So whatever it is, so they are shifting to natural packaging. So they are big largest competitor. They have already adopted. They have a lot of funds already available, so they have all of a sudden migrated to the that new packaging as per the norms. But this newly founded startup cloud kitchen, they take some time to shift to that new packaging. But in the meantime, the competitor might go aggressively into packaging even on that natural packing material and can take the market share. So like this, sometimes changes in the regulatory environment can bring new risk here. Like this one example. Or new personnel. When existing employee has left the company, when new person has entered inside the company, he is not that much aware of working conditions in the company, that could lead to new risk. Or new or revamped information system. When the client is using new accounting software, or when the client used to do manual activities, now they have migrated to the accounting software, or from Tally they are migrating it to SAP. So here also, because of migration issues, the risk might happen. And also rapid growth. Sometimes what will happen is company will grow all of a sudden 10 new branches. When they are rapidly concentrating on growth, they give less importance to the controls, which might bring new risks and all. Next, new technology. This is once again the same. Revamped information system or new technology, both will convey the same thing. Whenever there is a new technology you are bringing in, that will bring new risk also. New business models of products or activities. You are altogether introducing new business models, or you are diversifying. Till now you are a food industry, all of a sudden you are going into a fashion segment. So when you are diversifying, when you are bringing new products, that will bring new risks here. Corporate restructuring. So what do you mean by corporate restructuring? Amalgamation, merger. When your client entity has amalgamated with another entity, when your client has merged with other entity, that also could bring some new kind of risk. Or expanded foreign operation. Till now you used to operate only in India, now you have expanded your operations to foreign countries. This will bring a foreign exchange risk. Till now you don't know what is foreign exchange risk, but the moment you expand to foreign operations, now you will have that foreign currency risk related fluctuations also. And new accounting pronouncements. All of a sudden some new accounting standard will come into picture, which will increase the risk once again. It will bring new kind of risks altogether. So these are all the different ways by which a risk can happen. So as a management, when you are making assessment of the risk, you need to consider all these factors. So what are the various factors because of which risk can happen? Come on, this is also important part. So tell me, what are the different aspects because of which risk can happen? Changes in operating environment, changes in new personnel, new or revamped information system, rapid growth, new technology, new business models, products or activities, corporate restructuring, expanded foreign operations, and new accounting pronouncements. So this one part is having a chance of getting tested as a question. So what are the way, while doing the entities risk assessment process, what are the different circumstances due to which the risk can arise? Or what circumstances management should consider while doing the entities risk assessment process as a component of internal control? So then you have to write about these things. Then control activities. In the control activities, what will happen? Now we will design the control activities and we will start implementing it. So generally, control activities relevant to audit categorized as policies and procedures. You will start working on the policies and procedures. What kind of policies and procedures you will implement? Like you can implement performance reviews. What do you mean by performance reviews? Comparisons of budgets versus actual. So that kind of reviews you can do. Nothing but verifications and reconciliations you can implement. That is one kind of control activity. So these control activities include reviews and analysis of actual performance with budgets, forecast, prior period performance, or relating different sets of data like operating data or financial data to one another together with analysis of the relationships and investigative and corrective actions, basically analytical procedures. So you can also perform analytical procedures, study of relationship between financial and non-financial data. And you can also compare the internal data with external sources, like what? Your data with the competitor's data. When the competitor is growing 10%, who is in equal line of business, why we are growing only at the rate of 5%, doing that analysis. So these kind of performance reviews you can incorporate in the control activities. Or you can also concentrate on information processing. Nothing but you can implement internal controls in through information technology, and that information technology controls can be divided into two categories: application controls and general IT controls. You can start implementing internal controls with the help of information technology, and that controls can be divided into two categories. IT controls can be divided into two categories. What are they? Application controls, general IT controls. Very one simple example I will try to tell you. User ID, access to the system. Like for example, if you have to make sure that authorized person only should enter inside should have access to the system, so you can appoint a security guard. That is one general control. But general IT control is, as I've told, in the server room you should have access only by way of biometric scan. So that means entire system is getting protected because of that. That is a general IT control. Now when I say application control, at application level, at software level, you will have a control. So let me give you one simple analogy. This is an mobile phone is that you are putting a screen lock. That is a general IT control. Or when you are sleeping, You want nobody to access your mobile phone. So what you have done is you have kept this mobile phone in a drawer of your room and you have kept a lock. General IT control. Now that, or you, that's a screen lock also, you can call it as general IT control. Now inside this there will be multiple applications. For your file manager you have kept one lock. For your gallery you have kept one lock. For WhatsApp you have kept one lock. Even in the WhatsApp there will be something called encrypted text, encrypted messages. So these are all application level controls which operate at each application. So general IT controls protect the entire IT system, whereas application controls work at the specific application level. So that's what they say. Application controls which apply to processing of individual applications. Like application include checks like arithmetical accuracy, account review, edit check, sequence checks, manual follow-up. All this not required. This is all technical terminology. You can ignore them. And general IT controls are policies and procedures that relate to many applications, and they support the effective functioning of application controls by helping to ensure the continued proper operation of information system. That means if you want application controls to work effectively, you should have first general IT controls which are very effective. If general IT controls are effective, it will automatically result in effective application controls. If your screen lock is proper, then only application lock will work. If your screen lock can be easily cracked, then there is no purpose of having the application control. Next. Apart from that, you can also start implementing physical controls. Sir, what will come under physical controls? CCTV cameras will come, security guards will come, periodical verifications will come, physical verifications will come. All this will come under physical controls. So controls that encompass the physical security of the assets, including adequate safeguards such as secured facilities over access to the assets and records, keeping the assets and records at a safer place. The authorization for access to computer programs, only authorized person can access the data. Periodic counting and comparison, this is what we call it as physical verification. The extent to which physical controls intended to prevent theft of assets are relevant to reliability of financial statement preparation, and therefore the audit depends on circumstances such as when assets are highly susceptible to misappropriation. Nothing but if you have strong internal controls for safeguarding the assets, it will automatically increase the reliability of financial reporting. Like for example, in the inventory department, if you have proper CCTV footage, proper CCTV camera, inventory records are maintained, segregation of duties is there, that will automatically make sure that in inventory no theft is there. If in inventory no theft is there, inventory valuation, inventory figure which will come in the financial statements, that will also be more reliable. So those controls, if the physical controls ensure that assets are getting protected, that will automatically increase the reliability of financial statement preparation also. Then comes the fourth one, which kind of control activities you can also implement? Segregation of duties. I think we already know segregation of duties. Multiple times we have read. So what do you mean by segregation of duties? Dividing the duties and responsibilities among different person. So whatever we have read about regarding segregation of duties, the same thing will get repeated here. So 4 components will be there in the control activities. What are the four kinds of activities you can implement in the control activities? What are they? Number 1 is performance reviews you can conduct, information processing you can conduct, physical controls you can implement, or even safeguarding of duties. There should be one question regarding this. Let me show you that question. See here, this question. SA 315 requires the auditor to document key elements of understanding obtained regarding each of its internal control components, sources of information from which such understanding was obtained, and risk assessment procedures performed. While conducting statutory audit of MPT Limited, a listed company, CSZ has understood various IT controls relating to data center and network operations, system software acquisition, change and maintenance, program change, access security, application system acquisition, development and maintenance operating in the company. Basically, the summary is auditor understood various IT controls. Auditor understood various IT controls. Besides, he has also gained knowledge of application controls designed to ensure the integrity of the accounting records. Which one of the internal control components of the company is referred to above in the description? IT controls, application controls are all getting monitored. This relate to which component of internal control? Control activities. Besides activities gathered from the above description, give examples of any other 2 activities relevant for an audit included in the above identified component of internal control. They have told IT controls knowledge, you have gained information. First they are asking you what component it is. They are referring to control activities. Apart from this IT controls and all, they are also asking you to identify two more activities. Any two more activities. What you will write? Performance reviews you can write, physical controls you can write, segregation of duties they can write. So without using the phrase, without using that, they are referring to control activities. They are successful in asking the question regarding control activities. Okay, so this is what one example of the question here, how it can be tested. Next, the fourth component of internal control, what is that? Information system, including related business process relevant to financial reporting and communication. Basically, investing in the software, communication of the reports and all. So if you see here, information system, that means what does it contain? It contains infrastructure, which is physical components, hardware components, software, people, procedure, data. All this collectively we call it as information system. Many information systems make extensive use of information technology. Today, whatever communication we are doing, whatever information processing we are doing, everything we are doing with the help of extensive use of technology. Information systems relevant to financial reporting objectives include financial reporting systems encompasses methods and records. That means if you are using information system in the financial reporting process, basically if you want to use technology in your accounting process, what methods it should have, what it should do, what that accounting software should do. Number one, it should identify and record all valid transactions. Whatever accounting software that you are using, that should be able to identify and record all valid transactions. Describe on timely basis transactions in sufficient detail to permit proper classification. Not just identification, it should also do proper classification of the transactions, like revenue, capital, current, non-current, that classification it should do. It should also measure value of the transactions in a manner that permits recording proper monetary values in the financial statement. It should also value the transactions correctly. Determine the time period in which the transactions occurred to record transactions in the proper accounting period. Basically, that accounting software should record the transactions in the correct accounting period, and it should present properly the transactions and related disclosures in the financial statements. So whatever information system that you are using for the financial reporting, it should have these methods. Which methods? Or it has to fulfill these activities. Which activities it has to fulfill? Number one, it should identify and record all transactions. It should do proper classification. It should do proper valuation. It should record the transactions in the correct accounting period, and it should properly present the transactions. Next, the quality of the system generated information affects management's ability to make appropriate decisions in managing and controlling entities' activities and to prepare reliable financial reports. Basically, from the information system, if you are getting reliable information, then all the financial statements and other decisions will be correct. If the information system, whatever management is using, if it is generating correct information, then the management can take correct decisions and they can prepare better financial statements. If the information system does not give them proper information, will the management decisions will be appropriate? No. Will they prepare proper reliable financial statements? No. That's what this sentence is. From the system generated information, the quality, it affects management ability to make appropriate decisions and prepare reliable financial reports. If the system generated data is qualitative, they can make better decisions, they can prepare reliable financial statements. If there is no quality in the system generated data, that information, they will not take better decisions, they will not prepare reliable financial statements. Communication involves providing an understanding of individual roles and responsibilities pertaining to internal controls over financial reporting, may take forms such as policy manuals, accounting and financial reporting manuals, and memoranda. As I have told, communication is also very important. If you just implement the activities alone will not be enough. You should communicate to the respective people what is their role, what is their responsibility, and as I have told, that reports have to be sent to concerned person. On the basis of that report, what actions they have to take, that also you have to let them know. Next, communication also can be made electronically, orally, or through the actions of the management. These are all the different forms of communication. And then finally comes what? Monitoring. Last component is monitoring. An important management responsibility is to establish and maintain an internal control on an ongoing basis. If you just implement the control once alone, it will not be enough. You have to do it on a continuous basis. Management's monitoring of internal control includes considering whether they are operating as intended and that they are modified as appropriate. So what do you mean by monitoring? Checking whether the internal controls are operating as we have expected or whether it requires any changes. Monitoring of controls may include activities. When you are doing monitoring, what activities it will be included? Important point. This they might ask you as a question. What activities you should perform for monitoring of controls? Number one, management's review of whether bank reconciliations are prepared on a timely basis. Will you check it or not? Yes. Internal auditors evaluation of sales personnel's compliance with entity's policy on terms of sales contract. You have to check continuously whether the salespersons, whether the selling agents of the company are following the sales contract. Like company generally will have contract, they will allow only 5% of discount. You have to check whether really the sales agents are giving only that much amount of discount or they are going beyond it. And a legal department's oversight of compliance with entities ethical or business practices. There should be an internal legal department to check whether they are complying with the laws and regulations or not. Monitoring is done also to ensure that controls continue to operate effectively. The main purpose of monitoring is to make sure that controls are operating effectively, not at one point of time, on a continuous basis. Internal auditors or personnel may contribute to monitoring entities' internal control through separate evaluations. For the management, even internal audit team also can help. Why? Because internal auditors also will evaluate internal controls. So internal auditors can help the management by doing evaluation of internal control. Ordinarily, they regularly provide information about the functioning of internal control, focusing considerable attention on evaluating effectiveness of internal control, communicate information about strengths and deficiencies in internal control, and recommendations for improving them. Who will do all this? Internal auditors will do it. So internal auditors can evaluate internal control, they will find out effectiveness, they will report the strengths and weaknesses, and not just that, they will even give recommendations for improving them. And monitoring activities may include information from communications from external parties that may indicate problems or highlight areas. To know whether controls are working effectively or not, even you can use external information also. Sir, what kind of external information I can use for the purpose of knowing controls are working effectively or not? Say for example, company has decided one control. They have established a strong billing team. They have purchased one software where billing will happen. Once the customer places the order, the bill will be sent to the customer at appropriate pricing. But even after implementing that internal controls also, company is still receiving complaints from their customers that they are billed twice. They are getting billed twice. This particularly will happen in case of utilities. Say for example, you have taken an internet connection. So now that internet connection company, Wi-Fi connection you have taken, that company which is providing that Wi-Fi services, they have implemented one internal control. They have built one software which will automatically send the billing to the customer according to the plan which they have taken, according to the speed, 30 Mbps, 100 Mbps, according to the speed, they will send the bill at the appropriate amount. They have invested a lot of money on that internal control. But even after that investment also, they are receiving the customer complaints. They have taken 30 Mbps plan, but they are getting a bill for 100 Mbps. They are supposed to pay 700, but they are getting a bill of 1200. And for same month, they are getting two bills. So these kind of customer complaints they are getting. You tell me, these kind of customer complaints, what do they indicate? Controls are working effectively or controls are not working effectively? Controls are ineffective. So even management can use that external information also to monitoring for the purpose of monitoring of controls. Like for example, customers corroborate billing data by paying invoices or raising complaints. Regulators also may communicate with entity on matters affecting internal controls such as regulatory communication. Say for example, you have appointed one dedicated person who ensure compliance of GST. That person's role is to file GST returns on time. He will file GSTR 1 on or before due date. He has to file the GSTR 3B on or before the due date. But even after appointing that person also, one customer has complained that, or you have received a notice from the regulatory authority that GSTR 3B has not been filed for a month. Tell me, is the control working effectively? Not working effectively. Not working effectively. Management came to know about it. How they have come to know about it? Internal information or external information? External information. What is the external information here? Regulatory authorities, communications or notices. So this is what involved in the monitoring of the controls. That's all. These are the 5 components of internal control. So repeat once, what are the 5 components of internal control? Control environment, entities risk assessment, we have control activities, information system including related business processes, and monitoring of controls. So if we do one quick recap now, what will be included in the control environment? Number 1, communication and enforcement of what? Ethical values and the integrity. Number 2, what is that? Commitment to competence. Number 3, participation by those charged with governance. Number 4, management's philosophy and operating style, organizational structure, assignment of authority and responsibility, human resource policies and procedures. Number 2, entities risk assessment. The management should study the organization, find out where there is a risk, and there are various circumstances which could lead to risk, like we have seen here: changes in the operating environment, new personnel, new technology, new information system, adding new products, corporate restructuring, expanded foreign operations, and new accounting pronouncements. Then we have control activities. We have seen different kinds of control activities. Number one is performance reviews, IT controls, then physical controls, and segregation of the duties. And fourth one, it comes to information system related to business process. Basically, you should have, if you are using information systems related to financial reporting, it should have some methods, like it should identify and record all transactions. It should be properly able to classify the transactions. It should measure proper value of the transactions. It should record the transactions in the correct period, and it should present properly all the transactions. And then finally, monitoring. You have to check whether the controls continue to operate effectively, and you can use external information. Even internal audit team also can help them for the purpose of monitoring activities. So this is a summary of this 5 components of internal control. Clear, everyone? So how many more concepts we have? We are about to complete it, so let us do it. Now we will do one simple thing here. What are the techniques of evaluation of internal control? This we will do. So after this question, shall we break for lunch? So this will take somewhere around some 15 to 20 minutes. After that, we can take a break. 2, you have to come back. No, you will not come back. Shall I extend the session till 2:30 and leave then? No, till 2:30. Keep that talakai somewhere, okay? So we'll see. Let us complete this concept and we will decide. So techniques for evaluation of internal control. This is somewhat little interesting only. It is not so theoretical like whatever we have seen till now. Come on. See, all these difficult things, if we learn early, no concepts, all we can discuss later. Today, risk assessment and internal control. So after this, materiality concept is there. Materiality concept is conceptual, that we can that will once again find interesting. From tomorrow onwards, we will discuss standards. No, standards are once again, I don't need this much effort to make you engaging. Standards, I can automatically, the concept itself is engaging. There we can understand the things conceptually. But yeah, this chapter is little bit dry. Initial concepts are interesting, like what is audit risk and all, that is good. Meaning of internal controls, that is also good. After that, whatever things we have seen, no, all that is shit, I know it. Yeah, but from that also questions are going to come. So we have to learn it, whether it is dry or something that is least bothered. I have to teach everything. You have to listen to everything. Okay, we don't know from where the question is going to come. Right. So techniques of internal control evaluation. So let us try to understand it here. So if you want to know whether internal controls are working effectively or not, if you want to evaluate the internal controls, whether they are working effectively or not, so you have 3 techniques available. How many techniques available? 3 techniques we have available. Those 3 techniques are, number 1 is questionnaire, number 2 is checklist, number 3 is, oh, so informative you guys are. At CA inter level, you should have one more thing, no? You might have learned 4, right? What is that missing one? Narrative record. Very good. So at the CA inter level, you might have learned 4 things. Internal control internal control questionnaire, they say. Checklist, they will say. Flowchart, they will say. Apart from that, they say one more thing, narrative record. But here, narrative record, you will not find this. Why? Because narrative record is a very outdated method. No one in the industry is using it. So in the narrative, okay, first we will understand this, then I will talk about the narrative record, or else you concentrate on that and you ignore this, because that is not important. That is not there in the material. First, we will focus on these 3 methods. So first of all, so repeat the names. What are the 3 methods for evaluation? Questionnaire, checklist, flowchart. So first we will talk about the flowchart, which is very easy for us to understand. In the flowchart technique, what will happen is we will try to study the internal control system. We will try to understand what and all are the different processes involved in the internal control. And thereafter, whatever understanding we have obtained regarding internal control, we try to present it in a diagrammatic format. In a pictorial format, we will try to present it. Each and every stage which the transaction is going through, that we will try to present in a diagrammatical format. And flowchart is a most concise and briefest way of presenting the internal control. And from the flowchart, we can easily find out where something is going wrong also. Because since we have a visual representation, see, often people say a picture is more than 1,000 words, they say. So through that flowchart, you will be able to understand where something is going wrong, where something is going wrong. If something is going wrong, somewhere some deficiency is there. By looking at the chart, you can pinpoint where that thing is going wrong, and you can easily find out that deficiencies. So this is one method which we call it as flowchart, which involves diagrammatic presentation of internal control. So first we try to understand it, then we try to see what and all are the different stages which the transaction is going through, and we can pinpoint where something is going wrong. So if you see here, flowchart is a graphical presentation of internal control and normally drawn up to show controls in each section or subsection. As distinct from narrative form, it provides a most concise and comprehensive way for reviewing internal control and evaluate the findings. Instead of writing it in a narrative manner means what? So you have to write it in a descriptive format. Whatever understanding that you have obtained, you have to write it in a detailed paragraphical manner. That will take a lot of time, lot of energy, lot of broader description also. But instead of narrative form, if you go for flowchart, it is most concise. Why? Because you need not write paragraphs. Whatever you find it there, you try to present it in the pictorial format. So it is a most concise, at the same time comprehensive way for reviewing internal controls and evaluate the findings. It gives bird's eye view of system and is drawn up as a result of auditor's review thereof. So it gives a bird's eye view, which means what? Complete overview you are going to get it. Next one. Essentially, a flowchart is a diagram with full lines and symbols. And if judicious use of them can be made, it is probably the most effective way of presenting internal control. So we see lines, charts and all we see. And if you are able to make proper use of it, that is the best way to analyze the internal control. A properly drawn up flowchart can provide a neat visual picture of whole activities of section or department involving flow of documents and activities. So in the flowchart, you can easily present in a neat visual manner which and all activities are involved in the transaction. More specifically, it can show at what point a document is raised, what is the starting point of the document, whether it is internal or received from external sources. Like for example, if you are preparing a flowchart for sales, their sale invoice will be there. The document will be generated internally. If it is a purchase invoice, it will be generated outside. So it will show what is the starting point of the transaction. And number of copies in which a document is raised or received. How many copies of document is getting generated? Like for example, typically a flowchart will look something like this. If you take the purchase transaction, if you take the purchases, just I will give you a simple structure. So say for example, purchase related internal control start with inventory department or warehouse department, inventory department raising a document called not purchase order, they will requisition, purchase requisition slip they will raise. They will raise that purchase requisition slip in 2 or 3 copies. Let us say for example, they are raising purchase requisition in 2 copies. One copy they will keep it for accounting purposes. Another copy they will send it. One copy of purchase requisition note they will send it to purchase department. Now what the purchase department will do is they will raise the purchase order. That purchase order they will raise in 3 copies. One copy will be given to the supplier. One copy will be forwarded to the accountant. Along with that, they will forward it to the accountant or finance team, and one copy they will store it for their accounting purposes. Now the supplier will give invoice. Now generally invoice will be generated in 3 copies. We all know it. One will be kept by the supplier only. One will be given to transporter. Finally, as a recipient, we only get 1 copy of the invoice. We only get 1 copy of the invoice. Now this invoice, once the goods have been received, they go to the production department. They go to the production department. In the production department, inspection will happen. In the production department, what will happen? Inspection will happen. Now 3 copies of the inspection report will be generated. 1 copy of the inspection report will be go to once again inventory department. 1 copy will go to the accounts department, and even 1 copy will go to the purchase department. Now on the basis of that inspection report, this GRN will be raised. Goods receipt notes will be raised. Now this goods receipt note also will be generated in 2 or 3 copies. One copy will be retained by them, one copy will be given to accounts department. Now accounting department will accumulate all the copies. Copy of the invoice will be given to them, copy of the GRN they will have, copy of the inspection report they will have, and along with that copy of the purchase order will be sent to them, copy of the purchase requisition note also will be there. Now all of this they will attach. Generally there is no physical attaching here. Nowadays what they are doing is they are scanning and uploading it. So on the basis of that, they will prepare a voucher entry they will prepare. Now that entry will be forwarded to some concerned manager. Now what that concerned manager will do is he will check the entry, he will check all the supporting documents, try to match everything, then he will approve it. If he approves it, entry will be recorded in the books of accounts. If he doesn't approve it, entry will not be recorded in the books of accounts. So this is a simple flow chart. So now if you see here in this flow chart, you are able to see where the transaction has started. Purchase requisition note, that is a starting point. It is internally getting generated. How many copies are generated? That also you are able to see. And which and all stages, which and all departments the transaction has gone through. So everything will be demonstrated in the flow chart. So that's what they say here. It will show at what point a document is raised internally or received from external sources, the number of copies in which a document is raised or received, intermediate stages set sequentially through which the document and activity pass. Like the document has gone through different phases: purchase department, inventory department, production department, distribution of the documents to various sections, departments or operations. So like where and all the documents have gone. One copy has gone to purchase department, one copy has gone to the accounts department, and also checking authorization and matching. As you could see at the final, accountant has attached all the documents that has been verified by concerned manager, then only he has given the authorization. That approval stages also will be shown, and all these documents will be filed and final disposal by sending out or destruction. Basically in the purchase, the final disposal will be payment. Whenever you do the payment, then the transaction will come to an end. So it will show everything from starting point till the ending point. What is the starting, what is ending, what are the departments, what documents, how many copies, everything will be shown in the flowchart. By flowcharting, auditor can see interrelationship of activities and flows, how they are integrated from stage to stage. You can easily see the interrelationship between the elements. So this is what flowchart. Okay, one method we are done. Now we are left with two more methods. What are they? Questionnaire and checklist. Sir, what happens in the questionnaire and checklist? Very simple. Both are going to contain series of questions. Both are going to contain what? Series of questions. And those questions are drafted in a manner where answer will be yes, no, or not applicable. In both questionnaire and checklist, we will prepare series of the questions. Questions about what? Questions about elements of internal control. We are doing these techniques for evaluation of internal controls, no? So we will also be drafting questions regarding evaluation of internal controls only. So in both the cases, questionnaire and checklist, the auditor, who is going to draft the questions? Auditor himself will draft the questions, and the questions will be drafted in a manner the answer will be yes, no, or not applicable. And in both the cases, these questions are required to be answered. But who is going to answer the question? It is going to change. But let me give you one illustration. If I have to evaluate, if I have to prepare questions regarding the elements of internal control where the answer will be yes or no. I want to evaluate internal controls in the area of cash. Now say for example, I am drafting the question something like this. Is cashier preparing a voucher? Is cashier preparing voucher? Now I will leave a space there. Yes, no, or not applicable. Then are vouchers serially numbered? Another question. Then are vouchers approved? Are vouchers approved as per the delegation of authority? Are vouchers approved? Next, is cashier passing accounting entry also? Is cashier also passing accounting entry? So for example sake, I want to evaluate internal controls in the area of cash. These questions I have drafted. Sir, you are telling in both the cases auditor will draft the questions, and in both the cases questions will be drafted in the format of yes, no, or not applicable. Then what is the difference? Where the difference is going to come from? The difference will be in who is answering that question. In the case of questionnaire, the questions will be answered by the client's staff or client's management. If I'm following questionnaire, what I do is I will draft the question, I will take a printout or I will send a PDF copy to my client and I will say, sir, either you answer it, client's management, dear management, you answer it, or you forward these questions to the concerned department and ask the department head or department staff to fill the answers and give it back to me. This where I will do in the questionnaire. So I will draft the questions, I will give it to the client. I will ask either the client's management to fill the answers and give it back to me, or I will ask them to circulate it to the concerned department heads and get them filled. Whereas in the case of checklist, what will happen is I will prepare the questions, I will call my audit staff and I will ask them, dear article assistant, say for example, article assistant, I will call him, I will give him that checklist, I will give him that questions. I will say, go to the cash department, get answers, get back to me with the answers. So basically in the checklist, what will happen is these questions also will act as instructions. In the case of checklist, when I call my article assistant and give it to them, I want answers to this. Either you can call them as questions to be answered by your audit staff, or even you can consider them as instructions which are required to be followed by the auditor staff. That means by giving this checklist, you are giving him clarity, which and all questions, which and all things you have to verify. So if it is a questionnaire, I will get back the sheet with the answers from the client's staff or management. If it is a checklist, I will get back that sheet with the answers from my auditing staff. Now on the basis of responses, whatever I have got, for the questions, I will conclude whether controls are working effectively or not. Based on responses which I have got either from the management or client's staff, I will evaluate whether the controls are working effectively or not. Like say for example, I have given this questionnaire to the client and I have got all the responses as yes. I have got. Now I have to evaluate, are the controls working effectively in the department of cash? Are the controls working effectively? No. Look at the last question. What is the last question? Is the cashier passing accounting entry also? I got the response as yes. What do you mean by that? There is no proper segregation of duties. So like this, I will send the questions, I will get the responses. Depending on the responses, I will evaluate whether the controls are working effectively. So that same thing happens in the questionnaire and checklist, but where the difference arises in the questionnaire and checklist is who is going to respond to that questions. Okay, that's all. This is what regarding questionnaire and checklist. This is some more information in the material regarding that things. Let us try to have a look at that. So first I will talk about questionnaire. A questionnaire is a set of questions, and that too which are framed in an organized manner about each functional area, which has a purpose of evaluation of effectiveness of controls and detection of its weakness. So questionnaire is going to contain series of questions. That questions also will frame it in an organized manner, and from that questions we want to evaluate whether the controls are effective or not. It usually consists of several separate sections devoted to areas such as purchases, sales, trade receivables, trade payables, wages, etc. Like I have shown questionnaire only for cash. This kind of questionnaire can be there for all other areas. For purchase also there will be one questionnaire. For sales also there will be one questionnaire. For trade receivables also there will be one questionnaire. So like that in every area I will try to write the questions there. Next, it is intended, here comes the important part, who has to fill it? It is intended to be filled by company executives who are in charge of various areas, basically client's management or client's staff. However, this poses some practical difficulties. The questionnaire is to travel from executives and therefore it may take a pretty long time to be filled. Obviously, time will take, no, you will give it to the company's management. They have to circulate it to the respective person. Now they have to study the questions and give back the answers. It is definitely going to take some amount of time. Questions are so framed to dispense with the requirement of a detailed answer. To the extent possible, we will remove the requirement of detailed answer. The questions are framed in such a manner that answers will be yes, no, or not applicable. And also, questions are framed in such a manner that generally no answer will reflect weakness. This requires giving a positive power to the question, keeping in view what proper control should be. That means they are asking you one general instruction. Whenever you are drafting the questions, draft the question in such a manner that yes answer denotes a positive response, no answer denotes a negative response. Draft the question in such manner, but however it is not a hard and fast rule. So you can draft whether yes denotes a positive answer, no denotes a positive answer, that depends on the question you are asking. But to the extent possible, draft the question in such a manner that yes answer shall denote a positive answer. No answer shall denote a negative answer. But it is not always a thumb rule that yes is always positive, no is always negative. For example, if I say you are a wage fellow, the answer is yes. Positive answer or negative answer? What, you are only confused, huh? Negative response, right? So like this, whether yes denotes a positive answer or no denotes a positive answer, it depends on the question you are asking. Even if I show you the example here, I told is cashier passing accounting entry? We got the answer as yes. Is it a positive response, negative response? It is a negative response. So whether yes denotes a positive response or no denotes a negative response or not, that depends on the type of question you are asking. But one general instruction what they have told is when you are drafting, to the extent possible, draft the questions in such a manner that yes denotes a positive response, no denotes a negative response. So if I have to rephrase this question where yes denotes a positive answer, what I should do? What I should do? Is there a separate person passing an accounting entry? Like that I can draft it. I can draft a question. So that gives a positive power to the question. So if possible, try to draft in that manner. But in some rare circumstances, we will not be able to draft it. In that case, go with the normal rule. But to the extent possible, try to draft the question as per such a format that S denotes a positive answer, no denotes a negative response. If it is necessary, slightly detailed answers may also be asked to bring clarity to the matter. So you can do one more, you can go one more step ahead. What you can do is after you have drafted the questions, you add one column for answer. Yes, no, or not applicable. So what you can do is you can go one more step ahead and you can add the remarks column. If you want the client to give a little bit of extra remark, you can even add the remarks column. Next, in the use of standardized internal control questionnaire, certain basic assumptions about elements of good control are taken into account. See, when you are drafting questions, how you are drafting the question? I drafted you 4 questions, right? Whether cashier is, see these questions we have drafted. Is cashier preparing voucher? Our vouchers are signed, serially numbered. Our vouchers are approved. Is the cashier passing accounting entry? I have drafted these questions. Why I have drafted these questions? Because these are the general assumptions which I have. I do feel that in every organization, these control activities will be there. So I have that assumption. Based on that assumptions only, I draft the questions. Clear, everybody? So what are that assumptions which you will have in mind while drafting the questions? So what are they? Certain procedures in general used by most business concerns are essential in achieving reliable internal controls. This is a time-tested assumption. For example, daily bank deposits, cash book balancing, control account reconciliations. These kind of controls we generally expect for every organization to follow. Organizations that permit an extensive division of duties and responsibilities, basically segregation of duties. We do generally assume that they divide duties and responsibilities. Employees concerned with accounting function are not given any custodial function. This is also one assumption I can generally make in every organization. Once again, this is also related to segregation of duties only. No single person is entrusted with the responsibility of completing a transaction all by himself. Once again, what? Segregation of duties only. There should always be evidence to identify the person who has done the work, whether involving authorization, implementation, or checking. Audit trail, this we call it. So authorization also you can say. So I do expect that in an organization, every organization will have some sort of mechanism to identify the person where mistake has taken place. If in the entire process a mistake has taken place, at which stage that mistake happened, which person committed that mistake, there should be some means to identify it. Next one, work performed by each one should come under review of another in the usual course routine. This we call it as internal check mechanism, which we will see it in the while map. And there is a proper documentation and recording of the transactions. So these are all the assumptions. These are some general assumptions which I make for every organization to follow, and based on these assumptions only I will draft the questions. Important from the examination perspective. So they might ask a question from here. If you are, they will give a scenario like you are conducting audit of some company, you are verifying their internal control, you know that there are different methods for evaluation of internal control. Then finally they will add somewhere, after giving some 5-6 lines of information, at the end they will add one line. So you have to generate one standard internal control questionnaire. While doing that, you generally assume certain things while drafting the questionnaire. State those assumptions. So these assumptions you are required to write it here. Understood? Next. And one more thing here. For first year of engagements, issue of questionnaire is necessary. If you are doing the audit for the first time, you have to compulsorily issue a questionnaire. For subsequent years, instead of issuing a questionnaire again, auditor may request client to confirm if there is any change in nature and scope of business have taken place that necessitated corresponding change in internal control. Or even without change in nature and scope of business also have system undergone any change. Simply, in case of recurring audit, they are saying if you are doing the client audit for the first time, definitely will send questionnaire. For the same client, you are doing the audit for the next year. You need not send the detailed questionnaire once again. What you should do, you should ask the management, sir, has your business undergone any change? Because of which did you make any changes to the internal control? Or sometimes without any change in the nature of the business also, client might change the internal controls. For example, the client has diversified into new business. That's why they have changed internal controls. Or the client did not diversify, entire business remains the same, but till last year they used to follow manual controls, now they are following automated controls. Now, should I send internal control questionnaire once again or not? Yes, you have to send it. So if there is no change in nature of business, if there is no changes made to the internal controls, no need to send the internal questionnaire again and again every year. Next. However, it would be a good practice in the case of continuing engagements to issue a questionnaire irrespective of any change. Say every third year, important for MCQs. Important for MCQ. If it is a recurring engagement, it will be a good practice. Even though whether anything has changed or not, once in 3 years, if you send the questionnaire, it will be better. Not after year, but at least once in 3 years, you send a questionnaire. Next. Checklist. So checklist, the discussion and all remains the same. Here and there few changes they will try to say here. It is a series of instructions. As I have told, even you can call them as instructions. In the case of checklist, you can call them as instructions. Why? Because you are calling your audit team and you are asking to get the questions. That means basically you are giving instructions. In that area, what and all should be verified. So either you can call them as series of instructions or you can call them as series of questions on internal control, which the auditor must follow or answer. When particular instruction is carried out, the auditor initials a space opposite the instruction. So basically what he will do is, if this is the case, so let me copy it somewhere here. So if this is the question, if this is the checklist, so if this is the checklist, in case of checklist, what will happen is the concerned audit staff to whom the work has been assigned. Here also I will leave one column. So in this column, either I can have different kinds of marking. Either I can say yes or no. If I say yes or no, the article assistant after verifying, he will fill yes, no answers, he will fill. Or in most cases, what they will do is they will keep a box also here. If he has verified that, he will put a tick mark. If that is not there, he will give a into mark. So whatever it is, different kinds of marking will be followed in the industry. It is in the form of questions. Here also the answers will be generally yes, no or not applicable. It is more in nature of reminder to auditor about matters to be checked for testing. That's why I called it as instructions also. While a questionnaire is basically a set of questions put to the client, a checklist, which may be in the form of instructions, questions, or just points to be checked, may be meant for auditor's own staff. It is a set of instructions or points. It may be meant for client if it is in the form of questions. Same point I have told. Questionnaire is for management answering. Checklist is for auditors answering or auditors following of the instructions. The question form of checklist may even be meant for auditor's own staff. Either you can give it as instructions or you can frame it as a question. So example of checklist in the area of cash. I have given you few examples, no? Few more questions they are giving here. So in the area of cash, what kind of checklist you will do? Have you checked that the cashier is not responsible for opening incoming mails? The cashier should not open the incoming mails. He does not authorize any of ledgers. His duty should be only collecting and paying. He should not have authorization power. Does not authorize any expenditure or receipt. He should not sign checks. He should take his annual leave regularly. How good, no? Mandatory leave. Today in the companies we have this policy, mandatory leave. You have to go on leave. That's all. You can't say no, sir. Office is better place than home. I don't want to take any leave also. But still, the managers will say no, compulsory. You have to take leave. Go to somewhere, but don't come to office. So mandatory leave. These sensitive roles should compulsorily undergo leave. Whether that cashier inks and balances cash book every day, nothing but initialing and all, he will do it or not. On everyday basis, he has to put some initial. Verifies physical cash balance with book figures daily at the end of the day. He will prepare monthly BRS. He should hold no further funds or investment. Holds no unnecessary balance in hand. If any excess is there, he has to go and deposit it with the bank. Does not pay money without looking into compliance with proper procedure and due authorization. And also whether he has tendered proper security or has executed a fidelity bond. Nothing but they get a bond from the cashier. If at all something has gone wrong in the cashier has to compensate. That kind of bonds they will generally execute for sensitive roles, whether these kind of things are there or not. So this is an example of checklist in the area of cash. Once again, they are telling the basic distinction between internal control questionnaire and checklist are as under. ICQ incorporates large number of detailed questions, but checklist generally contains questions relating to main control objectives. So questionnaire is very broader. It contains a lot of questions, but in checklist we have main control objectives only. We don't give broader questions. In internal control questionnaire, questions are usually answered by company's executives. However, in checklist, the same are required to be answered by auditor or auditor staff. The significance of no in an ICQ does indicate a weakness. As I've told, generally we frame the questions in such a manner, no denotes a non-satisfactory response. But its significance is not revealed automatically. If you get no response in the internal control questionnaire, we know that something is wrong. But what is that wrong? How severe it is? We don't get it. However, in a checklist, a specific statement is required when an apparent weakness may prove to be material in relation to the accounts as a whole. But in the case of checklist, what you can do is we can say to the article assistant, if you are giving a non-satisfactory response, give me the reasons also. That we can say it to our staff, that we can't say it to the management. I can make my staff follow to give the reason also. Why, what exactly has gone wrong? That also you have to provide me. My audit staff will do it. But do you think management also will say, this all wrong things we have done? Do you think they will explain that? No. So that is a difference between internal control questionnaire and checklist. So that is what regarding the different techniques for evaluation of internal control system. So what is the time now? 1:34. Right. So let us resume our discussion. So before the break, we have completed 3 techniques for evaluation of internal control. So what are the three techniques? A questionnaire, checklist, and flowchart. Right. So now we will proceed further and understand the remaining concepts. So we'll try to understand this one small concept, which is internal check system. So what is this internal check and internal control? Often the students get confused between the two. So I will say here, internal control. What is the meaning of internal control? What we have understood regarding internal control? An internal control is a process which is designed, implemented, maintained by the management, those charged with governance or other personnel to achieve certain objectives. So internal control is a very broader term. Any process which organization has implemented to prevent mistakes from happening or to achieve its specific objectives, we call it as internal control. So basically, when I say internal control contain in its perspective so many processes, right? So when I say internal control contains so many processes. It includes authorization, it includes a segregation of duties, it includes adequate records and documents. So like that, in the internal control, we have so many sub procedures. Like that, one of the subset of internal control or one of the important element of internal control is internal check. So one of the element or one of the component, not component, because if I say use the term component, you will get confused with that 5 components. So don't call it as component. One of the important element. So one of the process in the internal control, that I can call it as internal check. And if I have to put it in simple terms, internal check is nothing but the other name for segregation of duties only. Internal check is a process which is just an other name for segregation of duties. And actually, internal control is a part of internal control system. Internal control system is very wide. It includes different processes which are included to make the control effective. In that, one of the processes is internal check system. And internal check is nothing but the other name for segregation of duties. So when we start reading the meaning of the term internal check, they say that internal check is a process in which we divide a task among different people in such a way that the work of one person will automatically be reviewed by another person. What do you mean by internal check system? Association or organization of duties in such a manner. We divide the duties, we divide one activity among different people in such a manner that the work will be spread among different people and the work performed by one person will be automatically checked by another person. And it will make sure that one activity is not under control of one single person. No single person will control the entire activity. So such a kind of mechanism, we call it as internal check mechanism. If I have to give you example, these days people have stopped going to the bank's branches physically. But a few years back, if you want to get a transaction done, you have to visit the bank branch. So the moment you visit the bank branch, you can typically see there how the internal check system works. Say for example, you wanted to withdraw money from your bank account. That is one activity. A customer coming to the bank and withdrawing the money. But if you go and visit the branch, this activity will not happen with only one person. You need to go through various counters to get the transaction happen. Like for example, initially you have to take the slip there. They will have that challan kind of thing. You will fill that challan. You go and take that challan and give it to some person. They will give you a token or something kind of thing they will give you. So now you will go to one person. That person will check your account details and all. He will check, and that will be transferred to another person. There will be adjacent person sitting to him. That transaction will be processed to him. Now that person will verify your signature, your account details, whether enough of balance is there or not. He will check. If it is a check, if you are signed, he will go to that database of the signatures and he will cross verify with the signature. Now that transaction will go to another person. That transaction will ultimately go to the cashier. Now cashier will once again verify signatures, all the work which is done by the previous person. If he is satisfied, then he will disburse the cash to you. One activity only, but this one single activity did not happen at one person. It has passed through different people, and the activities are organized in such a manner that one person will do the task will be forwarded to another person, and the work done by the previous person will be automatically verified by the next person. And if you see here, entire process is not under a control of single person. This is what we call it as internal check system, and you would have already realized this is what we are saying it as segregation of duties. So internal check is nothing but just an other name for segregation of duties. That's all. The concept is over. This is what they say here in this particular paragraph. So first of all, meaning. What is the meaning of the internal check system? So if you see here, internal check system implies organization of overall system of bookkeeping and arrangement of staff duties so that no one person can carry through a transaction and record every aspect thereof. So no single person will have a complete control over the transaction and record every aspect there. It is a part of overall control system. It is not a separate process. Internal check is a what? It is a part of a broader internal control system, and it operates basically as a built-in device as far as organization and job allocation aspects of controls are concerned. It is automatically built into the internal control system only. The system provides checks on day-to-day transactions, which operates continuously as a part of routine system, whereby work of each person is either proved independently or is made complementary to another person's work. See, the activities will be organized in such a manner that on a daily basis, on a transaction basis, if any person has to withdraw the money from the bank, everybody has to follow the same process. On a continuous basis, it is a kind of continuous internal audit happening. It is a kind of a continuous internal audit happening within the organization. So this is what the meaning of internal check system. Now with what objectives internal check system will be implemented? Same repeated objectives. Number one, to detect error and frauds. If work performed by one person is automatically verified by another person, frauds and errors can be easily detected. Number two, to avoid and minimize possibility of commissions of errors and frauds. Repeated point only, no, just change in the active voice, passive voice. They are playing with the English grammar, nothing else there. Third point, to increase the efficiency of the staff. If you know that your work will be verified by the another person, will you do the work carefully or not? That means overall, if you do the work carefully, overall efficiency will get improved. Overall organization will become better. Number three, to locate the responsibility area or the stages where actual fraud and error takes place. And with the internal check system, you can easily pinpoint where the mistake has taken place. You can easily find out that specific person who committed the mistake. Number five, to protect the integrity of the business by ensuring that accounts are always subject to proper scrutiny. Nothing but people will have even more trust on that financial statements in which there is an internal check system. And also to prevent and avoid the misappropriation or embezzlement of cash or falsification of accounts. Nothing but it will also prevent frauds. Regarding frauds, only 3 points they are saying. First point is also talking about detecting frauds and errors. Second point is also to avoid and minimize. That means first point says if it has already happened, we can detect it. Second point says we can stop it altogether from happening, fraud or error. Then last point say to prevent and avoid misappropriation or embezzlement. This is also something nothing but a fraud only. So broadly 6 objectives they have given. Tell me what are that 6 objectives? Number one, detection of frauds and errors. To avoid and minimize the possibility of errors and frauds. To increase the efficiency of staff. To locate the responsibility where the mistake has happened. To protect the integrity, nothing but to make the financial statements more reliable also you can write it, and to prevent and avoid the misappropriation or embezzlement of cash or falsification of accounts. These are all basically different kinds of frauds which we will see in SA 240, misappropriation of assets, manipulation of accounts and all. We can prevent all kinds of frauds. Next, consideration on which effectiveness of efficient system of internal control depends. Basically, when you implement internal check system, whether that internal check system will work in an efficient and effective manner or not, it depends on some factors. If you want internal check system to work effectively, So whether that will work or not, it is going to depend on some considerations. So what factors will decide whether internal check system will work effectively or not? Number one, clarity of responsibility. Basic thing. Since you are dividing the work among different people, everybody should have a clarity. What is their job, till what extent they are involved, till what extent they should do the operation, when they have to forward it to the next person. If you don't have that clarity, is there any purpose of implementing internal check system? No. So if you expect the internal check system to work effectively, number one, you have to educate all the people involved in the process. What is their role? What is their responsibility? To what extent they are involved? When they have to forward it to the next stage? That clarity of responsibility, you have to provide it. So as you could see here, responsibility of different peoples engaged in various operations of business transaction should be properly identified. A well-integrated organizational chart depicting the names of responsible persons associated with specific functions may fix up responsibility. What organization can do to provide the clarity of the responsibilities? They can draw an organization chart. They can have a flow chart. In that, they can say, this person will do only this thing. Like that, they can structure one SOP. This only we call it as SOP, and inform to everybody so that they can refer to that document and have clarity of what they are supposed to do. Second factor, you have to divide the work. You have to divide the work. Everybody should have a clarity of responsibility of their work. And number two, you should divide the work in a proper manner. Segregation of work should be made in such a manner that free flow of work is uninterrupted, and also helps to determine that work of one person is complementary to the other. It is suggested that a rotation of different employees should also be made. This I have already told you. Rotation is very, very important. So you should have clarity of responsibility. Divide the work in such a manner that that work is not getting stuck. There should be a smooth flow of work. Work should not get objected. Number three, standardization. See, every time you can't invent new policies, new procedures. If you want internal check system to work, you should standardize the process. If you have to do a purchase transaction, like as I have told, purchase requisition from the inventory department, it should go to purchase department, purchase order, invoice, verification, gate pass. This process should be standardized. Every transaction should go through this phase only. You cannot leave it to the choice of the employees. Transactions, you process it in whatever manner you want. If you say that, number one, no one will have clarity of responsibility, whatever they have to do. So that's why standardize the procedure. If an activity has to happen, this should follow compulsorily these steps. If you standardize it, then only internal check will work. Number three, appraisal. Appraisal means periodical review, nothing but monitoring. On a regular interval, you have to verify whether really that internal check system is working effectively or not. So periodical review should be made of the chain of operations and workflow. Such processes may be carried out by preparing an audit flow chart. Basically, reviews you have to do. Next one. Light. You want light? Please do that, no? So there are four considerations on which effectiveness of efficient system of internal check will depend. What are the four factors on which effectiveness and efficiency of internal check system will depend? Four things. What are they? Clarity of the responsibility, appropriate division of work, standardization of the procedure, and appraisal. Reviews also should happen. Then comes the next one, more or less the same thing of whatever we have seen. The general condition pertaining to the internal check system may be summarized as under. What conditions should be there in the internal check system? Whatever we have seen now, the same thing will be there. No single person should have complete control over any important aspect of business operation. Every employee's action should come under review of another person. Number two, staff duties should be rotated. Nothing but rotation of employees should take place. A person should not be kept in the same role for a longer period of time. Third one, every member of the staff should be encouraged to go on leave, mandatory leave. This also we have seen, no, cashier should be sent on mandatory leave. Then persons having physical custody of assets must not be permitted to have access to books of accounts. Segregation of duties. Whoever is handling the asset, the same person should not be given the power to maintain the records. There should exist an accounting control in respect of each class of assets. In addition, there should be periodical inspection so as to establish their physical condition. Nothing but this is what we call it as physical verification. That should happen. Mechanical devices should be used wherever practicable to prevent loss or misappropriation of assets. Like as I have told, in big companies, they attach the barcodes for the purpose of identification. Instead of manually writing the numbers, they attach a barcode. If you scan the barcode, all the details of the asset will be reflected. If you could use mechanical devices, that will be much better. See, even the banks also, if you see, they will move the transaction without any vouchers also. Only first you will write the voucher. Automatically, it will get transferred within that CBS. That concerned person, first person you will go. He will transfer in the system to the next person. You can transfer that transaction to the next person. Everything happens within the system only. No manual documents and all. So if there are manual documents, physical signatures can be forged. But if you route it through the mechanical devices, every person will be given a username, password, so their overriding that controls will become little difficult. So use mechanical devices wherever possible. Budgetary control should be exercised and wide deviation should be reconciled. You should have a budgetary control system. Nothing but forecast and budgets should be there. You should check whether actuals are falling within the budgets or is there any huge deviation. Next, for inventory taking at close of the year, trading activity should be, if possible, be suspended, and it should be done by the staff belonging to several sections of the organization. So generally all the companies will do inventory verification as on 31st of March. So whenever you are doing the inventory verification, stop the regular operations. Why? Because you will get confused. No, at one place the sales and purchases are happening and you are simultaneously doing physical verification. Do you think you will get the correct position of the stock? You will not get it. So that's why whenever you are doing the inventory taking, you should stop your regular trading activities. And then finally, the financial and administrative powers should be distributed very judiciously among different officers, and the manner in which those are actually exercised should be reviewed periodically. Nothing but delegation of authority. Like this example also, I have given up to 10,000 one person approval, up to 1 lakh another person approval, up to 10 lakhs another person approval. That kind of mechanism also you should have. Procedure should be laid down for periodical verification and testing of different sections of the accounting records to ensure that they are accurate. Nothing but once again monitoring, regular monitoring you have to do. So all these things we all know it, just it is like a summary of whatever we have already known till now. Nothing new to be taught here. So we are done with internal check system. Then comes one more thing, internal control assessment and evaluation. So nothing but if you want to evaluate, if you want to do an assessment whether internal controls are working effectively or not, what are the things which you generally verify? Techniques we have seen. What techniques we have seen? Questionnaire, checklist, flowchart. So now they talk about assessment and evaluation. Basically, what factors you try to analyze by way of that checklist, internal control questionnaire and flowchart. By using the techniques, we are evaluating, no? We are evaluating internal controls by doing by following the techniques of checklist, internal control questionnaire and flowchart. But what exactly you are evaluating by using that techniques, that is told in here. What exactly you are evaluating, that you are finding in this answer. So if you see here, the quality and effectiveness of internal controls is directly dependent on organizational environment, nothing but control environment. This we have seen in the components of internal control. The tone at the top, board and executive management, and credibility of message on internal control from top plays an important role in establishing strong control environment. This once again I have told you at the beginning only, the tone at the top of the organization will establish the effectiveness of the controls. Following are some of the key components to assess and evaluate the control environment. If you want to know whether there's a good control environment in the organization or not, what factors or what components you will evaluate. Number one, standard operating procedures, SOPs. Like as I have told, if you want something to work, if you want especially internal controls to work, should have a standardization. Every process should be standardized. If anybody has to do a purchase transaction, every transaction should follow the same procedure. If you have to make a sale, they have set one process for the sale. Every sale should follow all that steps. So if you expect the controls to work effectively, or if you want to know whether control environment is effective or not, first thing which you need to check is whether there is a standard operating procedure. Every procedure should be standardized. It should be listed down. It should be communicated to everybody. What is the advantage of having a SOP is, if at all a person leaves the organization, any new person comes into the organization, you need not spend a lot of time and energy in educating him. Just you give the SOP document, he will automatically realize what he is supposed to do, what is his role. So first thing, you need to have standard operating procedures. A well-defined SOPs helps define role, responsibilities, processes, controls, and helps clearly communicate operating controls to all touch points of the process. Controls are likely to be clearly understood and consistently applied, even during employee turnover. Like as I've told, if the employees are changing, still you need not worry. If you have SOP, give him a copy of SOP, he will automatically get to know what is expected from him. Number two, enterprise risk management. Nothing but an organization should identify all the risk, identify the areas of the financial statements which are getting affected, and identify the risk, whether it is high, low, and moderate, and accordingly you have to plan your procedures. So an organization which has a robust process to identify and mitigate risk across enterprise, and its periodical review will assist in early identification of gaps and taking effective control measures. In such cases, surprises of failures in controls is likely to be few. So if you want to have good internal control system, first you should have good risk management, good risk identification. So you have to, the better you identify the risk, the better you list out the risk, the better controls will work effectively. If you don't identify the risk only properly, what is the purpose of having the internal control? So if you don't identify the risk, what will happen is all of a sudden that new risk will pop up, and to your surprise, the control will not work effectively. So if you want to have such lesser surprises, spend more time on your risk management. The better you identify the risk, the better you evaluate the risk, the better controls are going to be. Next one, segregation of job responsibilities. Do you want me to read this once again? We have read it at multiple places. The work is divided among different people. That is segregation of duties. Job rotation in sensitive areas. Do we know this? Yes, rotation. Important in sensitive areas, jobs should be rotated at regular intervals. Delegation of financial powers document. This also we have seen. Person wise, power wise, you have to delegate the authority. Like 10,000, 1%, 1 lakh, 1%, 10 lakh, 1%, delegation of proper power. And to the extent possible, you have to use a technology based controls. So you tell me, manual controls will be effective or technology based controls will be effective? Technology based controls will be generally effective than the manual controls. So that's what they say here. With the advent of computers and enterprise resource planning, that is ERP systems, it is much easier to embed controls to the system instead of being human dependent. See, traditionally we used to have one control. Each and every transaction should be authorized. How traditionally that control used to be implemented? By way of vouchers. A person will write the voucher, the other person should sign it. That is how the authorization mechanism used to be implemented. But today the same control is getting implemented through the system. So like today, if you take Tally and SAP, there you have a future. If I am an accountant, I will pass it entry. I will do the data entry. So and so account debit, so and so account credit. And I will click the submit button. The moment I click the submit button, my ledgers will not be affected. The moment I click the submit button, in the software, you can connect your manager. So now a mail or intimation will go to the manager. So and so person has submitted a entry. It is waiting for your review. Now what my manager will do is he will log into the system. He will go to the inbox. It will show there the list of entries which are pending for his approval. He will open that entry, check the details. What is debit? What is credit? He will also check the supporting documents. The same will be attached in the software. And he will click the accept button. Once he click the accept button, transaction will now be reflected in the financial statements. Same control. What is the control objective? Each and every transaction should be authorized. The same has been implemented traditionally manually with the help of vouchers. Now we are integrating within the software. Tell me which one will be more effective? That software related controls will be more effective. Why? Because as I've told, physical approvals are all based on signature. It is very easy to do the forgery. No? Yes or no? You might have done at some stage, right? No, you should have done. You should have done. I am on record, or else I would have told you what and all you do in the office, where and all you do it. Okay. Right. Failure rate for IT embedded controls is likely to be low. If you implement the controls in the information through the information technology, the chances of failure is very low, and it will have better audit trail, and it will be easier to monitor. So to the extent possible, try to use information technology based controls. So if they ask you the question regarding internal control assessment and evaluation, or even they might ask a question like this: what are the key components that you assess to evaluate the control environment? So different ways they ask a question. So you have to remember these phrases. Often people get confused here. See, if they ask you what are the elements of control environment, then we have to write from the components of internal control. If they ask you the question, what are the elements of control environment? We have seen 5 components now. In that 5 components, we have seen control environment. In that, we have seen subparts. Communication and enforcement of integrity, ethical values, commitment to competence, management attitude, participation by those charged with governance. If they write elements, you have to write that paragraph. Instead, if they ask you the question, key components to assess and evaluate control environment, you have to write this. SOPs, enterprise risk management, segregation of job responsibilities, job rotation, delegation of financial powers document, and information technology based controls. Understood? Clear? Shall we proceed further now? Right. So techniques also we are done, internal checks we are done. What else we have? Reporting requirements. This I will tell you. Very simple. Reporting requirements of the auditor regarding internal control weakness. If you find any weakness in the internal controls, you are required to report it. You are required to report it. To whom you are required to report? To whom you are required to report? So if you see here, they say reporting requirement under 2 categories. If you find any material weakness, in internal control, you have to report it to the management. If you find any significant deficiency, in internal control. You have to report it to those charged with governance. Two simple things they try to say here. If you find material weakness in the internal control, that you have to report to the management by giving a separate letter called letter of weakness or management representation letter, something they call it. In that letter, you have to report the material weakness. On the other hand, if you find a significant deficiency in internal control, what is significant deficiency? The deficiency which you feel it is so important that it deserves the top level management's attention. If you feel some risk, some deficiency, some significant deficiency, some deficiency is there in the internal control, some weakness is there in the internal control system, which is very important. And if you judge that using your professional judgment, you determine that it deserves those charged with governance attention. That kind of deficiency, we call it as significant deficiency. So if you find any significant deficiency, that you have to report it to those charged with governance. So when you are reporting that material weakness or when you are reporting that significant deficiencies, what matters you have to include, what you have to say in your communication, all that we are going to see here. And especially what is important here is many a times asked in the question, how the significant deficiency will be communicated in internal control to those charged with governance. Those requirements are given under SA 265, very frequently asked question. What are the reporting requirements regarding significant deficiency in internal control to those charged with governance? What you should communicate, what and all you have to include in that communication. So that information we are going to learn now. So let us have a look at it. Let us have an understanding of it. Very simple one only. Please pay attention. During the course of audit, auditor may notice material weaknesses. You might find some material weaknesses. If it is insignificant, immaterial weaknesses, you can ignore it. So you have to be worried only when there is a material weakness. Now you will get a doubt, sir, what is the meaning of material weakness? They have defined in the question itself. Material weakness are defined as absence of adequate controls on flow of transactions that increases the possibility of errors and frauds in the financial statements of the entity. There is an area, in that area there should be some internal control, but adequate controls are not there. Either control itself is missing or control is there but it is inadequate. Anything it could be. Either control itself is not there or control is there but that control is inadequate. That means it is not operating effectively. So material weaknesses are defined as absence of adequate controls on flow of transaction that increases the possibility of frauds and errors, that increases the chances of errors and frauds in the financial statements. Such a weakness we call it as what? Material weakness. Repeat everybody, what is the meaning of material weakness? Absence of adequate controls. When I say absence of adequate controls, there could be altogether no controls or controls are there but they are inadequate. So absence of inadequate control that increases the possibility of errors and frauds in the financial statements. So that kind of weakness we call it as material weakness. And that material weakness to whom you have to report? To the management you have to report. How you have to report? That they say here. Reporting material weakness through a letter called letter of weakness or through a management letter. So auditor should communicate such material weakness to the management or to audit committee. Here also once again, if audit committee is there, we do it to audit committee. If audit committee is not there, to the board of directors we do. So on a timely basis, this should be in writing. How you have to communicate? Not oral communication. That should be in a written format. And that written document, what do we call it? Letter of weakness we call it, or management letter we call it. So if you find any material weakness, that must be communicated with the management or audit committee, that too in writing. That written document we call it as letter of weakness or management letter. Sir, what points should be included in that letter of weakness or management letter? So if you could see here, the letter listed down areas of weakness in the system and even offer suggestion. What weakness you have identified, and you can also give suggestions how they can overcome. It shall clearly indicate it discloses only weaknesses which have come to auditor's attention as a result of audit, and his examination is not designed to determine adequacy of internal control. See, management are also not chartered accountants. They don't know what is our responsibility. Sometimes they don't know what is their responsibility only. So now when I report them material weaknesses, so these weaknesses are there in your organization. Some management might have a perception that, okay, auditor will verify internal controls also, and he has verified all the internal controls, and after verifying all the internal controls, these weaknesses he has found out and he has reported us. And they might be under a misconception that apart from this there is no weakness only, because they might be under a wrong perception. Auditor might have verified all internal controls, and after verifying all internal controls, these weaknesses he has found out and he is reporting it to us. We can be assured that there are no other deficiencies apart from that. Can they come to that conclusion? Is that our objective? Are we verifying all internal controls? No. What is our objective? Our objective is to express an opinion on the financial statements. Our main objective is not to report on internal controls. As a part of objective of expressing opinion on the financial statements, we evaluated some internal controls. As a part of that evaluation, these weaknesses we have found it out. Apart from these weaknesses, there could be other weaknesses also. Apart from this, our objective is not to verify internal controls. Our main objective is to what? Express an opinion on financial statements. As a part of that objective, what we have done? We have verified a few internal controls. On that verification, we found some weaknesses. That only we are reporting. We are reporting you the weaknesses, whatever that have come to our attention. And we don't have any objective of verifying all the controls, which means I am giving a hint to them that apart from whatever I am reporting, there could be other weaknesses also. Okay, so that is what you have to clearly indicate. It shall clearly indicate that it discusses only weaknesses which have come to auditor's attention as a result of audit, and the examination is not designed to determine adequacy of internal control. Our objective is to not determine adequacy of internal control. Only whatever have come to our attention, that we are reporting it to you. And this letter serves as a valuable reference document for management for the purpose of revising the system and insisting on its strict implementation. If you communicate those weaknesses, it will be a very important document for the management so that they can follow up with their staff, they can take rectifications, and they can make sure that going forward that will be strictly implemented. And the letter may also serve to minimize legal liability in the event of a major defalcation or other loss resulting from a weakness in internal control. It could also help the organization to prevent major losses because they get to know about their weaknesses and they can take action even before major damage happens. Okay, so there is one case law here. In case of SP Catterson and Limited, auditor was acquitted. Acquitted means released. Auditor was released of charges of negligence for employees fraud in view of fact that he has already informed the client about the unsatisfactory state in the specific areas of accounts and has suggested improvements. So in one case, what has happened is client has made allegation against the auditor. They told that one employee has committed a fraud, but this fellow did not find out. I want action to be taken against him. But what auditor has done is he has shown that letter of weakness as a proof. Sir, I have already communicated to the management. My objective is to not verify all internal controls. So I already found some deficiencies in the internal controls that I have communicated to the management also. This is my letter of weakness. Now how can the management blame me? So what court has decided is, okay, here auditor is not guilty. Why? Because he has clearly communicated to the management what deficiencies are there. Management should have taken action. Instead of taking the action, how can they blame the auditor? So court has released the auditor of all the issues. Okay, so come on, what are the characteristics of letter of weakness? What should be there? Number one, it should contain all the areas of weakness along with improvements. Number two, it should say that he is reporting weaknesses only that has come to his notice and he is not responsible for determining adequacy of internal controls. This serves as a very important document for the management to ensure strict implementation of it. It also serves as an important document to prevent major losses or defalcation of the assets. Understood? Next. Now comes SA 265 requirements. Reporting requirements as per SA 265. Very, very important. As I was saying, multiple times it has been tested. So reporting requirements as per SA 265. Auditor shall communicate in writing what deficiencies? Significant deficiency in internal control. To whom? To directly to those charged with governance. Now, what is a significant deficiency? I have already told. First of all, what is a deficiency? Deficiency means once again weakness only. So they say the same thing. Deficiency means a control is designed, implemented or operated in such a way that it is unable to prevent, detect or correct a misstatement in the financial statements, or control necessary to prevent, detect, correct a misstatement is altogether missing. That's what I told you for weakness also. Either control is not there or control is there but it failed to prevent, detect or correct a misstatements. Both we call it as deficiency. Even if internal control is not there, control is there but it has failed, both we call it as deficiency. At one place they have called it as material weakness, but in SA 265 they called it as deficiency. But they are not asking us to report deficiency to those charged with governance. What they are asking us to report? Significant deficiency. Sir, what is significant deficiency? It is something which auditor himself has to decide. But what they have told in SA 265 is significant deficiency refers to such a deficiency which auditor feels that it deserves the attention of those charged with governance. If you feel certain deficiency deserves the attention of those charged with governance, that you have to decide that will become significant deficiency. There is no hard and fast rule. Auditor himself has to decide using his professional judgment. So whatever it is, the auditor shall report significant deficiency to those charged with governance. Auditor shall also communicate to management at appropriate level on timely basis. In addition to communicating with those charged with governance, he should also fulfill some communication requirements with management. What he has to communicate. In writing, significant deficiencies in internal control that auditor has or intends to communicate to those charged with governance. That means before communicating the matter to those charged with governance, you should also communicate the significant deficiency to management once. This point I would ask you to keep it on hold. This I will tell you when I take up essay 260. Little complicated sentence it is. I want you to remember just till here. So you have to communicate with the management before you communicate significant deficiencies with those charged with governance. Communicate them with the management also. Other deficiencies in internal control identified that have not been communicated to management by other parties and that in auditor's professional judgment are of sufficient importance. So what do you mean by this is, so as per essay 265, if I give further details, as per essay 265, you have to find out a deficiency. First you have to find out deficiency. Now you have to determine, is it significant? Is it significant? Or others. Others means what? Not a significant deficiency. If it is a significant deficiency, you have to communicate with those charged with governance. But before communication with those charged with governance, you have to communicate with the management also. If it is other than significant deficiency, you have to report it only to the management. You have to report it only to the management. That also you have to do it if the management is not aware of it. If someone has already reported that other deficiency to the management, you need not do it once again. So other than significant deficiency, if you have something else which has not yet been reported to the management by others, those other deficiencies you are required to communicate. So very simple everyone, if I have to summarize, as per essay 265, once you find deficiency, determine whether it is significant or not. If it is significant, communicate with the management also, communicate with those charged with governance also. If it is other deficiency, communicate only with management. No need to communicate with those charged with governance. Next. The auditor shall include in the written communication of significant deficiencies in internal control. You will report to those charged with governance, no? How you will report it? In a written format, you have to do it. In that document, what and all you have to explain. Number one, a description of the deficiencies and an explanation of their potential effects. You have to explain the list of all the deficiencies you have identified and what is its impact on the financial statements. Sufficient information to enable those charged with governance and management to understand the context. Don't just say that there is a deficiency, so and so effect is there. You should provide all the relevant information that will help them to understand what is the deficiency. Why? Because as I have told you, management and those charged with governance might not have technical knowledge. These days, even not these days, a few years ago, a few decades ago also, you can say, the top owners of the big companies used to be even uneducated people also. So those people don't know what is deficiency, what is significant deficiency, all this they don't know. That's why if you just use the technical terminology, they may not even understand. So that's why give them context. Say them that, sir, I'm doing audit. I was verifying internal controls. At that point of time, I found deficiency. Deficiency means in this area control is missing, or in this area control is not working. Because of that, there could be loss in the future. So give the context of the information so that they can understand it. And also, in particular, you should explain that the purpose of the audit was to express an opinion. Our ultimate objective is to express an opinion. The audit included consideration of internal controls relevant to preparation of financial statements in order to design audit procedures that are appropriate in circumstances, but not for the purpose of expressing an opinion on the effectiveness of internal control. You have to clearly tell them that, boss, we are responsible for expressing opinion. And as a part of that expression of opinion, we have verified internal controls. Not all internal controls, those internal controls which are related to financial statements. And that too, why we have verified internal controls is to design our nature, timing and extent of substantive audit procedures. We are doing compliance procedures. Why we are doing compliance procedures? To express an opinion on internal controls? No. Why we are doing compliance procedures is to determine nature, timing and extent of substantive audit procedures. Make it clear, or else those charged with governance might have a misconception. Auditor is having an objective of verifying internal controls also. He might feel it. So that's why I tell them that, dear those charged with governance, we are responsible for expressing opinion on financial statements. As a part of that, we have verified internal controls, not all internal controls, only those internal controls which are related to financial statements. That verification also we have done to determine nature, timing and extent of audit procedures, but not for the purpose of expressing an opinion on them. And also, matters being reported are limited to those deficiencies that auditor has identified and concluded are of sufficient importance to merit being reported to those charged with governance. Same like above. We are only reporting whatever we have, whatever that has come to our knowledge, and whatever we find it as significant, that only we are reporting with you. That means we did not find all deficiencies. There could be others also. That's what hint we are giving. Understood? So many a times the question will come around this aspect only. They will say what particularly need to be included in reporting the significant deficiency to those charged with governance. So what will be reported? Number one, a description of deficiencies along with their potential effects. Also give them context in order to understand the deficiencies being reported. And particularly you should mention that your objective is to express an opinion, and as a part of that opinion you have verified internal controls which are related to financial reporting for the purpose of deciding audit procedures, not for the purpose of expression of opinion. And also you are reporting only those matters that you feel it as significant and which have come to your attention. This points must come in that significant deficiency letter which you are communicating into those charged with governance. Clear? So this is what the question is all about. Then see, there is one exam question actually that I would like to cover. I told that whether the deficiency is a significant deficiency or not, that who has to decide? Auditor himself has to decide. Now, whether there will be a significant deficiency or not, there will be sometimes some indicators. There will be some events or transactions which give a hint to the auditor that there could be a significant deficiency. What are that indicators? This is actually from detailed explanation of essay 265. This detailed essay 265 was not given as a part of our CA final syllabus, but they have asked one question in RTP May 23. So as a caution, I am telling you this also. So I told that whatever significant deficiency is there, that you have to report it to those charged with governance. What is a significant deficiency or not? Who has to decide? Auditor himself has to decide. Now there will be some indicators. Sometimes if the auditor comes across certain circumstances, he will get a hint that there could be a possibility of significant deficiency. So what are that indicators which indicate that there is a significant deficiency? So that's what you have here. If you read the question, elucidate, or let me read the entire question here. Auditors are required to obtain an understanding of internal control relevant to the audit when identifying and assessing its effectiveness and also risk of material misstatement. During the audit of Acharya Limited, you observed that significant deficiency exists in the internal control system and you want to ascertain the same. Elucidate, that means explain various indicators of significant deficiencies which will help you in assessing the efficiency of internal control system. So what are the indicators which will give you a hint that there could be significant deficiency? So here they have given some indicators. So as you could see here, as per essay 265, communicating deficiencies in internal control to those charged with governance and management, indicators of significant deficiency in internal controls are, for example, if you come across these circumstances, whatever they are going to explain, a hint should come to you. Okay, there could be a significant deficiency. So what are they? Number one, evidence of ineffective aspects of control environment. You are able to find that control environment is not good. Proper ethical values are not communicated. Management is not showing good attitude. Those charged with governance is not participating. They are not giving importance to capabilities. They are purely recruiting on recommendations. Don't you think this clearly indicates there is a possibility of significant deficiency? So that's what they say. Evidence of ineffective aspects of control environment, such as indication that significant transaction in which management is financially interested are not being appropriately scrutinized by those charged with governance. That means lack of participation by those charged with governance. Identification of management fraud, whether or not material, that was not prevented by entity's internal control. You are able to find some fraud in which who himself is involved? Management itself is involved. That means management is having a bad attitude, bad philosophy. Management's failure to implement appropriate remedial action on significant deficiencies, even after communication. Even after communicating also, management is not taking rectification action. So these things clearly indicate that there is a significant deficiency. Or one more example, absence of risk assessment process. Client is not doing the risk assessment only. Which risks are there in organization? That mechanism itself is not there in the organization. So when the management itself is not paying attention to what risk is there in the organization, there will not be controls also, and that deficiency will not be a normal deficiency. That could lead to a significant deficiency. So absence of risk assessment process within the entity where such a process would ordinarily be expected to have been established, or evidence of an ineffective risk assessment process. In the previous point, they have told there is no risk assessment process only. Now what they are saying, risk assessment process is there, but it is very much ineffective. So evidence of an ineffective entity's risk assessment process, such as management's failure to identify risk of material misstatement that auditor would expect the entity's risk assessment process to have identified. I am clearly able to find a risk in the organization, and I do expect that with basic knowledge, management should be able to identify it. But even such a risk also they are not able to identify. And when I go and ask them, do you have a risk assessment process? They are telling, yes, we have a risk assessment process. So this is an example of ineffective risk assessment process. Then evidence of an ineffective response to identified significant risk. Even after identifying significant risk also, they are not taking any responses. Misstatements detected by the auditor's procedures that were not prevented or detected or corrected by internal controls. So auditor has found out some misstatement which was not prevented, detected or corrected by a misstatement. Or disclosure of a material misstatement due to fraud or error as a prior period item. The management is trying to play the cheap tricks here. They found some fraud or error, but instead of reporting it directly, instead of voluntarily coming forward and disclosing it, they are showing it as what? Prior period item. And also evidence of management's inability to oversee the preparation of financial statements. That means management is not able to understand the financial statement process only. Management is not aware of financial statements, schedule 3, all that they are not aware. When they are not aware, it provides an opportunity for the person, whoever is preparing, to override the controls and do the misstatements. So these are all few indicators which give a hint to the auditor that there could be a significant deficiency. Understood? So this content you will not be able to find it in the main concept book. This you will not be able to find it even in the study material also. This is something tested in the RTP of some attempt from May 23 they have tested. So I have included here, and also we have understood it. Clear? Next. So this also we are done. Reporting requirements we are done. So now we have this small 2 lines of paragraph, but this is a lot of headache. So anyhow, let me take that headache and explain for you. So when the auditor shall design and perform test of controls. When you should design and perform the test of controls. Test of controls, other name is what? Compliance procedures. When you will perform compliance procedures. Now many people will say after, I know you will say that only. You will say after risk assessment procedure, before substantive audit procedure. No, that is not what they are asking. Throughout the, no, that is also not the answer. That is not the question only. So what is the intention of the question here is, I will tell you. See, understanding the context is very difficult. Answer is very easy, but understanding the context of the question is difficult here. See, how many audit procedures we perform broadly? What are they? Risk assessment procedures, further audit procedures. Further audit procedures further divided into compliance procedures, substantive audit procedures. Come on guys, last few minutes of the session, please do participate. Right. So in the risk assessment procedures, what we do? In the risk assessment procedures, what we do? We identify the risk of material misstatement. Compliance procedures, what we do? We determine whether the controls are effective or not. Do you think by performing risk assessment procedures, by performing compliance procedures, will we be able to obtain all the evidence required for expression of opinion? See, discussion might sound out of the place. Please follow. I will give you conclusion. Once I explain the concept, you will get the conclusion. So by doing risk assessment procedures, we are only identifying and assessing risk of material misstatement. By doing compliance procedures, we are only effectiveness of controls we are deciding. So whatever evidence we require for expression of opinion, that we are getting only by performing substantive audit procedures. So all the evidence, whatever we require, that we are going to get it only by performing substantive audit procedures. Now, why can't we skip compliance procedures? Why don't we directly perform the substantive audit procedures? Because substantive audit procedures are the only procedures which is giving complete evidence required for the expression of opinion. Why I should spend the time on compliance procedures once again? Why the need arises for the auditor to spend the time on compliance procedures? Why not directly proceed further to the substantive audit procedures? So if you read the heading now, when the auditor will perform compliance procedures or test of controls, what do they mean by that is, in what circumstances auditor will spend time on performing compliance procedures instead of directly performing substantive audit procedures. In what circumstances auditor will spend time on performing compliance procedures instead of performing directly what? Substantive audit procedures. Because all the evidence required for substantive audit procedures, we are going to get it from what? Substantive audit procedures. But still, when auditor will spend the time on compliance procedures? I will explain the answer, then you will get the context even much clear. Say for example, first what I will perform? Risk assessment procedures I will perform. In the risk assessment procedure, I will understand how many things? Come on. Entity, environment, internal control. So as a part of risk assessment procedure, I get a basic understanding of the internal control. See, when I am verifying, when I got the basic understanding of the internal controls, at that point of time only I realized that this entity is following very outdated controls. Controls are completely waste of time here. When I performed risk assessment procedures only, I did not test. Testing when it will happen? Compliance procedures testing will happen. But in the risk assessment procedures, I only obtain what? Understanding of internal controls. But I'm seeing the organization making a list of internal controls. By looking at the organization as a part of risk assessment procedure, I know that controls are completely waste of time. Here, verifying the controls doesn't have any purpose. That means while performing risk assessment procedures only, I have an expectation that controls will not work effectively. These controls are waste. And I don't want to rely on controls altogether. When performing risk assessment procedures, I came to know that internal controls are waste. I don't want to rely on controls. I have decided. When I have decided? While performing risk assessment procedures only. Do you think in that case also I will spend time once again on performing compliance procedures? When you don't want to rely on the controls only, why you will perform compliance procedures once again? Then what you will do? Directly you will perform substantive audit procedures. So I have told you, when you perform risk assessment procedures, when you have an expectation that controls will not work effectively, when you have decided at the stage of risk assessment procedures that you don't want to rely on internal controls, then what you can do? You will skip compliance procedures and you will perform substantive audit procedures only. But the question they are asking is not when you will skip compliance procedures. Question they are asking what? When you will perform compliance audit procedures. That means the sentence whatever I have framed, I have to put it in an opposite manner. Able to understand what I'm trying to say? I know this is somewhat a little bit unbearable. So please concentrate. So I told when you will not perform compliance procedures. What did I say? You performed risk assessment procedures and you have an expectation that controls will not work effectively. You don't want to rely on controls. Then you will skip compliance procedures and perform substantive audit procedures. This is a statement for when you will not perform compliance procedures. But I want a statement for when I will perform compliance procedures. Listen carefully. Can I put it this way? When I perform risk assessment procedures, I have an expectation that controls will work effectively. And I want to rely on internal controls. Then only I will spend the time on performing compliance procedures or test of controls. Able to understand? Clear and comfortable, everybody? Now, if you read the sentence here, the auditor shall design and perform test of controls to obtain sufficient appropriate audit evidence. To obtain sufficient appropriate audit evidence as to the effectiveness of relevant controls. That means you will spend the time on performing compliance procedures to obtain evidence regarding operating effectiveness of controls when, number one, the auditor's assessment of risk of material misstatement at the assertion level. When you will do that risk of material misstatement assertion? At the time of risk assessment procedures. That means when you are performing risk assessment procedures, you have an expectation. What expectation you have? That controls are operating effectively. That the auditor intends to rely on operating effectiveness of controls in determining nature, timing and extent of substantive audit procedures. Then only I will perform compliance procedures. Able to understand? So when you are assessing risk of material misstatement, basically when you are performing risk assessment procedures, when you have an expectation that controls will work effectively, that means when you want to rely on internal controls to determine nature, timing and extent of substantive audit procedures, then only I will spend the time on performing compliance procedures. At the stage of risk assessment procedures only, I don't have an expectation that controls are working effectively. Then why unnecessarily I will waste my time once again on compliance procedures? Then I will not perform it. Understood? See, only one line of sentence is there, but background is very difficult to understand. To make the context of the question itself is very difficult here. Next, one more case. See, in some cases, what will happen is substantive audit procedures alone will not give you all the evidence. Sometimes it might not be possible altogether to obtain evidence only from substantive audit procedures. Say, for example, there is an e-commerce platform like Flipkart. There's an e-commerce platform like Flipkart. You want to verify the revenue of Flipkart. On everyday basis, we know lakhs and crores of transactions are there. Say, for example, throughout the financial year, there are some 10 crores transactions have taken place on the Flipkart. Now, I wanted to obtain evidence regarding this 10 crores worth of transactions. If I have decided, if I have to perform substantive audit procedures alone to obtain audit evidence, that means I should do 100% of verification. I will get audit evidence only from substantive audit procedures. But do you think, is it possible in this case? If I have to obtain audit evidence only from substantive audit procedures, I have to do 100% of verification. So can I get all the evidence only from substantive audit procedures here? No. So now what I will do, I have to perform compliance procedures. I will verify what internal controls are there in the sales here. If I found the controls are effective, then I will perform substantive audit procedures on a sampling basis. Then you have to perform then you can perform substantive audit procedures on a sampling basis. So what I want to say here is one more case when you will perform substantive audit or compliance procedures is when you believe that substantive audit procedures alone cannot give audit evidence. It is not practically possible to get all the evidence only from substantive audit procedures. When you feel that, then you will perform compliance procedures. On the other hand, say a small company is a startup company, throughout the year only 1,000 transactions are there. Here I need not verify controls or anything. What I can do, directly I will take substantive audit procedures, I will verify 100% of the transactions and give the opinion. There is no purpose of compliance procedures only. But today, in keeping in mind the today's volume of the transactions, in most of the cases, it is quite impossible to obtain all the evidence only from substantive audit procedures. That's why I will spend the time on performing compliance procedures. Right. So that's what they say here. One more case where you will spend the time on performing test of controls when you believe that substantive audit procedures alone can't provide sufficient and appropriate audit evidence. Understood? So two cases when the auditor will perform test of controls or compliance procedures is when you are assessing the risk of material misstatement at the assertion level, you have an expectation that controls are working effectively. That is, you want to rely on internal controls for determining nature, timing and extent of substantive audit procedures. Then you spend the time on performing test of controls. Number two, when you believe that substantive audit procedures alone can't provide sufficient and appropriate audit evidence, then also you perform compliance procedures. Understood? So now we have one more last heading, various frameworks of internal control. Nothing but in order to have effective implementation of internal controls in the organization, globally we have various frameworks. Frameworks means what? Globally we got some guidance from various organizations all over the world, including India, from regulatory authorities, from statutory authorities, from accounting authorities. We got some frameworks, we got some guidance. So if we could follow that guidance, we can make the internal controls in the organization effective. So what are that frameworks? Not just India, guys, across the world we have frameworks for internal control. Basically, these global organizations, they have given guidance. If you follow these steps, internal control in your organization will be effective. So like that, some frameworks are there. Let us try to understand what are that frameworks. Here also there is nothing concept here to explain. Just we have to go through all the frameworks and close this. First one, let us start with India. We have a guidance note on audit of internal financial controls over financial reporting. Nothing but 143 subsection 3 clause I. We have to report on internal financial controls. Now ICAI has given a guidance note how to report on that internal financial controls over financial reporting. That is one guidance which we have. So ICAI has issued guidance note on audit of internal financial controls over financial reporting, which covers aspects on what matters ICAI is giving guidance on matters of scope of reporting, how you have to report as per Companies Act 2013. What are the essential components in the organization? What components should be there in the internal control? Technical guidance. This ICAI is also giving technically guidance on you how to report on internal financial controls and implementation of guidance on audit of IFC. Basically, ICAI is giving a framework for auditors to effectively fulfill their reporting requirements under 143 subsection 3 clause I. On different matters they are giving guidance. Next one, we have one more framework called internal control integrated framework issued by Committee of Sponsoring Organizations of the Tradeway Commission. We also call it as COSO framework. Now what this framework says, this framework is guidance for management, not auditors. Only guidance not given by ICI is a guidance for auditors. Now rest of all other frameworks are guidance for management for effective implementation of internal controls. So what does this COSO framework say? This framework was introduced in 1992, a guidance on how to establish better controls so companies can achieve their objectives. So according to this framework, what should be the objectives? What should be the internal control principles? They have altogether 17 principles are there. Total how many principles are there? 17 principles representing fundamental concepts associated with 5 components. We have 5 components, no? So what are the 5 components? Control environment, risk assessment, control activities, information and communication, monitoring. In each of this component, they asked organization to follow in total 17 principles. So out of that, they have divided. Like as you could see in control environment, 5 principles you should always have. What 5 principles? They should always demonstrate commitment to integrity and ethical values. You should always show your commitment to integrity and ethical values. Exercise oversight responsibility. Someone should overlook the transactions. Someone should monitor the transactions. Establish structure, authority and responsibility. This is what we call it as organization structure, authority and responsibility in the control environment component. Demonstrate commitment to competence. Same point we have seen in the control environment. Commitment to competence, second point only. And enforces accountability. So these are 5 principles should be followed in the area of control environment. Then in the risk assessment, there should be 4 principles. What are those principles? Specify suitable objectives, identify and analyze the risk, assess a fraud risk, identify and analyze significant changes. In the control activities, you should follow some principles like select and develop control activities, select and develop general controls over technology, general IT controls, application controls, deploys through policies and procedure. And in the information and communication, you should follow some principles. You should use relevant information. You should communicate internally also. You should communicate externally also. And finally, in monitoring, 2 principles: conduct ongoing or separate evaluation or evaluate and communicate deficiencies. See, nothing here for me to explain. So as per COSO framework, the only thing which you have to remember is in 5 components, you need to have in total 17 principles you need to have. In the control environment, you have 5 principles, risk assessment, 4 principles, control activities, 3 principles, information and communication, 3, monitoring, 2. Right, next. Then, objectives of internal control. As per COSO framework to be used by organization to assess effectiveness of internal control to achieve 3 categories of objectives. That means as per COSO framework, internal control should achieve any of these 3 objectives. Number 1, operational objectives. Nothing but whatever we have told as those internal controls which are related to efficiency and effectiveness of operations. So these are related to effectiveness and efficiency of entities' operations. Then we have reporting objectives. Some internal controls will have reporting objectives. What are they? These are related to internal and external financial and non-financial reporting to stakeholders, which would encompass reliability, timeliness, transparency, or other terms. And then we have some objectives which are related to compliance related objectives. So as per COSO framework, every organization should try to implement internal controls to achieve 3 kinds of objectives. What are the 3 kinds of objectives? Operational objectives, reporting objectives, compliance objectives. And even COSO framework has also recognized that no matter how much effort you put into it, there will always be inherent limitations to internal control. That was recognized by COSO framework as well. Then we have something called guidance on assessing control published by Canadian Institute of Chartered Accountant. So even Canadian Institute of Chartered Accountant has also given some framework. What framework they have given? This was developed by Canadian Institute of Chartered Accountants with the objective of improving organizational performance and decision making with better controls, risk management and corporate governance. Now what they have done is they have included 20 criteria. This Canadian Institute has gone to another level. COSO has given only 7 principles. Now they have given what? 20 criteria they have given for effective operation, for effective control in 4 areas. So according to this Canadian Institute, 4 areas, 20 criteria should be there. What are they? Purpose, commitment, capability, monitoring and learning. Like that they have identified 4 areas. In that 4 areas, 20 criteria they have given. It emphasizes that control involves entire organization but begins at individual level with employees. These minute details are important. They might ask a MCQ from this. They can say some framework emphasizes on controls which says that control involve entire organization but begins at an individual level. Which kind of framework emphasizes this? COCO framework. So like that they might frame questions like this. And in order to assess whether controls exist and are operating effectively, each criteria would be examined to identify that controls are in place to address them. 20 criteria they have told no, so you have to verify all that 20 criteria has been complied with or not. Then we have something called COBIT, control objectives for information and related technology. So they have also given one framework which we call it, which has been given by an entity called ISACA, Information Systems Audit and Control Association. So like that, we have an entity, they have given this framework. Here they have gone one more step ahead. They have given 34 high level processes, and that cover 210 control objectives in 4 domains, in 4 areas. So planning and organization, acquisition and implementation, delivery and support, monitoring and evaluation. This is a framework relating only to IT controls. This doesn't talk about manual controls. COBIT mainly talks about IT controls. They will talk about it. So it is a supportive tool for managers and bridges crucial gap between technical issues, business risk and control equipment. From here, what is the potential for asking a question is, they might say, they might frame a MCQ. So they might, from the frameworks, they might frame a MCQ. So in one statement, what they will say is, COCO framework will act as a supportive tool for managers, which is actually incorrect. COBIT act as a supportive tool for managers. Like that, they will do a mix and match. Next, business managers are equipped with a model to deliver value to the organization and practice better risk management practices associated with IT processes. So it helps the business manager to have better risk management practices. It is a control model that guarantees integrity of information system. From this also they can ask a question, which framework guarantees the integrity of information system? Which model guarantees it? COBIT guarantees it. Today, COBIT is used globally by all managers who are responsible for IT business processes. It is thoroughly recognized guideline that can be applied to any organization. Many organizations are in fact really following it in the real world. Overall, COBIT ensures quality, control and reliability of information system in organization, which is also most important aspect of every modern business. This framework guides organizations on how to use IT resources, that is application, information infrastructure, people, to manage IT domains, processes, activities to respond to business requirements, which include compliance, effectiveness, efficiency, confidentiality, integrity. All this will be ensured by this framework. And well-governed IT practices help businesses to comply with laws, regulations, and contractual arrangements. Then comes the fifth point, internal control, guidance for directors on the combined code published by Institute of Chartered Accountants in England and Wales, ICWAE. That only know, ICAEW, sorry. So this institute has also given some guidance. So what guidance they have given? When the combined code of committee on corporate governance was published, so this institute agreed with London Stock Exchange that it will provide guidance to assist listed companies to implement the requirements in the code relating to internal control. So this ICAEW, they have given guidance to, they have promised to London Stock Exchange that they will help all the listed companies to implement internal control. The key principles of the code are: the board should maintain a sound system of internal control. They have told that the management, the board of directors or every company should maintain a strong internal control system. The directors should at least annually conduct a review of effectiveness of group's system of internal control, and they should report to the shareholders that they have done so. At least every year they have to do a verification that controls are working effectively or not. The review should cover all controls, not just financial. The review should cover all controls, including financial, operational, compliance controls and risk management. And companies which don't have internal audit function should from time to time review the need for one. So if you don't have currently internal audit department, period after every year after year, you have to analyze now is the need has arisen for the purpose of appointing an internal auditors. The guidance requires directors to exercise judgment in reviewing how company has implemented requirements of code relating to internal control and reporting to shareholders. Even they have to report to the shareholders also how they have complied with the objectives of this framework. The guidance is based on adoption by company's board of a risk-based approach, the establishing a sound system of internal control and reviewing its effectiveness. So they will give a policy, they will give a guidance which should be adopted by the company's board of directors. This should be incorporated by company within its normal management and governance process. It should not be treated as a separate exercise undertaken to meet regulatory requirements. That means don't take this internal control as a legal burden. Do it as a part of your normal process. Acknowledge it. Then we have finally SOX, Sarbanes-Oxley Act. Today, whatever Companies Act provisions we have under corporate governance, those are all influenced from Sarbanes-Oxley Act only, which provides rules and regulations for listed companies in US. So whatever they have told in US, many Companies Act provisions are influenced by Sarbanes-Oxley Act. So Section 404 of Sarbanes-Oxley Act of USA mandates that all publicly traded companies must establish internal controls and procedures for financial reporting and must document, test and maintain and procedures to ensure their effectiveness. They have made it mandatory for every public listed company in US. The purpose of SOX is to reduce reduce possibilities of corporate fraud. Many corporate frauds have taken in the past. Especially we have one bigger fraud called Enron fraud, which is actually a history or starting point of the biggest so-called corporate scams today, that actually led to the creation of the SOX and these internal controls. The SOX Act has revamped federal regulations pertaining to publicly traded companies, corporate governance, and reporting obligations. In all these matters, they have given new rules and regulations. It was followed with the constitution of PCAOB. They have even constituted one more committee, Public Company Accounting Oversight Board. It regulates audits of public companies and SEC registered brokers, dealers to protect investors. The same role in India is played by NFRA. Looking at them only, they have constituted in India NFRA. In US, SOX has constituted that PCAOB to regulate the audit of the listed companies and all. Looking at that, our Indian government has constituted NFRA. Next. The SEC rules and PCAOB standard require that management should perform a formal assessment of its controls over financial reporting, including tests that confirm the design and operating effectiveness of controls. So every management should assess their controls over financial reporting. Management include in its annual report an assessment of internal control over financial reporting. They should just not do assessment, even they have to include a report in the annual report regarding their assessment of internal financial controls. And the external auditors provide two opinions, one report on effectiveness of internal controls over financial reporting, one normal opinion on the financial statements. The same in India also we are doing. 143 subsection 3 clause A, we are giving internal report on internal controls over financial reporting, and we are also giving a traditional opinion on the financial statements. So as I've told, many things which SOX has implemented in US that we are copying in India. Okay, that's all. So this is what the concept of internal control. So in this chapter we had three aspects. One is risk assessment, that we have completed. Internal controls, that also we have completed. Now the last component which is left out is materiality. But however, questions regarding internal control and or pending, that we will try to do it in our next session. Okay, so I will leave you now. Bye. See you in the tomorrow session at sharp 8:30. Okay. Right. So let us resume our discussion. So in the previous session, we have completed the risk assessment and internal control part. I will do it. So in the previous session, we have completed the risk assessment, internal control part. We have one more part to get completed, which is internal control part is still pending. Yeah, sorry, materiality part is still pending. So let us try to have a quick recap of the content relating to risk assessment and internal control. Quickly we'll try to cover revise a few important concepts, not everything, a few important things whatever are there that we will try to do. So for this chapter actually I'm preparing a summary. Yesterday I have started doing it since so many point wise things are there, so much of things are there. So I have started working on the summary. I am halfway done, so I will complete the summary. That summary also I will share it with you. But the thing is, I'm telling you once again, don't rely only on that summary. First go through the main content, try to get some comfort over the main content in this concept notes. After that, for the purpose of revision and all, use that summary notes and all. If you completely rely on summary notes, once again you comment will blame me definitely. So I will say that. So just for the sake of your ease in revision, so I am working on it. So by tomorrow or day after tomorrow it will get ready. So whatever chapters where there is a lot of this kind of theory content without any conceptual discussion, so there I will do the summary and share it with you. So I'm halfway done through it. So balance I will do in the form of chats and also some interactive thing. I have worked it out. So we'll share that with you. Right. So what and all we have understood? What are the main concepts from the discussion, whatever we had yesterday? First of all, we have understood what is the meaning of the term audit risk and what are its components. So what is the meaning of the term audit risk? Risk of expressing an inappropriate opinion when the financial statements are materially misstated. That means when the financial statements contain a material misstatement and you are giving a inappropriate opinion. So when I put it in specific terms, when modified opinion is appropriate, but if you are giving a unmodified opinion, that will come under audit risk. Whereas the other way around will not fall under audit risk. That means if you are giving a modified opinion, when unmodified is appropriate, that will never come under audit risk. Why? Because of that, auditor will not face any kind of legal consequences. That is something which will fall under business risk, loss of clients and loss of reputation. So when it comes to audit risk, there are how many components? Two components we have. What are the two components? Risk of material misstatement and detection risk. What do you mean by risk of material misstatement? The risk of misstatement in the financial statements even prior to audit. It contains two more components. What are they? Inherent risk and control risk. Inherent risk means the risk of susceptibility of an assertion to a material misstatement either individually or in aggregate with no internal controls or before considering internal controls, or in simple terms absence of the internal controls, we call it as inherent risk. Then we have something called control risk. That means internal control is there, designed, implemented, maintained, but it failed to prevent, detect, or correct a misstatement in the financial statements. So this control risk we also call it as control deficiency or control weakness also we call it. And then we have seen detection risk. What do you mean by detection risk? The audit procedures performed by the auditor may not be able to detect a misstatement which is already there in financial statements. So that we call it as detection risk. What kind of relationship exists between risk of material misstatement and detection risk? There exists an inverse relationship. That means when the risk of material misstatement is high, you plan for more audit procedures. When you plan more audit procedures, you try to reduce your detection risk. Then after that, we have seen there are two levels of material misstatement: risk of material misstatement at the financial statement level, risk of material misstatement at the assertion level. The risk which has a potential to cause a misstatement in the entire financial statements, not just in specific items, that we call it as risk of material misstatement at the financial statement level. On the other hand, if the risk is having a potential to cause a misstatement at for one specific assertion, like class of assertion, account balances, and disclosures, then we call it as risk of material misstatement at the assertion level. Then we have seen one small concept like steps for identification of risk. So we have seen various steps like first you have to identify the significance of the risk, its impact, likelihood of its occurrence, then what are the assertions and which are all getting affected, what is the impact on the assertions, blah blah blah, a list of things we have seen. So then comes risk based audit. So what do you mean by risk based audit? So nothing but if we are giving prioritization to the risk before planning for audit procedures, that we call it as a risk based audit. So in the risk based audit, we first analyze the audit risk. On that basis, we decide the materiality, and then we design our nature, timing, and extent of audit procedures depending on the risk, prioritizing the risk. And there are three phases in the risk based audit approach. What are the three phases in the risk based audit approach? Number one is risk assessment. Number two is risk response. Number three is reporting. Basically, risk assessment. That whatever risk assessment procedures we perform that do fall there, like understanding the entity, identifying and assessing the risk of material statement, analyzing, verifying internal controls and all. So once we have identified the risk, then we perform our substantive audit procedures, compliance procedures, all that we will perform. And then finally we do the reporting, whatever opinion we have that is required to be expressed. Then talking about internal controls, internal control refers to any policy, which any process which is designed, implemented and maintained by whom? By the those charged with governance, management or other personnel to provide reasonable assurance regarding the achievement of four kinds of objectives. What are the four kinds of objectives? Reliability of financial reporting, safeguarding of the assets, efficiency and effectiveness of the operation, compliances with the laws and regulations. And when we talk about the scope includes accounting records, so accounting controls also, administrative controls also. But auditor will be concerned about only those controls which are related to financial reporting, prevention and detection of frauds and errors, accuracy and completeness of the records, and also timely preparation of the financial statements. Basically, those accounting controls only auditor will be concerned with it. Auditor will also verify administrative controls only when they have a relation to the financial reporting. And then we have seen accounting controls should fulfill some objectives. So you should expect accounting controls to fulfill at least a few objectives. What are that objectives? Transactions are all promptly recorded, transactions are all properly identified, and also they ensure the safeguarding of the assets and all. They ensure accountability. So like that we have seen, and even three more points also I have added from other place. Then inherent limitations of the internal control we have seen. No matter how much internal controls are effective, they only give reasonable assurance, but they can't give absolute assurance. Why they can't give absolute assurance? Because they suffer from some inherent limitations, those limitations which are unavoidable in nature. What are they? Number one is cost exceeding benefits. Number two, unusual transactions, they can't handle it. Number three, pollution among the individuals. Number four, misuse of the authority. Number five, wrong assumptions or wrong judgments. So that is a inherent limitation. So then after that, what question we have? What is the concept we have? Structure of internal control policies, or structure of internal controls or policies and procedures which are required to be included in the internal controls. So what will be included? Segregation of duties, adequacy of the records, authorization, accountability and safeguarding of the assets, and independent checks also should be there. Then I think we have discussed about components of the internal control. So we have mainly 5 components of internal control. What are they? Control environment, entities risk assessment process, control activities, information system including related business process, and then finally we have monitoring of the controls. So when I say control environment, we have to set the tone at the top of the organization. That is basically we have to create the good culture in the organization. So what and all are elements of the control environment? Number one, we have commitment to sorry, not communication and enforcement of integrity and ethical values, commitment to competence, participation by those charged with governance, management philosophy and attitude, organizational structure, assignment of authority and responsibility, HR policies and procedures, right? So then we have entities risk assessment process. The organization should study about their own organization and find out the risk can come from various sources, like new change in operating environment, a change in the laws and regulations, a change in accounting standards, new personnel, new technology, new information systems. So because of that, of all that, risk will come. Then when it comes to control activities, this is the phase where actual implementation of the internal controls is going to happen. 4 kinds of broad control activities we have seen. Number one is performance reviews, IT controls divided into 2 categories: application controls and general IT controls. Then after that we have seen physical custody. Then last one, segregation of duties. So these are basic control activities. Then we have information system. When I say information system, we have software, hardware, network, people and infrastructure, everything will come there. So when we are using information system for relevant for financial reporting, it should have some methods. What methods you should have? More or less the same like the way we have seen accounting related controls objectives. So it should ensure that all the transactions are recorded in the correct headings, so like that, and it should be recorded in the correct period. So like that, it should have some, it is expected a minimum methods from information system related to financial reporting. Then comes monitoring of the internal controls. Basically, we need to review whether the controls are working as expected. So we have to monitor it on either you can do it on a continuous basis, or you can do separate evaluation. Internal audit team also can assist you in that monitoring, and even you can rely on external information for the purpose of monitoring of the controls, like customer complaints, notices from the regulatory authorities. That also you can use it. Then next major concept we have seen, what are the various techniques for evaluation of internal control. So what are the various techniques for evaluation of internal control? Questionnaire we have, checklist we have, flowchart we have. Flowchart is a diagrammatic presentation of internal control. It is the most concise and briefest way of presentation of internal control. It gives a bird's eye view of entire internal control system, and it is easy to spot the errors in the flowchart. And then comes to questionnaire and checklist. In both the cases, we have series of questions drafted regarding elements of internal controls, and the questions are drafted in such a manner that answer is going to be either yes, no, or not applicable. But the differentiating factor between the two is, in the case of questionnaire, we will give it to the client and we will get it filled by the client's staff or client's management. Whereas in the case of checklist, we give it to our audit staff, ask them to follow that instructions. You can either say questions to be answered by auditor staff, even you can say instructions. And in case of questionnaire, they give one more instruction. When you are drafting the questions, draft the questions in such a manner: yes denotes a positive response and no denotes a negative response. And questionnaire will be more detailed, whereas checklist will concentrate mainly on main control objectives. So these are the two differences. So then after that, we have seen the concept of internal check. Internal check is not altogether a separate concept. It is one of the important element of internal control only. So what do you mean by simply an internal check system? Division of duties among different peoples in such a manner that the work of one person will automatically come under the review of another person. And also, no single person will have a control over entire organization, and periodically the duties are required to be rotated. So this is what the summary. And then we have seen objectives. What are the objectives of internal check system? So they have told 6 objectives. Number 1, to detect errors and frauds, to prevent the errors and frauds, and to increase the efficiency of the staff, and also to locate the responsibility where exactly mistake has taken place. You can easily find it out, and it will increase the reliability on the financial statements of the entity, and also it can prevent the misappropriation or manipulation of the accounts. And some considerations we have seen: if you expect the internal controls to work effectively, some things you need to keep in mind. Number 1, everybody should have a clarity of responsibility. There should be proper division of the work. Number 3, the process should be standardized, and periodical reviews also should happen. Appraisal in the sense review, periodical reviews also should happen. I think, yeah. So Yeah, then we have this internal control assessment and evaluation. I told you, even they can ask this, they can also ask the question in a different manner. They can say what are some of the key components to assess and evaluate the controls in the to evaluate the control environment. Then also you are required to say the same things, 6 things that they have told. Number one, there should be standard operating procedures, and enterprise should do a proper risk management, segregation of responsibilities, job rotation is required, delegation of financial powers, that means basically authorization mechanism and all, and finally information technology based controls should be there. So this is what the brief summary of what and all we have discussed in our previous session. So somewhere we spent around, if I'm not wrong, or yesterday we got a total effective recording of 5 hours of 20 minutes we have got a recording. So in that I think 5 hours, almost close to 5 hours, we have spent it on this risk assessment and internal control only. And whatever discussion we had, so that is worth discussing, because everywhere we are going to see a linkage with the risk assessment. Why? Because that is one of the fundamental thing. Unless you do the risk assessment, the entire effectiveness, the entire strength of the audit lies in your risk assessment process only. So that's why this concept is having a lot of relevance at various instances, at various chapters. You will come across the linkages with the risk assessment process. At that point of time, I do wish now that you will not face any kind of confusion. Okay, right. So let us proceed further now. So what we shall do, shall we do questions regarding this, or shall we do the materiality directly? We'll do one thing, we'll do the materiality also, then we will complete all the questions in one go. So we'll do the materiality, some linkages with some materiality related questions also will be there. So everything we can complete in one go. Right. So let us try to understand it. Simple concept only, very easy one. So materiality. So till now, whatever we have discussed regarding risk assessment and risk assessment and internal control, that has been taken from SA 350. Voice okay, right? Right. So risk assessment and internal control related discussion, we have taken that a discussion from the standard SA 350. And when it comes to materiality, whatever content we are going to discuss materiality, all that content has been taken from SA 320. So SA 320 is also one of the most important consideration while while conducting the audit of the financial statements. And in fact, practically speaking, where this materiality will come into picture. I have told you the process of audit, right? So what did I say till now? Process of the audit. So I have told you that first auditor will get appointed, then he will perform preliminary engagement activities, then he will do risk assessment procedures. So then he will do risk assessment procedures, then he will do planning of the audit, then we perform audit procedures, that is execution, and then finally reporting we will do. So now where this materiality, fixing of the materiality, where does it fall? Where does it fall? So practically speaking, along with the planning only, we decide the materiality. Materiality determination happens here. So after performing risk assessment procedures, when we are actually doing the planning, that is when we are establishing audit strategy, plan and program. So along with the development of audit strategy, planning and program, we also fix materiality. We also decide the materiality. Okay. So now, what do you mean by materiality? What is the first place we have come across this term materiality when we are discussing the objectives? In that first objective, what we have seen, whether financial statements are free from material misstatements. So that is the first place where we have come across the term material. What is the general meaning of the term material? Something which is significant, something which is important, or something which is major. So these are all the synonyms for the term materiality. And when a misstatement will be considered as material? When we consider a misstatement as material, if it could influence the decisions of users of financial statements. So because of a misstatement in the financial statements, if the user is expected to change his economic decision, so then we call such a misstatement as material. So we have seen examples also. Take a company like X Limited. It is a small company, hardly having 1 CR of turnover. And there is another company, Reliance Industries Limited, which is having 6 lakh plus crores of turnover. So in this entity, Reliance, say for example, 1 CR worth of fraud has taken place. How much? 1 CR worth of fraud has taken place. If you are a prospective investor, or if you are already an investor in the company, if you came to know about this misstatement, you came to know that a fraud has taken place in the company, will you stop yourself from investing in the company? Or if you are already an investor, will you wind up all your shares? Will you sell all your shares? Will you change your decision? Will you stay out of the company, or will you stop yourself from investing? No. So you found a misstatement, but it is not having any significant impact on your decision making. So those misstatements, we will not consider them as material. Those misstatements will not consider them as material. Say for example, say here the company's turnover is 10 CR. The same 1 crore worth of misstatement has taken place. Everything remains the same. Whatever fraud has taken in the Reliance, the same fraud has taken place in even X Limited also, and the amount is also same. Same 1 crore worth of fraud has taken place. Now, if you are a person who is looking for a prospective investment in the company, or if you are already a investor in the company, by coming to know about this 1 CR worth of fraud, will you stop yourself from investing in the company? Yes. Or if you are already invested, will you try to quit from the company? Yes. So the same misstatement here, also same misstatement. What factors led to that misstatement are same. The people who have committed are similar. The significance is also same. Impact is also same. But at one place you are telling that is not material, but another place you are telling it is material. So the point which I want to conclude here is materiality is not absolute. We can't exactly define this much percentage will be, this much things will always be material. We can't say that. So materiality is something which is not an absolute thing. Materiality is something which is relative thing, or materiality is a subjective decision. What is it? This is a subjective decision. What do you mean by subjective? It changes from person to person, circumstance to circumstance, entity to entity, industry to industry. It will change. So that is what the materiality decision is. It is a relative, it is subjective, and it is something which is purely based on the professional judgment of the auditor. Who will decide what is material, what is not material? Auditor himself will decide what is material, what is not material, and it is purely based on his professional judgment. He will use his knowledge, experience, and training, and accordingly he will determine what is material, what is not material. And few more things talking about materiality. We generally express materiality in quantitative things. We generally express materiality in quantitative terms. What do you mean by quantitative terms? Numbers. Generally, in majority of the circumstances, we express materiality in numbers. Like 10 lakhs is material, 5 lakhs is material, 10% is material, 5% is material, 2% is material. So we generally express the materiality in quantitative terms. In numbers, we try to generally express it. But materiality will not be always in quantitative terms. Sometimes materiality could be even as per qualitative aspects also. Sometimes even materiality could be as per qualitative aspects. What do you mean by qualitative aspects? I already told you. In the financial statements, what is the thing which is qualitative? Disclosures, notes to accounts. So sometimes we can express materiality even in the qualitative aspects also, qualitative terms also. Other than numbers also, we fix the materiality. Sir, how come I will fix the materiality? Say for example, I will say that I will compulsorily verify related party transactions. Even 1 rupee of misstatement has happened in related party transactions, I will consider its impact on my financial statements. So that means here I am saying that I will be very concerned with the related party transactions. Related party transactions will always be material. That's what I have felt. Or going concern related assessment. I am saying that going concern related assessment is always material. It is always significant. In that area, misstatement should not happen. Understood, everybody? So here how I am deciding my materiality. Here I am deciding the materiality in qualitative aspects, not in quantitative aspects. So depends, it all depends on the facts and circumstances. Depending on the item of the financial statement which you are verifying, we sometimes we decide the materiality in numbers, that is in quantitative terms. Sometimes we decide the materiality in qualitative aspects. It all depends on the item which you are verifying. It all depends upon the matter which you are verifying. So whatever it is, materiality can be decided in two aspects, either quantitative or qualitative terms. Now let us talk about a determination of materiality. How to determine the materiality? Determination of materiality, we will see how to fix that. Sir, if I'm conducting audit of some company, say for example, if I'm conducting audit of Infosys company, now how will decide how much amount is material? Which amount of misstatement I should be bothered about? Which amount of misstatement I should not be bothered about? First, I have to take that decision. That is very, very important that you have to do it at the planning stage only. Why? Because throughout the audit, you keep obtaining evidences, you keep finding misstatement. So while doing audit procedures, which misstatement you have to get worried, which misstatement you have to ignore, that you can do it if you decide the materiality well in advance. So that's why at the planning stage only, depending on risk assessment procedures, after we get the understanding of entity, environment and its internal control, after we identify risk of material misstatement, so after considering the results of preliminary engagement activities, using all that information, I fix that materiality at the planning stage itself. That's why in the previous class, when I was teaching the audit strategy, I have shown you this practical example of audit strategy. In the audit strategy itself, we have decided the materiality. In the audit strategy itself, we have decided materiality. So in the strategy document itself, you will be able to find that materiality. So now how to fix that materiality? The question comes, how to fix that materiality? So when you are expressing materiality in quantitative terms, so how you have to fix that materiality is, first you have to arrive at one percentage. First you have to arrive at an percentage. Sir, how to arrive at that percentage? Once again, professional judgment. So you have to keep one thing in mind. SA 320 is not giving detailed steps or exact steps how to calculate the materiality. It doesn't give. It only gives you an approach. SA 320 only help you out to decide the approach. What approach you have to follow, that only they will say. Exact guidelines they are not going to say. Everywhere they will leave it to the choice of the auditor. That is what the entire beauty of the auditing subject, leaving it out to the auditor's choice. And so on, I think I might have already told you this. So in audit, the beauty itself is professional judgment. Nowhere they will say exactly what needs to be done. Why? Because if they, like in accounts, we learn hard and fast rules. In taxation, we learn hard and fast rules. But in audit, we don't learn hard and fast rules. We learn multiple options depending on the facts we have to apply. If standards on audit also will give you hard and fast rules, then what we are supposed to do, everybody knows, not just us. Client also, if he opens the standards on audit, he will get to know what auditor will verify. Then you tell me, will there be any purpose of doing the audit? No. So that's why the entire auditing concept itself is revolving around professional judgment. The same professional judgment will be here as well. So first they say, in order to determine materiality, you have to fix percentage. Sir, how to arrive at that percentage? Once again, professional judgment. So some person might feel 1%, some person might feel 2%, some person might feel 5%, some person might feel 10% as material. So using my knowledge, using my experience, using my training, I have decided 5% to be material. So now 5%, some percentage you have arrived at. Now this percentage should be multiplied on some factor. No, to arrive at that materiality figure, we need to multiply that percentage with some benchmark, with some item. So that we call it as benchmark. What do we call it? Benchmark. So you have to arrive at a percentage. That arrived percentage should be multiplied with some benchmark. Sir, what could be a benchmark? What could be a benchmark? You are telling this 5% I have to multiply it with the benchmark. So what could be that benchmark? Benchmark could be any item from the financial statements. It could be profit. It could be revenue. It could be total assets. It could be total expenses. It could be net profit. It could be gross profit. Whatever it is, any item of the financial statements can be taken as a benchmark. See, once again, see here also they are not telling exactly what you need to do. Once again, they have given multiple options. They've given multiple options. Any of this you can choose it as a benchmark. Profit, you can choose it as a benchmark. Revenue, you can choose it as a benchmark. Total assets, you can choose it as a benchmark. Total expenses, whatever it is, any item from the financial statements, you can choose it as benchmark. So these many options they have given. Which one I have to choose? Once again, professional judgment. Once again, professional judgment. So you will consider various factors. Basically, you will consider various factors and accordingly you will decide which benchmark you have to use. Sir, what kind of factors I will consider? So I will consider factors like, first factor which we will consider is volatility. Whether that factor, whether that these many options are there, I will find out which one is constant or which one is following a trend. Say for example, one company is there, its profit is following a trend. Like in 1 year it was 100, in 1 year it was 110, 120, trend is there. Profits are not volatile, profits are following one trend. So then I can take profit as a benchmark. Take another company which is a highly risky business. What they are doing is in 1 year profit was 50, in another year profit was 10 crores, in another year profit was 100. Very volatile. In that case, I can't take the profit as a benchmark. Why? Because the figure is not following any trend or it is not remaining constant. It is very, very volatile. So we will check the volatility of that benchmark. And also we will consider the nature of industry, or expectation of users of the industry. Like say for example, uh, IT companies. In IT companies, people are interested to more know about the profits. People are interested to know more about profits. They are not worried about the turnovers and all. Why? Because in IT companies, since it is a service sector, profit margin is very high. So people, investors in the IT sector, more interested to know about profits of the company. Whereas if you take FMCG companies, like if you take HUL and all, for these companies, the margins are very shrinking margins they have. So that's why people, shareholders of the FMCG company, they want to know the turnover. They want to know their market share. Turnover basically represents their market share. So they wanted to know about turnover. So if I'm conducting audit of IT company, I will take the profit as a benchmark. If I'm conducting audit of a FMCG company, I will take the turnover of benchmark. So in some cases, an entity might be a highly asset-oriented entity, heavily capital invested company. So much of money has gone into that purchase of the assets. Or it is in the early phase. It is a startup entity. It is recently started, heavily manufacturing entity, and many of the expenditure and much of the expenditure has gone into the capital expenditure. There, I can take total assets as my benchmark. So like that, various factors auditor will consider and he will arrive at the benchmark. Say for example, in my typical example, I am conducting audit and I felt that I am conducting on an audit of an IT company, and I came to know that the profits are also not volatile. The profit is also some more or less constant or following a trend. So now what I will do is, using my professional judgment, I will take the profit as a benchmark. So how much percentage I have arrived? 5%. How I have arrived it? Professional judgment. Then I have taken profit as a benchmark. How I have arrived at that benchmark? Once again using a professional judgment. So 5%, now I have to take the profit figure. Say for example, my company is making 100 CR worth of profit. So if I calculate that, what my materiality will be? 5 crores will be my materiality level. 5 crores will be my materiality level. So I have decided the materiality in my financial statements audit is 5 crores. What do I mean by that? When I am doing audit, if at all I find misstatements, I will be worried about only those misstatements which either in individual or in aggregate, either individually or in aggregate, if they exceed this 5 CR, if they exceed my materiality level, then only I will modify my opinion. Say for example, I am conducting the audit, and while conducting the audit, I found a material misstatement amounting to only 50 lakh rupees. Is there a misstatement in the financial statements? Yes, there is a misstatement in the financial statements. But is it material? No, it is not material, because it is far lower than the materiality level whatever I have set. So there is a misstatement, but it is not material. Will I modify my opinion here? No, you will not modify your opinion. So whether you will modify or not, that depends on whether the misstatement is material or not. Just having a misstatement alone will not be enough. That misstatement should be even material. It should be expected to influence the decision of users of the financial statements. And this is how we fix the materiality. So we take a percentage and we multiply it with the chosen benchmark. Fine. Next, few more things talking about the materiality. See, the standard essay 320 says materiality, you have to decide it at two levels. Materiality, you have to decide it at two levels. One is overall materiality. One is overall materiality, and the other one is performance materiality. So materiality, you have to decide it at two levels. What are the two levels of the materiality which you have to decide? One is overall materiality and the other one is performance materiality. Sir, what do you mean by overall materiality? The definition says materiality decided for the financial statements as a whole. Whatever materiality level that you are deciding for the financial statements as a whole, for the entire financial statements, if you are deciding one materiality level, that materiality level we call it as overall materiality. Like for example, I am conducting audit, okay, of one entity. Take an extract of the balance sheet. The client has given me their balance sheet. So in the balance sheet, I'm able to find data. So balance sheet is there. The total of the balance sheet is 100 crores. So in that 100 crores, I have fixed assets amounting to 50 crores. I have trade receivables amounting to 20 crores. I have inventories amounting to 20 crores. Cash and cash equivalents, I have 10 crores. This is the breakup. Okay. So while I am doing the audit, I have decided materiality level. So say for example, I have taken total assets as my benchmark. On that, I have multiplied 5%. So it will come to 5 CR. I told that if in my entire financial statements there is a misstatement of 5 crore rupees, then I will consider my entire financial statements are materially misstated. So this 5 crores of materiality I have decided, and this materiality level I have decided for the financial statements of a whole. For the entire financial statements, I have fixed the materiality. But instead of that, what I have to do is, you can also decide something called performance materiality. So for each assertion, for each item of the financial statements also, I can decide the materiality level separately. So what is the need for this performance materiality is, I decided my materiality as 5 CR. Say for example, I found 1 CR worth of misstatement in fixed assets. Since it is less than my overall materiality, I might ignore it. I found another 1 CR worth of misstatement in trade receivables. Since it is less than my overall materiality, I might ignore it. So there is some another item where I'm able to find 2 crores worth of misstatement. I might ignore it because it is less than my overall materiality. And there is one more misstatement also, 1 CR in some other item, that also I might ignore it. So now what should happen is, individually they are not material, but collectively when I take it, they are material. But I might miss it out. Individual items, when each person is verifying, I allocate the work, no. So what I will say, for example, to one person I have allocated fixed assets. He will have information only regarding fixed assets. While verifying fixed assets, he got to know that there is 1 crore worth of misstatement. But since he doesn't have information on other items of the financial statements, he might find that this misstatement is not material and he will not report it to anybody. Similarly, I will assign a work of trade receivables to somebody else. He might find some misstatement. He might take a decision that in that area misstatement is there, but it is not up to the overall materiality level. He might ignore it. So they might not discuss with others. But collectively, when I take, those misstatements could be material. So that's why what I have to do is, I have to fix the materiality for each item of financial statements, and that materiality we call it as performance materiality, and this performance materiality generally should be lower than the overall materiality level. Yes or no? So performance materiality should be lower than overall materiality level. It should not be higher than overall materiality. If you are fixing the performance materiality higher than overall materiality, it is not serving any purpose. So that's why performance materiality, you have to keep it, and that performance materiality should be generally lower than overall materiality. Say for example, I am saying that if in my fixed assets 1 crore worth of misstatement is there, then I will consider in the fixed assets might be materially misstated. In my trade receivables, 1 crore is the materiality level. In my inventory, 50 lakh rupees is the inventory level. 50 lakh rupees is the materiality level. So like that, for each item of the financial statements also, you can maintain that. You have to maintain that materiality, which will be generally lower than the overall materiality in the financial statements. Understood? Then there is one more concept which we need to understand, something called specific materiality or specified materiality, we say it. Practical, this is practical. This phrase you will not use, you will not find anywhere in the industry, anywhere in the standards, but in the industry it is very common to use. So something which is specified materiality. Sir, what is this specified materiality? See, there will be certain items in the financial statements where the misstatements could be very small. There will be some sensitive areas in the financial statements where small misstatements, which are far lower than specified material, which are far lower than the performance materiality, which are far lower than the overall materiality. Even such small misstatements will happen in some sensitive areas, still they influence the decision of users of financial statements. Generally, only material misstatements will influence the decision of users of financial statements. But there will be some sensitive areas in the financial statements where small misstatements will happen. which are far lower than my overall materiality level, overall performance materiality level. The misstatement is very, very small, but still it is expected to influence the decision of users of the financial statements. So in those sensitive areas, we keep a specified materiality level which is far lower than my overall materiality, which is far lower than my performance materiality. Like for example, related party transactions. Related party transactions. So in the related, I have said, for example, Reliance Industries Limited. My overall materiality in the Reliance is 100 crores. My performance materiality is not falling behind 50 crores. This is the materiality levels I have set. So in the Reliance Industries Limited, in the related party transactions, even if 1 CR worth of misstatement has also taken place, that is very significant. That is very sensitive matter. So users might change the decision because of that 1 CR worth of misstatement in such area. Related party transactions might be directors have colluded with each other. Or you take managerial remuneration. Managerial remuneration, we give a disclosure of managerial remuneration, how much CEO is drawing, how much managing directors are drawing, how much whole time directors are drawing. So that managerial remuneration is there. That is also one such a sensitive area where even small misstatements also can influence the decision of users of the financial statements. Like if someone came to know CEO is drawing salary of more than 1 crore, CEO is drawing salary 1 CR more than actually what he is eligible for. So even this small misstatement also might be very sensitive. People might change their decision because of this. So for these sensitive areas, we keep something called specified materiality. Able to understand? Overall materiality will be applicable for all items of the financial statements. Performance materiality also will be applicable for all items of the financial statements. But for specified materiality, that is applicable only for selected items of the financial statements. Clear? So that's what even you will be able to find it in the audit strategy here. Like as you could see, overall materiality, we have seen logistics company related strategy, while discussing the audit strategy planning and program. See here what they are saying. Overall materiality, INR 1 CR for the entire financial statements as a whole, they set the materiality as 1 crore, approximately 6.67% of the profit before tax. Rational, profit before tax is relatively volatile, therefore revenue based materiality is also considered for a more stable base. Might be, so they are telling that profit is volatile, and also they have told 0.4% of revenue also they have told. So profit is more volatile, that's why they might have taken revenue as a benchmark. Then comes performance materiality. Performance materiality is how much? 0.75 crores. See here, which is less than overall materiality. Then comes the specified materiality. For selected items, sensitive items, we keep separate materiality level. What selective items they have told? Related party transactions. They have kept the materiality there as 10 lakh rupees only. And legal and regulatory penalties. This is also one such a sensitive matter where they have also set the materiality at very low level. Capital expenditure, they might have felt this as very significant, very sensitive area. There they have kept the specified materiality as a 25 lakh. So which areas require specified materiality? Once again, here also there is no fast and hard and fast rule. It also depends on nature of the industry, nature of the entity, nature of the transactions. Auditor himself will decide where specified materiality will be required. Understood? Clear everyone? Right. So this is what the major discussion regarding the materiality, and a few more things I will try to explain here itself. Revision of materiality. So once we complete this concept, we can directly start reading it. So we will try to understand revision of materiality. So generally, when we are deciding materiality, guys, tell me, when we are deciding materiality? At the planning phase. Nothing but, can I say, in the initial phases, of the audit only, we are deciding the materiality. Do you agree with me? Yes or no? So generally, in the initial phases of the audit only, we are deciding the materiality. At the planning stage only, we decide materiality. So when we are deciding materiality at the planning stage, we are doing it on the basis of risk assessment procedures. So by performing risk assessment procedures, we have some info. On that basis, on that information we use. We also perform preliminary engagement activities. From that also we get information. That also we use. So at the beginning, we have limited information. On the basis of that limited information only, we fix our materiality. But during the course of the audit, when you actually start performing compliance procedures, when you actually start performing substantive audit procedures, you might get some extra information. You might get some extra information. Say, for example, initially, while performing risk assessment procedures, you thought risk is very low. You thought risk is very low. So you set the materiality at a higher level. That means since the risk is very low, you don't want to be bothered about small items. You want to be concerned about only bigger items. So you set the materiality as, say, for example, 5 CR, you have set the materiality. But later when you performed compliance procedures, then you realize that controls are not at all effective in the organization. Controls are there, but there are so many lapses in the internal controls. Controls are not at all working effectively. Or when you actually started performing substantive audit procedures, then you realize that there is more scope for material misstatements in the organization. That means when you performed extra procedures, you come across the circumstances to reassess the risk of material misstatement. I told you about this yesterday. In some circumstances, you might be required to reassess the risk of material misstatement. So what did I say? When you are assessing, when you are reassessing the risk of material misstatement, what impact it will have? When you are reassessing the risk of material misstatement, what impact it will have? You need to make changes to your audit strategy and plan. You need to make changes to your overall audit procedures. You need to make changes to your opinion also. And one more change, what you have to make it, you need to revise your materiality level also. Along with all the changes, you need to even revise your materiality level. So whenever you are reassessing the risk of material misstatement, that will result a revision of audit strategy, audit plan, audit program. That will result in revision of materiality. That will result in revision of nature, timing and extent of the audit procedures. That will result in form and nature of opinion also. Okay, so like that, sometimes while you are actually performing the audit, you might get some extra information. You might do reassessment of risk of material misstatement. You can get information regarding some other matters which might require you to come back and revise your materiality levels. Yes, you are permitted even by the standard. SA 320 even gives you the permission that you can and you have to revise the materiality if at all required. So in some circumstances, there is 100% need for you to revise the materiality, and in that circumstances, only when you revise the materiality, your audit will be effective. If you are not revising the materiality in such circumstances, your audit is not going to be effective at all. Understood? So this is what regarding the revision of the materiality. So that's all. This is what the major discussion from SA 320. So let us try to quickly cover the standard now. So materiality, what they are trying to say, meaning they are saying first materiality. Materiality is an important consideration in audit to evaluate whether the financial statements are free from material misstatements. So we know it, one of the basic objective itself is to verify whether financial statements are free from material misstatements. If we have to decide that, one of the most important factor which we need to consider is what is material. SA 320 on materiality in planning and performing an audit requires that an auditor should consider materiality and its relationship with audit risk. I told you already, whenever you are doing whenever you are doing risk assessment procedures, on that basis only we are deciding materiality, and there is a relationship between audit risk and risk of materiality levels or not. 100% yes. Next, a misstatement is considered material when if it could influence decision making process of users of financial statements. What could be considered material for all situations can't be defined precisely. Can you exactly define what is material in all the circumstances? No. Why? Because it is relative, it is subjective. And an amount or transaction material in one situation may not be material in other situation. In certain cases, quantitative limits of materiality is specified. So generally we express materiality in quantitative terms only, in numbers only. A few such cases are, some examples they are giving. Companies must disclose in notes any income or expense in items of item of income or expense item exceeding 1% of revenue from operations or 1 lakh. So here we are expressing materiality in numbers, 1%, 1 lakh. Or a company should disclose in notes to accounts shares in the company held by shareholding more than 5%. Like these are all materiality requirements in the schedule 3. Like you have to disclose some items separately, and if someone is holding more than 5% of the shares, that their names you have to mention and all. Next, materiality levels may change as audit progresses. You need not stick to that materiality level, whatever you have decided at the beginning of the audit. You can revise that materiality levels during the course of the audit. Now, how to fix that materiality? So what they are saying, determining materiality. How do we fix it? Auditor shall apply a appropriate percentage on selected benchmark. Generally, the percentage on profit before tax benchmark is usually higher than turnover benchmark. See, what do you mean by this is, I told revenue also can be taken as a benchmark. Turnover also can be taken as a benchmark. See, we are generally between the two. Which one is a bigger figure? Turnover is a bigger figure. Say for example, if the turnover is 100 crores, so revenue and turnover both are same, no? Profit. So revenue is 100 crore, profit is 10 crores. Generally turnover will be bigger figure, revenue will be bigger figure. See, when I am choosing profit as a benchmark, say for example, if I have decided 5% as material, we have decided 5% as material. When I am choosing profit as a benchmark, I take 5% as material. So if I calculate that 5% on 10 crores, how much amount I will get it? 50 lakh rupees you will get it. But to get the same 50 lakh rupees of materiality here, you don't need to multiply with 5 percentage. Even if you multiply with 0.5 percentage also, you will get the same 50 lakh rupees. Yes or no? So the point which I want to conclude here is, between revenue and profit, which one is bigger figure? Revenue will always be larger figure. For a larger figure, smaller percentage also will give a reasonable number. But comparatively, profit is a smaller figure. There we have to give a little bit more percentage to arrive at a reasonable figure. You can't say for revenue I have used 0.5%, for profit also I will use 0.5% only. Then you will get very low materiality level. So you have to get worried about even 5 lakhs amount of misstatement also, which is not actually a reasonable decision. So that's why, since the turnover is a bigger figure, the percentage which we apply on a turnover benchmark will be smaller than the percentage which we apply on a profit benchmark. Because turnover is a bigger figure, smaller percentage will give you reasonable amount of materiality. When compared with that, profit is a smaller figure. There you need to give little bit higher percentage to arrive at a reasonable figure. Understood? Next. Levels of materiality. How many levels of materiality will be there? Two levels of materiality. So one is overall materiality. Materiality is set for financial statements as a whole. And other one is performance materiality. Specific materiality level for particular class of transaction, account balance or disclosures, and which is generally less than overall materiality. This we also call it as assertion level materiality. So these are other names. So overall materiality, the other name for that is pervasive materiality. Performance materiality, we call it as assertion level materiality. And also includes general materiality level for all class of transactions, balances and disclosure. So what do you mean by this is, see, performance materiality you can decide item wise, or even you can have general performance materiality. So what do you mean by general performance materiality is, this is something, the example whatever I have given is general performance materiality. For the entire fixed assets, I have kept it as 1 CR. But what I can do even further is, I will identify in the fixed assets what is the breakup. So in the fixed assets, I have, say for example, land and buildings I have, plant and machinery I have, furniture and fittings I have. So land and buildings is 20, plant and machinery is 20, furniture and fittings is 10. So what I can do is, I can fix materiality at this level also. I can fix materiality for each item level also. That is performance materiality. That is also a performance materiality. Or alternatively, what you can do is, for the entire fixed assets also, you can fix one overall general performance materiality. So like this, material performance materiality you can do to whatever extent you want it to go. So either you can keep for certain head of item separate general performance materiality, or even you can go deeper into that specific head and their item wise performance materiality also you can do it. Understood? Next. Factors which are helpful in identifying the benchmark. So I told you have to decide a percentage and that you have to multiply with the benchmark. First of all, what are the various examples of the benchmark? See, what are the various examples of the benchmark? Profit before tax, turnover, gross profits, total expenses, net worth and net asset value. Anything can be taken as a benchmark. Next, so these many benchmarks are there. How will you identify one specific benchmark out of these many options? So now we have factors in identifying benchmark. So what are the various factors for determining benchmark? Number one, any element of asset, liability, income and expense. Anything you can take it as a benchmark. The first one is not factor here. First one is a general statement. So any item of income, asset, expense, liabilities can be taken as a benchmark. From second point, actually factors will come. Any indication in applicable financial reporting framework. Sometimes there will be an indication in the applicable financial reporting framework only. Like Schedule 3 itself says, whatever items are there which are more than 0.5% of the turnover or 1 lakh, whichever is higher, it should be stated separately. That means there is a hint in the Schedule 3 itself that you can take turnover as a benchmark. Next, it also depends on entity's capital structure, entity's ownership, like how it is financed, whether it is debt financed, equity financed, or what is its ownership structure, that also will consider. And information needs of majority of the users. Like I told, in the IT company, majority of the users expect to know profit. In a FMCG company, majority of the users expect to know turnover. So keeping in mind the requirements of users of the industry, also we decide the benchmark. Then comes, it also depends on applicable law or regulation. Like example, under Income Tax Act, payments more than 10,000 are required to be stated separately or are disallowed altogether. 48 disallowance will be there. So while verifying cash payments, what will be the materiality level that you set? 10,000 only, you will set directly because there is an indication in law and regulation itself. Next we have sources for selecting benchmarks. Say for example, you have decided profit as benchmark. After considering all the factors, you have considered profit as a benchmark. Now this profit, from where you have to take this profit figure, from where you have to take? You will say financial statements, I know, but from which financial statements? See, if the current year financial statements are already ready, generally what will happen is, in small entities, for example, if you are appointed as auditor of the financial year 24-25 and the entity is small, we will generally start the audit after completion of the year, after the financial statements are ready. So in that case, what we do is, from the current year financial statements only, we will take the benchmark. But in large entities and listed entities, you are aware, we will not wait till the completion of the year for the purpose of starting the audit. During the course of the year also, we will go and periodical basis till that date, like once in every quarter we will go, we verify transactions till that date. So in that case, when you have started doing the audit, financial statements of the current year are not yet ready. Then from where you will take the benchmark? Then we will start looking for other sources. What could be that other sources? You can take it from prior period financial statements, or even you can take it from budgets also. Budgets and forecast entity will prepare, no? From that budgets you can take the benchmark, or even you can take it from the quarterly financial statements. From where you can take, even on the basis of quarterly financial statements. Basically you do projection. In one quarter, if it is this much, into 4 that you will do, that figures you can take it. So if the current year financial statements are ready, you need not look for any other sources. You can take the benchmark from current period financial statements only. If at all current year financial statements are not ready, then you have to start looking for other sources. In those cases, you have to take the benchmark from either prior period financial statements or budgets, or even quarterly financial statements. Next one. Revision in materiality level, this we have already seen. Overall and performance materiality may need to be revised. In some circumstances, we may be required to revise it. In what circumstances we are required to revise it? Number one, change in circumstances. Sometimes circumstances might change. Whatever circumstances that are prevailing at the time when we have decided the materiality, basically at the time of planning, the same circumstances might not be there when we are actually performing the audit. Or availability of additional information. When you are doing the audit, you might get extra information. Then also you can revise your strategy, revise your materiality, sorry. A change in actual financial results than the anticipated results. So just now, as I've told, one of the source from where you can take the benchmark is budget. On the basis of forecast, you can take the budget. See, say for example, when I'm conducting the audit, current year financial statements are not ready. So I want to take revenue as a benchmark. So what I have done is, from the budgets I have taken. In the budget, the revenue is 100 crores. So I have taken that budgeted revenue as benchmark. But I have started doing the audit. Later, during the course of the audit, financial statements are ready. Year got closed, financial statements are ready. If my actual financial results also somewhere like 90, or they are also 100, or they are also 110, 105, since the actuals are also in a close range of budget, I need not revise my materiality. But say for example, you have taken the budgeted revenue as 100 crore rupees, but actual revenue turned out to be 175 crore rupees. Now you tell me, will your materiality be relevant? No. What you need to do? You need to revise your materiality level on the basis of actuals. So if the actuals are close range with anticipated figures, no need to revise. If the actuals are deviating a lot from anticipated figures, then we need to revise our materiality levels. Next, increase in the estimated risk. This I've already told you. Whenever you are doing the reassessment of the audit risk, you need to make the changes to your materiality also. Next, a change in auditor's knowledge of the client's business. When you get some extra information regarding the client's business, this also could be a case where we need to revise our materiality. So tell me, what are the factors which might lead to revision of materiality? Number one, change in circumstances, availability of additional information, change in actual financial results from anticipated figures, increase in estimated risk, and change in auditor's knowledge of the client's business. And whatever materiality that you have set, all that needs to be documented. How you have fixed that materiality, how you have decided overall materiality, what is the figure, how you have decided performance materiality, what is the figure, if you fix the general performance materiality, what is the figure, if you have revised this materiality levels, what are the revised figures, along with the reasons why you have revised that materiality levels. All this should form part of my documentation. So that's what they say here. The auditor shall document the following: materiality for the financial statements as a whole, materiality for particular class of transaction account balances, general performance materiality. If you are revising any of the above, that revised materiality levels along with the reasons. Understood? That's all. This is what regarding SA 320. So what we have understood entirely in this SA 320, how to fix the materiality, meaning of the materiality we have seen, which is expected to influence the decision of users of the financial statements. And then we have seen that materiality, you can express it in qualitative terms and also quantitative terms. Then we have seen how to fix the materiality. First, we arrive at a percentage. That percentage we multiply it with benchmark, and that benchmark you can take it from multiple sources. It could be a profit, revenue, etc. And there are various factors which will affect the auditor's decision regarding selection of the benchmark. Like we will consider, add one more line here. See, I have told you till applicable law or regulation, no, add one more line here. One more point was missing here. Volatility also you add it. Volatility of the benchmark also, one more point you added. That is also very, very important. This was missed out. How much volatile your benchmark is. Nothing but how much change is happening in the benchmark. If it is very frequently changing, we don't prefer that. We go for alternative options. So volatility also you have to consider. Please do write that point also. So these are all the factors which we will consider. Then in what circumstances we need to revise our materiality, and what things we need to document regarding the materiality. So that's all SA 320 we have successfully completed. So with this we have completed even the entire chapter materiality, not just materiality, risk assessment, internal control, and materiality. Everything we have completed. Okay, so now we will take a break. Then after the break we will resume. Fine. So the time is 10:05 now. Please do come back by 10:30. So after the break, what we will do is we'll first quickly cover the question bank of this chapter. Will not take more than 30 minutes. So we'll do the question bank completely. Once we are done with the question bank completely, we will start 500 series. 500 series of the standards we will do. 501 we will do. 500 and today's target I will tell you. Let us see how far we will be able to achieve it. 501 I will do. 505 and then 510. 530, 550 might not be possible, I do know it. Okay, so but at least I will try to complete 4 standards: 501, 505, 510, 530. At least till here we will have a target. If at all time permits, if at all you are very active and you are able to grasp the things quickly, we can complete say 550 as well. So we will see. Okay, we will not rush through the things. We will take it slowly, because from here the questions are getting tested. So we'll take our time and try to grasp the content. Okay, right.